So hello all my dearest students of full English. I hope you all are doing good. I hope your studies are going on great for your upcoming exams. So as I've promised to you all that I will be coming up with the latest ICAI MCQ case scenarios which ICAI has uploaded on their students portal. And as I've promised to you all that I will be coming up with the video for the same in full English also. So what has been done by the ICAI in the last two attempts, that is since May 2024. Earlier, they used to give a PDF of the entire MCQs on their website. But nowadays, they don't put the PDF of the MCQs on the website. Instead, they put the MCQs individually in the portal of the student, where the student has to go inside the portal and select the MCQ chapter wise, and then the student has to go and attempt those MCQs and get the answer done. I would say very time consuming exercise. So for that purpose, since May 2024, I have been doing one exercise that I have been taking out the screenshot of all those MCQs and then getting it typed, converting that into a PDF and giving it to my students. And after that, I have also promised you that I'll make a video on the same explaining the reasoning of the same. And this video will cover the latest 34 MCQ case scenarios which are uploaded on the ICAI students portal, for which the PDF I'm attaching in the comment box. You can check it over there. You can download the PDF from there. And this entire video will explain you more than 100 important concepts of different provisions of the income tax law. This video will explain you so many small concepts that a student generally miss out while studying at their own. Therefore, it is my request that you watch this video completely at least once, if possible twice, if further possible thrice. I know thrice it is not possible, but at least twice it is possible. So you can keep the PDF in front of you. Okay, you can take a printout of the PDF if you want, or you can keep the soft copy of the PDF in front of you and you can start watching the video from here onwards. Now, before starting the discussion of the first MCQ case scenario, I would like to tell few things, and that is I will be discussing the reasoning of each and every MCQs. Along with that, I will also be explaining the scenarios, what exactly is happening in the particular question. But I'm not going to read the entire question in front of you. That will waste a lot of time of mine. Okay. So reading the question will be a waste of time. So I will not read the question, but I will definitely do what? I will definitely explain each and every MCQ. What is the answer for a particular question and why the answer of this particular question is this particular answer. Okay. So don't worry about all those things. Okay. So let us start without wasting any further time. Okay. So the first case scenario is a beautiful case scenario on section 194Q and section 206C1H, that is TDS and TCS. Now what is the first MCQ over here? Is Mr. Subhash required to deduct TDS at source in respect of purchases transaction made directly with car accessories? If yes, when and what is the amount of tax to be deducted? Now you have to be very careful. Now Mr. Subhash, let's read few things about Mr. Subhash first of all. So what is the question? The question is Mr. Subhash required to deduct tax first? Second, if yes, when? What is the timing of deduction? Third, what is the amount of tax to be deducted? There are three questions that we need to answer. Is he liable to deduct? When he is liable to deduct? And what is the amount of tax that he is liable to deduct? For that purpose, we need to read the question little bit. Now, Subhash is a retailer, as you can check over here. Now, the last year turnover of Subhash is 10.5 crore. Now, the last year turnover of Subhash is more than 10 crore. Therefore, 194Q will be applicable to Subhash. Okay. 194Q is applicable if the last year business turnover is more than what? It is more than 10 crore. And Subhash's last year turnover is more than 10 crore. Now, Subhash is purchasing total how much? Total of this Subhash is purchasing, this he is purchasing, this he is purchasing, this he is purchasing. Definitely Subhash is purchasing total of more than 50 lakh goods. So 194Q is applicable if you purchase more than 50 lakhs goods. Now, there are a few very important points that I need to say over here before we jump on the solution. In 194Q, there is a CBDT circular which says that generally the TDS has to be deducted on credit or on payment, whichever is earlier. But the circular says that if you make the credit first, and the payment later on, if the credit is done first and the payment is done later on, then the TDS has to be deducted on excluding GST amount. Okay. If the credit is first, payment is afterwards, then the TDS has to be deducted on exclusive GST amount. But the circular says that if the payment is first and the credit is later, what is first? The payment is first and the credit is later, then the TDS has to be deducted on inclusive of the GST portion. So this is what the thing has to be kept in mind. Okay. Now be very careful in this case, this particular case. Let's talk about Subhash, when Subhash is purchasing and how much Subhash is purchasing. Let's talk about that. Come to this discussion. The first time Subhash is purchasing on 15th of May and he's deducting, he's crediting in the books of accounts on 15th of May and he's paying on 2nd of June. So what is first? The first is what? The first is credit. Therefore, he is liable to deduct TDS on excluding GST because the credit is first, payment is afterwards. Therefore, he is liable to deduct TDS on GST, excluding GST. Now, at this point of time, that is on 15th of May, the purchase excluding GST is only 45 lakhs. Therefore, on the first transaction, Mr. Subhash is not liable to deduct the TDS. Is it clear to all of you? I hope it is clear to all of you. Now, the second transaction, if you see, the second transaction, the credit is happening on 18th of June and the payment is happening on 30th of June. Okay. Again, the credit is on 18th June, payment is afterwards. So again, the credit is first, payment is later. Therefore, the TDS has to be deducted on excluding GST if the total purchase exceeds 50 lakhs. Now, the next transaction, is the purchase exceeding 50 lakhs now? Yes. Earlier it was 45 lakhs. Now it is 15 lakhs. So the exceeding portion, amount exceeding 50 lakh is how much? 10 lakhs. So now he is liable to deduct TDS on 10 lakh rupees excluding GST because the credit is first, payment is later. So he will deduct TDS on excess of 50 lakhs. On 10 lakhs, 0.1% TDS has to be deducted by the buyer. On which date? On the date of what? Credit. So check. The first answer is yes, you are supposed to deduct 0.1% of 10 lakh rupees on 18th of June. Okay. I hope everybody understood the reasoning of the first particular answer. Let's go ahead now. Next one is the credit is in August 28, but the payment is in August 17. So what is happening first? Now the payment is happening first. See, 17th August is obviously before 28th August. Therefore, now the payment is happening. Now you will deduct TDS on entire amount including GST 2537. Is it clear all of you how you are supposed to interpret this particular provision? So now TDS will be deducted on what? On 17th of August, entire 2537 into 0.1%. You can check it over here. That is 17th August you will deduct TDS on 2537. Okay. 2537 is the amount of TDS that you are going to deduct on 17th of August. Next one. Next one is first what is happening? First credit is happening, then payment is happening. So now again you will deduct TDS on credit, and if you are deducting TDS on credit, you will deduct on what? Excluding the GST portion. So now you will deduct TDS on 14th of Feb on 10,50,000, 0.1%. That is 14th of Feb, 10 lakh 0.1% will come to 1050. I hope everybody understood the question number 1. Okay. I hope it is clear to all of you. Now coming to question number 2. Is car accessories required to collect tax at source in respect of the sale transaction with Mr. Subhash? Now, who is car accessories? Car accessories is the seller. Subhash is the buyer. Now, is car accessories liable to collect TCS? See, if the buyer is not liable to deduct TDS now, then the seller is liable to collect TCS. Between 194Q and 2061H, the priority has to be given to 194Q. But if the buyer is not liable to deduct TDS, then the seller is liable to collect TCS. And remember, the seller is also liable to collect TCS under section 2061H subject to some condition. First condition, the last year business turnover of the seller has to be more than 10 crore. Now see, what is the last year turnover of the seller? It is more than 10 crore, that is 15 crore. Second, the seller will also collect TCS on an amount of sale in excess of 50 lakh rupees. Okay. So if the sale is more than 50 lakhs, the seller will collect TCS. But the most important point, in this section, the seller will always collect TCS on receipt basis. First of all, there is no concept of debit or receipt, whichever is earlier, for 206C subsection 1H. And one more thing, in this section, the seller will collect TCS always on including GST portion. In TCS, there is no relaxation of GST. In TCS, you have to collect TCS always on including GST portion. So now, is the Subhash liable to deduct collect TCS? Is the seller? Who is the seller? The car accessories and company, are they liable to collect TCS? That's what the question is asking. They are liable to collect TCS if the buyer is not deducting TDS. So they are liable to collect TCS only on the first transaction. Check please. Which transaction? First transaction. Can you see this? On the first transaction, the amount including GST is it crossing what? Is it crossing 50 lakh rupees? The answer is yes. Now, because on the first transaction, the amount is exceeding 50 lakh rupees, but buyer is not deducting TDS, because for buyer we have to see excluding GST, and excluding GST it was below 50 lakhs. But for seller we have to see including GST. For seller it is what? Including GST. Therefore the seller will collect TCS in the first transaction, because the buyer has not deducted TDS in the first transaction. I hope it is clear to all of you. On how much amount? He will also collect 0.1% on excess of 50 lakhs. So seller will collect 0.1% on what basis? On receipt basis. That is the date on which the payment is made to you. On that date you will collect 0.1% on 3,10,000. That will come to 310 rupees. I hope everyone is clear with this particular question. It's a beautiful question. The very first question is a dynamite. The very first question put in this particular case scenario will explain you the level of MCQs that ICI is trying to put in your examination. Okay. Now question number 3. Assume that Mr. Subhash has started the retail business of car spare parts in May 23. It means this is the first year of Subhash. In such case, would the answer to MCQ1 and MCQ be different? If yes, what would be the answer of MCQ1 and MCQ2? See, for example, if Subhash, this is the first year, then Subhash will not deduct TDS. Okay. Subhash will not deduct TDS. Therefore, the answer to MCQ1 will go to answer to MCQ1 will be point number 4. Are you clear? Because if this is your first year of business, then last year business turnover is 0. Therefore, buyer is not liable to deduct TDS. Okay. But then the seller will be liable to collect TCS on all the transactions. I hope it is clear to all of you. The seller will be liable to collect TCS on 5310. That is on 3,10,000. When? On the date of payment. Okay. So now the seller will be liable to collect TCS on 3,10,000 on this date, on 17,10,000 on this date, on 2537 on this date, and on 1239 on 28th of Feb. Therefore, the answer to seller will be what? The answer to seller will be becoming B. B, that is the second one, and the answer to buyer will be becoming D. That is D. That is D means the fourth point. Okay. I hope it is clear to all of you. So for seller, the answer will become this. The seller will collect TCS on 2nd June, on 30th June, on 17th August, and on 20th Feb. That is on the date of receipt, date of receipt, date of receipt, date of receipt. Because in 2061H, you have to collect TCS on receipt basis, and receipt basis only. Okay. Now question number 4. Let's go ahead with the next question. Are the provisions of tax deduction and collection at source attracted in respect of the transaction with carparts.com? If yes, who has to collect or deduct tax at source and at what rate? See, Mr. Subhash is also buying something through an e-commerce operator. You can check over here. How much they have bought through an e-commerce operator? They have bought of around 12 lakh rupees through an e-commerce operator. Okay. Now. The e-commerce operator, suppose if I am buying, I am a buyer, you are a seller, and there is an e-commerce operator like Amazon. If I am not directly buying from you, but I am buying through an Amazon, then the TDS responsibility is of the Amazon. It is neither me nor yours. I am not supposed to deduct TDS, nor you are supposed to collect TCS. It is the responsibility of the e-commerce operator to deduct TDS on that amount. Now, generally, the TDS will be deducted on excluding GST, but in this case they are not showing GST separately in the invoice. Now, because they are not showing GST separately in the invoice, the e-commerce operator is under an obligation to deduct deduct TDS on the entire amount of 12 lakh rupees. Okay. So now the car part accessory will deduct TDS on entire 12 lakh rupees 1%. Okay. So the car parts is required to deduct tax at 1% on entire 12 lakh rupees. If the portion of GST was given separately in the invoice, then the TDS would have been deducted on excluding the GST portion. Okay. Next question and the last question. Mr. Subhash has not furnished his PAN but has furnished his Aadhar number. What would be the rate for the purpose of MCQ2? So if Mr. Subhash, who is Subhash? Subhash is a buyer. Buyer is not furnishing PAN but is furnishing Aadhar. It's okay. Even if he furnishes Aadhar, that is fine. But because generally if the buyer does not give PAN and Aadhar, then under 2061H, the seller is supposed to collect TCS at twice the rate or 1%, whichever is higher. But because instead of PAN he has given Aadhar, that is a sufficient compliance. Therefore, I will deduct TDS at 0.1% only. Check it please. I have given reasoning of each and everything over here. I am saying the reasoning in very detail, and in short you can see the reasoning over here also. It is written. So this is what this first question is all about. I hope this is clear to all of you. Okay. Now let's move on to the next question. Case scenario number 2. There is an Indian company who has invested in multiple companies. As you can see over here, from there they are getting some dividend. They are also paying some interest, which they have taken loan from the bank to invest in the companies. And then there are certain other people also who are mentioned over here. Mr. Akash, Mr. Arav, all these people are there about which we need to answer in this question. Now, what is the first question? I am reading the question. Along with the question, I will also explain you the case study. Don't worry about it. But you guys can do one thing. You can pause the lecture and read the case study once, and then you can listen to my questions. Okay? Because ultimately, you guys need to have the practice of understanding the case. If everything you only listen from me and try to mug up the things in the exam, if new question comes, you will not be able to answer it. Okay. Now, what is the amount of dividend includable in the gross total income of A Limited? How much A Limited will include in its gross total income? First of all, A Limited has received the following dividends. This is received by A Limited in the current year. See, this is received by A Limited in the current year. This is the date of declaration by the company. This is received in the current year. 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 Now, we all know that from dividend, there is only one expense which is allowed. That is interest expense. That too, if it is up to 20% of total dividend. Okay. So therefore, everywhere I'm going to reduce 20% of total dividend, 20% of total dividend, 20% of total dividend. I cannot reduce more than 20% of total dividend. So in first case, it comes to 1,60,000. After reducing 20%. In second case, it comes to 3,20,000. In third case, it comes to 4,80,000. In fourth case, it comes to 2,56,000. Okay. Now, if I make the total of all four of them, then the answer will come to 12,16,000. This is the amount of dividend which is includable in the income of A Limited. I hope it is clear to all of you. Now, the second question is, what is the deduction allowable under ATM to A Limited? Now, listen carefully. The deduction under ATM is whatever dividend is received by the company during the previous year minus, compare with what? The dividend distributed by the company 1 month prior to the due date of filing of return. So how much dividend is earned by the company in the current year? In the current year, the company has earned a dividend of 12,16,000 rupees. Okay, 12 lakh, as we can see over here. But how much dividend has the company given in the current year? In the current year, company has given a dividend. See, interim dividend and final dividend total of 13 lakh rupees is given by the company in the current year before the due date of filing of return. Whatever dividend is distributed by the company 1 month prior to the due date of filing of return, that can be deducted what? From under section ATM under chapter 6A. Now there is one mistake done by the ICI. What ICI has done? ICI has compared this 13 lakhs with the gross dividend. You cannot compare the gross dividend with the dividend distributed. You have to compare the dividend distributed with the net dividend which is included in income from other source. What is the net dividend included under the income from other source? It is 12,16,000. So you have to compare the amount distributed, that is 13 lakhs, with 12,16,000. Now ICI has compared 13 lakhs with the gross dividend. Now obviously gross dividend is more than 13 lakhs, and that is the reason wrongly ICI has taken the answer as 13 lakh rupees over here, which is wrong. The correct answer should be the dividend, net dividend received, which is taxable under IFOS, that is 12,16,000, and the dividend distributed under ATM, that is 13 lakh. Whichever is lower, that should be allowed as deduction. But unfortunately, they have taken this particular thing as their answer, which is wrong. Okay. Now next question. What is the tax liability rounded off of Mr. Akash for AY 24-25 under the provision of Income Tax Act? If he wishes to make maximum tax saving, what is he supposed to do? He wishes to make maximum tax saving. So if anybody says that I wish to save maximum tax saving, then in that case, you have to compute the tax of that person as per both the regimes. That is the new regime as per 115 BSE and the old regime also. I hope it is clear to all of you. Now in this particular case, what we will do? Come here, please. What is the income of Akash? Check here, please. Come here. Mr. Akash and Mr. Arav are two brothers who have invested in shares of A Limited. Both of them were born in India. Now, Akash is employed in India. Akash lives in India only. Therefore, Akash is resident and ordinary resident. For him, world income is taxable. Now, what all incomes Akash is earning? First of all, Akash is earning some salary of 1 lakh rupees per month. From where? From a particular company. So, therefore, his salary will come to how much? Akash's salary will come to 12 lakh rupees. From that, he will get 50,000 standard deduction. Therefore, Akash's net salary will be 11 lakh 50,000. Okay. Apart from that, Akash is also earning some dividends. Where dividend is there, you can check over here in this table. The Akash is earning a dividend of 60,000 rupees in the current year, out of which he is paying some interest of 15,000, but he will get only 20% deduction, not more than 20%. Therefore, the net dividend taxable in the hands of Akash will be 48,000. Now, Akash is also earning some dividend of 70,000, but this 70,000 dividend you will not take because this is earned in the next year 24-25 and we are computing income for previous year 23-24. Therefore, this dividend should not be taken in the current year. Therefore, the only dividend which Akash is earning, which is going to come in the current year is 48,000 rupees after the expense of 12,000 rupees. So, this is the income of Akash. Akash is not earning any other income except these two incomes. Therefore, salary is 1150. and dividend after interest expenses 48,000. Now the income, total income of Akash is 1198. Now you are supposed to compute tax as per both the regime, old regime, new regime. Okay, in the old regime 2,50,000, 5 lakhs, 10 lakhs, 15 lakhs. This is how after 10 lakh 30%. And in the new regime you are supposed to compute tax as per the new regime. I hope everybody knows the new regime tax rate. Up to 3 lakh no tax, then for the next 3 lakhs 5%, for the next 3 lakhs 10%, for the next 3 lakhs 15%, for the next 3 lakhs 20%, and after that above 15 lakhs it is 30%. So if I compute this, the answer comes as 93,290 in the new regime, and in the old regime it is 178,720. He wished to make maximum tax saving, therefore he should go as per the new regime, and therefore his answer should be 93,290 rupees. I hope it is clear to all of you. Now the next question, what is the residential status of Mr. Arav for AY 24-25? Let's first of all find out the residential status of Mr. Arav. See, Mr. Arav is a person of Indian origin. Sir, how did you come to know? Because he was born in India, his parents were born in India. Check, both of them were born in India. His parents, grandparents were also born in India. Therefore Arav is definitely person of Indian origin. Now remember, if a person of Indian origin visits India during the previous year for less than 120 days, then he is a non-resident. Now if he visits for 120 days and up to 181 days, then he has to fulfill some criteria. That is, Indian income should be more than what? 15 lakh rupees. Then only his income will be taxable. So where does Arav falls? Arav falls in the second category. That is, he is a person of Indian origin and he comes to India for a visit. See, Arav comes to India for a visit for 4 months. It means for approximately 120 days he comes every year in India. But his Indian income is not exceeding 15 lakh rupees. How, sir? His Indian income is only 14 lakh rupees. He is earning from interest from FD, and dividend income if he is earning 90,000. From that also he is getting 20% deduction of interest. So dividend income is 72,000. His Indian income is only 14 lakh 72,000 rupees. 14 lakh of FD interest and 72,000 of what? Dividend net income after the deduction of interest. Therefore, the income of Arav in India is less than 20 lakhs. So less than 15 lakhs. So a person of Indian origin visiting in India during the previous year for 120 days or more up to 181 days, but his income is less than 15 lakh rupees. Therefore, he is non-resident. Therefore, the residential status of Arav is what? Non-resident in this question. Now, the next question is also dependent on the previous question. Now, we need to find out the tax liability of Arav also. And Arav also wish to make maximum tax saving. That is, therefore, for Arav also you will compute what? Both the regime, old regime and new regime. Now, in the previous question itself also, I have told you only 2 incomes will be taxable in case of Arav in India. One, interest which is earned on FD. Second, dividend income, and on that dividend income he will not get any deduction in India. Why? Because for non-resident you don't get any deduction in India. Remember that 20% deduction is not available to non-residents. That 20% deduction is only available to residents. Non-resident dividend income is charged where? Non-residents dividend income is charged under 115A. Therefore this 90,000 will be directly taxable at what? 20%. Therefore this 90,000 will be directly taxable at 20%, 18,000, and on balance 14 lakh rupees you can apply old regime and new regime and then find whichever is more beneficial. In this question, the beneficial provision is again the new regime. Therefore, Arav will also go as per what? New regime only. I hope it is clear to all of you. Apart from this, Arav is also earning some other income in his country. He is a partner in a firm. We should not be interested in that. If a non-resident is earning some income outside India, then that income should not be what? Taxable in India. I hope it is clear to all of you. Is it clear? So let's move on to the next case scenario, that is case scenario number 3, which is on tonnage taxation. Very unorthodox topic on which the case scenario has been put over here. So there is a BMT shipping company, which is an Indian company, which is having 2 qualifying ships. The weight of the first ship is 33,840 and 230 kg, and the weight of the second ship is 24,952 tons and 370 kg. And the ship is operating for 212 days and 347 days, and then they have given us some other data. Okay, now what would be the tonnage income of BMT shipping company computed under 115 VG for AY 24-25? Now listen carefully. Let's compute the tonnage income of each and every ship individually. Let's compute for the first ship. What is the weight of the first ship? It is 33,840. Now the tonnage income which is given under the income tax law, it is a daily tonnage income. Whatever is the tonnage income, that you have to multiply by number of days the ship was operating. So in first case, whatever the answer will come, we have to multiply that by 212 days, and in second case we need to multiply by 347 days. Now in first case, the weight of the vehicle vessel is 33,840 ton and it is 230 kg. So for up to 25,000 ton, there is a flat amount. How much it is? For up to 25,000 ton, it is flat 11,770, as you can check over here. So for first 25,000, it is flat 11,770 rupees for per day. It is a per day data. After that, for every 100 ton, it is 29 rupees. So after that, how many tons are there? After 33,000, how many tons are there? After 33,000, there are 8,840 ton, 8,840 ton and 230 kg. Okay. So the law says that if this particular amount, this ton is more than 50, then you have to round off to the next digit, next 100. But if it is less than 50, then you have to round off to the previous 100. So because 8,840 is less than 50, then we have to round off to the previous 100. Therefore, this will become 8,800. Okay. Now 8,800 divided by 100 will give me the total ton. So the total ton is 88. So after 25,000 kg, for every ton, it is how much? It is 29 rupees. So after that, for every ton it is 29. So I will multiply 88 into 29 rupees. Therefore, the answer will come to whatever the answer will come, that I will multiply by what? 212 days. Because whatever answer I will get, that will be the per day data. I have to multiply that with what? 212 days. That will give me the answer for the first ship. Similarly, for the second ship, we need to check the weight of the second ship first. It is 24,952. Therefore, how you will round off this? Because it is 24,952. 952 is more than 50. Therefore, you will make this as what? 24,952 will become what? Directly 25,000. Okay. So how will you compute this? In this case, the slab rate changes. For the first 10,000 kg, you can open the tonnage taxation chapter and see what I am trying to say. For the first 10,000 kg, it is 5470 flat, and after that it is 42 rupees for every 100 ton. So it is 42 rupees for every 100 ton. So you will multiply that, and then you will multiply by 347 days, and then you will get this answer. The total of both of them will be 71,20,454, and that is the correct answer. I hope it is clear to all of you. Second question, what would be the written down value as on 1/4/2023 of the qualifying ship of BMT Shipping Company for tax purpose? We need to see for tax purpose what is the written down value of the BMT Shipping Company. Okay, now let's check over here the written down value. As per books, it is given. As per books, for the first ship, which is a qualifying ship, it is 580. For the second ship, it is 270. And for the third ship, it is what? 230. Now what I'm doing, for the purpose of tax, it is 1200 for all three ships. So for all three ships, it is 1200. For all three ships, it is 1200. Okay, as per tax. And as per accounts, for all three ships, it is 1080. Okay. So as per accounts, for two ship, it is how much? For two ship, as per accounts, it is how much? 850. So if I cross multiply, I will get the proportionate amount of the tax also. See, it is very simple now. 1200 is the WDV of the block of asset for all the three ships, and 1080 is the accounting value of all the three assets, and 850 is the accounting value of what? Accounting value of the qualifying ship. So I will cross multiply. I will get the proportionate amount which should be considered as a WDV of the block of the qualifying ship. Therefore, this will be the answer, that is 944.44. Therefore, the answer is 1200 into 850, 1200 into 850, that is 1200 into 850 divided by 1080, that will come to 944.44. That is the proportionate answer that we can put over here. Okay. Now the next, the minimum reserve requirement as per 115 VT. Remember, if you want to take the benefit of this chapter, tonnage taxation, then you have to transfer 20% of your book profit to reserves. Which reserve? Tonnage taxation reserve. What is the book profit of the company? The book profit of the company, it is given in this particular point. You can check, it is 100 rupees. Now suppose the book profit is 100, you have to transfer at least 20 rupees, that is 20 lakh rupees to what? Tonnage taxation reserve. Only then you can take the benefit of this particular section. Okay. Therefore, the answer to this question is what? It is 20 lakhs. Okay. I hope it is clear to all of you. Next question. Would any amount be taxable under any other provision of the Income Tax Act as per the provisions of 115 VT subsection 5? If BMT Shipping Company had transferred 15 lakhs to tonnage tax reserve account during the previous year 23-24? If yes, what is the amount so taxable? Now listen carefully. The company has to transfer how much amount? The company has to transfer 20 lakhs. But the company has transferred how much? Company has transferred only 15 lakhs. So company has fulfilled the commitment to the extent of, say, I can say 75%. You are supposed to transfer 20 lakhs. You have transferred only 15 lakhs. So you are fulfilling your commitment to the extent of 75%. So how much you are not fulfilling? You are not fulfilling the commitment to the extent of how much? 25%. Because out of 20, you are not transferring 5 lakhs. Therefore, 25%, which is not transferred. Out of 20, 15 lakh is transferred, 5 is not transferred, 25 commitment is not done. Therefore, 25% of your profits will be subject to tax now. Now, what is your profit? Profit from core activity, it is 70 lakhs. Profit from incidental activity, it is 14 lakhs. Therefore, the total profit is 84 lakhs. You have not fulfilled the commitment 100%. Only 75% is fulfilled. Therefore, 25% of 84 lakhs will be taxable in your hands, and therefore your answer will come to how much? It will come to 21 lakhs. Check it, please. This is your answer. I hope it is clear to all of you. Okay. And one last question is on section 44B. This question has nothing to do with tonnage taxation. This is absolutely an independent question. So there is an element shipping company whose gross receipt is 630 lakhs. Now we need to say how much income is taxable in India. See, if the ship is leaving India, then the entire amount is taxable in India. 7.5% of that amount will be taxable in India. So the goods shipped at port in India, this will be fully taxable. In this case, you don't have to see whether the money is received in India or whether the money is received outside India. Both will be taxable. Okay. But if the goods are shipped outside India, then only that much amount will be taxable, which is received in India. If the goods are shipped outside India and the money is also received in India, then it is not taxable. Therefore, this 180 lakhs will also be taxable at 7.5%. If you take the last one, will not be taxable because the goods are shipped outside India and the money is also outside India, received outside India. Therefore, last one will not be taxable. The first three will be taxable. And if I take the answer of first three, it will come to 39.75 lakhs. That is 530 lakhs into 7.5%. The answer will come to 39.75 lakhs. I hope it is clear to all of you. So let's move on to the next case scenario, that is case scenario number 4. Now what is happening in this particular question? Let's see which of the following statement is correct in respect of loan of 10 lakhs obtained by Mr. Rajat from XYZ Private Limited. Now listen what is happening in case of Rajat. Mr. Rajat is holding some 20% stake in a closely held company, and from that closely held company he is taking a loan of 10 lakh, but the reserves of that company is only 8 lakh rupees. So remember, if a shareholders hold not less than 10% of the voting power of a closely held company, and if that closely held company gives you a loan, then that becomes your deemed dividend. Okay. But the deemed dividend cannot be more than the accumulated profits. Therefore, the loan is 10 lakh, but the accumulated profit is only 8 lakh. Therefore, 8 lakh will be taxable as deemed dividend in the hands of Mr. Rajat under section what? 2 clause 22 subclause E. Okay, I hope it is clear to all of you. Now, would cash withdrawal by Mr. Rajat during the previous year 23-24 attract deduction of tax at source? Now Rajat is withdrawing cash from 2 banks. Let's check over here from which bank Rajat is withdrawing cash. Okay, now Rajat is withdrawing cash from 2 banks. Let's see which 2 banks he is withdrawing cash. First, he is withdrawing 1.2 crore rupees from a current account in ABC Bank. Therefore, this bank will, and Rajat has been regularly filing his return. Please be very careful. So, if a person is regularly filing his return, then his TDS should not be deducted under 194N up to 1 crore withdrawal. So, Mr. Rajat is withdrawing 1.2 crore. Then, therefore, the ABC Bank will deduct TDS on 20 lakh rupees. That is in excess of 1 crore rupees at 2%. Mr. Rajat is also withdrawing 50 lakhs from Cooperative Bank. So in this case, Mr. Rajat will not be liable for TDS. Okay, there will not be any TDS because the withdrawal is less than what? Less than 1 crore rupees. Therefore, the TDS is only applicable in case of ABC Bank on excess of 1 crore rupees. 2%. Okay. Would cash withdrawal by Mr. Rahul during the previous year 23-24 attract deduction of tax at source? Now let's check what Mr. Rahul has been doing. Mr. Rahul is not filing the return for the last 5 years and he is withdrawing 50 lakh rupees from the Cooperative Bank. Now remember, if you have not filed the return for the last 3 years, then your TDS limit is lower than about 20 lakhs. Up to 1 crore withdrawal, it is 2%, and above 1 crore, it is 5%. Now, Mr. Rahul is not filing the return. Therefore, the bank will deduct TDS in excess of 20 lakh rupees. Therefore, excess of 20 lakhs is how much? 30 lakhs. On 30 lakhs, bank will deduct 2%. And therefore, in case of Rahul, the TDS will be 2% on 30 lakh rupees because he is not filing the return for the last 3 years. Okay. What is the total income of Mr. Rajat? Assuming that he has shifted out of the default regime, Rajat doesn't want to come under the default regime. He wants to go under the old regime. What will be his total income? Let's check his total income, which all income he has earned. First of all, he has earned a profit of 60 lakh rupees check from a diamond business. Okay. So first of all, I will write over here 60 lakh rupees from diamond business. Okay. Apart from that, he has also taken some house property loan for self-occupied house, on which the total interest is 2,50,000, out of which he has paid only 1,80,000. Therefore, he will get deduction of 2 lakh rupees. Sir, but he has paid only 1,80,000. Why will he get 2 lakh rupees deduction? Because under house property, you get deduction on accrual basis, not on payment basis. Therefore, even though the interest paid is 1,80,000, he will get deduction of entire 2 lakh rupees. He will not get more than 2 lakhs because in SOP you cannot get deduction of more than 2 lakh rupees. Okay. Plus he will get the deduction of 2 lakh rupees house property loss only because he is following the old regime. If he follows the new regime, he will not get this deduction also. Okay. Apart from that, Mr. Rajat is also receiving some gift of 5 lakh rupees. You can check it over here from his friend. Some jewelry he is receiving from his friend of 5 lakh rupees. That will also be part of Mr. Rajat's income. Apart from that, I have already told you, Mr. Rajat is also receiving deemed dividend of 8 lakh rupees from a closely held company. Apart from that, Mr. Rajat is also receiving in the third line, he is receiving some actual dividend of 12 lakhs from a particular company. So that is also the income of Mr. Rajat. I hope it is clear to all of you. Therefore, the total income of Mr. Rajat is 83 lakh rupees. Now, what is the tax liability of Mr. Rajat? Assuming that again he shifted out of the default regime and he pays tax under the old regime. Okay. So under old regime, what is the slab rate? Up to 2,50,000 there is no tax. Above 2,50,000 up to 5 lakh it is 5%. Above 5 lakh up to 10 lakh it is 20%. And above 10 lakh it is what? It is 30%. But whatever tax you will compute, you also have to apply 10% surcharge on that because Rajat's income is more than what? 50 lakh rupees. Therefore surcharge will be applicable. On that 4% cess will also be applicable. Therefore the answer will come to 26,34,060 rupees. I hope it is clear to all of you. So let's move on to the next case scenario. That is case scenario number 5. What is happening in this case? Question number 1. I am reading, what is the amount of income chargeable to tax in the hands of Mr. Hari in respect of transaction of sale of building to Mr. Rajesh? And under which head it is taxable? First of all, what is Hari doing? Hari is a property dealer. Okay. Now he is selling a property. So if a property dealer is selling a property, it will be taxable obviously under business income. Correct? There is no second thought about it. And if a property dealer is selling property, then the provisions of 43CA is applicable, 50C will not be applicable. Okay. Now we need to see the consideration for which he is selling the property. Now he sold the property to his friend for 100 lakh rupees on 1/1/2024. On that date, the stamp duty value was 120 lakhs. But when the agreement was done 3 months back. That is in September 2023. At that time, the value was 110 lakhs. See, if the date of agreement and the date of transfer does not match, you can take the value, stamp duty value of date of agreement, but the condition is you should receive an advance on or before the date of agreement, and it should be received by the 4 modes: account pay check, account pay draft, ECS, and such other electronic mode. Now, listen carefully. This is a very critical point. This is applicable under 50C also, under 43CA also, under 56(2)(10) also. So, Hari is selling the property on 1st of Jan, but agreement was done on 1st of September. Which stamp duty value shall I consider? You should consider stamp duty value as 110 lakhs. Why? Because you have received 15 lakhs on the date of agreement and you have received the 15 lakhs by the prescribed mode, that is NEFT. Therefore, you can take the value as 110 lakhs. 120 lakhs should not be taken. And now if you compare the sale consideration 100 lakhs with stamp duty value 110 lakhs, the difference between the two is not more than 110%. It is exactly 100%. Therefore, because the difference is not more than 110%, you will take the selling price as what? As 100 lakhs. Therefore, 100 lakhs is the selling price and Hari has purchased this building for 50 lakh rupees. Therefore, 50 lakh is the cost and therefore 50 lakhs will be considered as business income. Do you understand why I am not applying 110% provision? Because the difference is not more than 110%. If you want to apply the stamp duty value, the difference has to be more than 110%. Okay. So in this question, it is not there. Is any amount taxable in the hands of Mr. Rajesh in respect of transaction of purchase of building from Hari? If so, what is the amount and under which head? Rajesh will also not be liable for income from other source. Income from other source is applicable when the difference is more than 110% and at the same time the difference is more than 50,000 rupees. Yes, the difference is more than 50,000 rupees. 100 lakhs, 110 lakhs, the difference is more than 50,000. But the difference is not more than 110%. Therefore, Mr. Rajesh is also not liable for what? Income from other source under section 56 subsection 2 clause 10. Okay, I hope it is clear to all of you. Third question, what is the amount of income chargeable to tax in the hands of Mr. Ravi in respect of transaction of sale of residential house property to Mr. Valish and under which head it is taxable? Let's see what Ravi is doing. Ravi, where is Ravi? Yes, Hari's brother Ravi is a retail trader. He is not a trader in property. Now he is selling his house. So therefore for him, section 50C will applicable. For Hari, 43CA was applicable because Hari was dealer in property. For Hari, property was stock in trade. But for Ravi, the property is not a stock in trade. The property is a capital asset. Therefore he is selling the property for 50 lakh rupees to Mr. Valish. Now on the date on which he sold the property, on that date, the stamp duty value was 70 lakhs. But on the date of agreement, the stamp duty value was what? 55 lakhs. Which stamp duty value I can can take. Can I take the stamp duty value on the date of 50 on the date of agreement? Yes, you can take, but the payment should be received by 4 modes on or before the date of agreement. Here you made a mistake that you received the payment by what? Cross check. Cross check is not covered in the 4 modes. You should receive by account pay check, account pay draft, ECS or such other electronic mode. Cross check is not sufficient enough. Therefore, you are violating the provisions of section 50C. Therefore, you will not take 55 lakhs as your sale consideration. You will take what? You will take 70 lakhs as your stamp duty value, and your sale consideration is 50 lakhs. Your 70 lakhs is your stamp duty value. Therefore, you will take the 50C stamp duty value as what? FBC as 70 lakh rupees. And what is the price at which you have purchased this property? You have purchased this property for how much? You have purchased this property for 32 lakhs rupees around a year back on 17th of August 2022. Therefore, sale consideration is 70 lakhs. Cost of acquisition is 32 lakhs. You are selling the property within 24 months. Therefore, 32 lakhs will be short-term capital gain. What will be the income from other source in the hands of Mr. Valish? The income from other source, Mr. Valish is buying at 50 lakhs, whereas the stamp duty value is 70 lakhs. Therefore, the differential amount of 20 lakhs will be income from other source in the hands of Mr. Valish. The reason is because the difference is greater than 50,000. There is second reason, the difference is greater than 110%. And the third reason, Mr. Valish is not a dealer in property. This is not bought by him in the capacity of stock in trade. This is bought by him in the capacity of capital asset. Therefore, it is taxable. Remember, under 56(2)(10), gift tax is applicable only if you buy the asset in the capacity of capital asset, not in the capacity of stock in trade. And last but not least, is Mr. Valish and Rajesh liable to deduct TDS? Yes, both of them are liable to deduct TDS because the consideration or the stamp duty value in both the case, whether it is Mr. Rajesh who is buying the property in the first case or Mr. Valish who is buying the property in the second case, in both the case, the consideration or stamp duty, either of them is either 50 lakh rupees or more. Therefore, 1% TDS will be applicable under 194 IA. I hope it is clear to all of you. You can check it once. Now let's move on to the next question. The next question is a beautiful question. There are 4 companies: A Limited, B Limited, C Limited, D Limited. We need to answer a few questions based on all the companies. Okay. First, what would be the tax liability of B Limited for AY 24-25 if it avails the beneficial tax rates under the special provisions of 115BAA, 115BAB as the case may be by fulfilling the conditions specified therein? Assume that the gross total income reflects the computation under the special provision. So for B Limited, we need to find out what will be the tax liability of B Limited, assuming that B Limited is following the special provision. First of all, we need to find out which special provision is applicable in case of B Limited. See, B Limited is setting up in November 2023. So any company who is set up from 1st October 2019 to 31st March 2024, this is the date to set up and commence the business. And if it is doing manufacturing, then it is eligible for 115BAB 15% special rate. Okay. In some cases, it is 15% for manufacturing business. For other incomes, it is 22%. So this assessee is eligible for 115BAB. Now we need to compute the total income of this assessee. The gross total income is directly given as 2.8 crore rupees. But there is one benefit which this assessee will get is the employment given to the new employees. They will be eligible for 80JJAA. Remember, assessee covered under 115BAB are not eligible for any chapter 6 deduction, but they will be eligible for 80JJAA. 80JJAA is allowed. Okay. Now 80JJAA will be allowed to the first category of employees because the emoluments has to be up to 25,000 rupees. If the emoluments is more than 25,000 rupees, 80JJAA will not be allowed. Secondly, because the assessee is engaged in the business of apparel, generally if you want deduction of 80JJAA, you should do an employment for an employee for at least 240 days in the previous year. But for apparel business, leather business, and one more business is there, footwear business, apparel business, leather business and footwear business, even if the employment is done for 150 days, that is sufficient enough. So in this case, second employee will not get, in case of second employee, you will not get the deduction, but in case of first employee, you will definitely get. So 500 employees into 24,000 per month into from when you have employed on the date of what? On the date of setting up of the company, that is from November. So if you count from November till March, it comes to how much? It comes to somewhere around 151, 152 days, which is more than 150. So that is sufficient enough. You will get the deduction for these employees. So 24,000 into 500 into 5 months. Okay. So that is the deduction that you're going to get over here. So therefore, what is your total income? 2 crore 80 lakhs is your gross total income, and your deduction under 80JJAA is 1 crore 80 lakhs. And therefore, your total income will come to how much? 1 crore. Now, what is the tax liability under 115BAB? It is 15% tax plus 10% flat surcharge to everybody and 4% cess. Therefore, the answer will come to 17,16,000. I hope it is clear to all of you. Let's move on to the second question now. What would be the tax liability of A Limited? if it avails the beneficial tax rates under the special provision of 115BAA and BAB. Now, A Limited is eligible for which section? See, A Limited was set up in 1st September 2019. So it is set up before 1st October 2019. Therefore, it is not eligible for 115BAB, but it is definitely eligible for 115BAA. Therefore, what is the gross total income of A Limited? It is 4.9 crore. So therefore, the gross total income of A Limited will be 4.9 crore. Will they get 80JJAA? They will not get 80JAA. Why? Because they were set up in 2019-20, and in 1920 they have already what? They have already employed the employees in 1920, and 80JJAA is available for only 3 years, 1920, 2021 and 22-23, and we are computing tax for which year? For 23-24. Therefore, for A Limited, 80JJAA will not be available. 4.9 crore will be taxable directly at what? 22% tax, 10% surcharge, 4% cess. Check it please. That is coming to 25.168%. That will be, this is the amount of tax that A Limited has to pay as per the special provisions of 115BAA. BAB is not applicable to A Limited. Okay, reason I have told you. Now the third question, what would be the total income of A and B if they do not opt for special provision but they opt for the normal provision? Now what difference will it make? The difference it will make is they will be eligible for additional depreciation. That's it. That's the only difference that will make, because if they opt for the special provision of 115BAA and BAB, then they are not eligible for additional depreciation. But they do not opt for special provision, then they are eligible for what? Special depreciation under section 32 subsection 1 clause 2A. That is the additional depreciation. In that also, let's see the value of plant and machinery purchased by them. The value of plant and machinery purchased on the date of setting up. Now, A Limited will not get any additional depreciation in the current year, because they would have got additional depreciation in 1920, because additional depreciation is available in the year of purchase. Okay. Now, A Limited will not get any additional depreciation, but yes, B will definitely get additional depreciation because they are purchasing in the year of 23-24. So they will get 4 crore rupees into only 10%, not 20%. Why? Because the asset is put to use for less than 180 days. Okay. So on 4 crores, 10% comes to how much? It comes to 40 lakh rupees. Okay. So for B Limited, the income will change from 1 crore to 60 lakh rupees. But for A Limited, the income will remain at how much? 4 crore 90 lakh, because in A Limited, there is no additional depreciation in the current year. For B Limited, the income will drop down to how much? 60 lakhs from 1 crore because of the additional depreciation. Next one. Question number 4. What would be the quantum of penalty payable by C Limited? How much penalty C Limited has to pay under section 270A, assuming that the underreporting is not due to misreporting. So because it is not misreporting, the penalty will be only 50%, not 200%. If it would have been misreporting, then it would have been 200%. So here it is not misreporting, it is underreporting, therefore 50%. And none of the additions made qualifies under section 270A6. Assume that C has not opted for the special provision under 115BAA and BAB. They are not opting for special provision. So let's see what will be the tax rate of C. The tax rate of C will be, this is C, and the C's last to last year turnover C, it is more than 400 crore. So if C opts for the normal provision of tax, then we need to check the turnover of the last to last year for the domestic company. So the last to last year turnover is 409 crore. Therefore, C will be liable for 30% tax. Okay. Now we will compute the penalty of C. What is the penalty of C? The return income assessed as per the AO is 20 lakhs and the income processed as per the return is 16 lakhs. Therefore, the difference amount between the income assessed minus the income processed will be under reported income, and on this much amount the company has to pay tax of 30%, and the company also has to pay surcharge of 12% because the income is more than 10 crore, and the company also has to pay cess of 4%. Okay, so on this much amount you have to compute tax on underreported income plus process minus tax on process. On that, first you will compute tax on 20 crore, you will apply 12% surcharge because the income is more than 10 crore, and then you will compute tax on 16 crores, you will again apply 12% surcharge because the income is more than 10 crore. Then you will take the differential amount, and whatever amount will come, you will take 50% tax of penalty of that because it is not a case of misreporting. Last question over here is, what would be the quantum of penalty payable by D Limited under section 270A, assuming that it is misreporting? If it is misreporting, then the penalty will be definitely 200%. Assuming that again D has not opted for special provision, even D wants to go for the general provision. So let's find out the tax rate of D. The last to last turnover of D is 250 crore. Therefore, D will be liable for tax of only 25% because the last to last year turnover is not exceeding how much? It is not exceeding 400 crore. Therefore, only 25% will be the tax rate. How much will be the penalty? Income assessed 22 crore. Income processed 20 crore. Differential amount 2 crore. On 2 crore, the D Limited will be liable for 25% tax, 12% surcharge because the income is more than 10 crore and 4% cess. Whatever answer will come on that, they will take 200% penalty, and therefore the answer should come to 1 crore 16 lakhs 448,000 rupees. I hope it is clear to all of you. So let's move on to the next question. That is question number 7, which is a very, very beautiful question on business trust. There is a business trust which is registered under SEBI, and the business trust is earning the following incomes. First, the business trust is earning 10 lakh rupees from Z Limited. What is Z Limited? Z Limited is a special purpose vehicle from where the business trust is earning. It is mentioned below. Z Limited is an Indian company in which the business trust holds 100% shareholding and does not pay tax under section 115BAA. Okay. So it's a special purpose vehicle in which the business trust is holding 100% shares. Now, these are the different kind of incomes which the business trust is earning over here. Now, we need to answer the following question. In respect of component of interest income from Z Limited, distributed by business trust to unit holder X and Y. First of all, we will try to find out how many units X is holding, how many units Y is holding, and what is the percentage of their shareholding. Okay. First of all, X is holding 100 units and X is resident, and Y is holding 500 units and Y is non-resident, and the total units held by the business trust is 5,000 units. How many? 5,000. So first of all, we'll try to find out the percentage of their shareholding. So out of 5,000 units, X is holding 100. It means X is only holding how much? 2% of the units of the business trust. Out of 5,000 units, Y is holding 500 units. Therefore, Y is holding how much? 10% of the total units. Okay. I hope it is clear to all of you. So X is holding how much? 2% of the units. Y is holding how much? 10% of the units. Okay. Now let's come to the question. Question number 1. In respect of component of interest income, remember, whatever interest income is earned by business trust from the SPV, it is not taxable in the hands of business trust. It is taxable in the hands of the investor. So how much interest income they are earning from the business trust? 10 lakhs. So out of 10 lakhs, how much will be taxable in the hands of X? 2%. That is 20,000. How much will be taxable in the hands of Y? That is 10%. 10% of 10 lakh is how much? 1 lakh. So 2% will be taxable in the hands of X and 10% will be taxable in the hands of Y. Now we need to also deduct TDS. The business trust will deduct TDS while making the payment or credit of what? The interest income, because it is taxable in the hands of investor. How much TDS? In case of resident, it is 10%. In case of non-resident, it is 5% plus cess, that is 5.2%. Okay. So in case of resident, it is 10%. In case of non-resident, it is 5.2%. I hope it is clear to all of you. Okay. Why we are deducting TDS? Because the interest is taxable in the hands of investor. Therefore, we have to deduct TDS. Okay. Next one. In respect of short-term capital gains of 4 lakh on listed shares and short-term capital gains of 8 lakh on sale of development properties. Now, who will pay tax on this? Remember, if a business trust is earning short-term capital gains under 111A, okay, then it is taxable in the hands of business trust as per 111A provision, that is 15.6%. An investor is not liable to pay tax. But if the business trust is earning other short-term capital gains other than 111A, then business trust will be liable for tax at MMR, maximum marginal rate, which is 42.744%. Okay. So 111A income, business trust will pay tax as per 111A. Other than 111A income, business trust will pay tax as per what? As per MMR. Okay. Now coming to question number 3, the dividend component of income from Z. So I am business trust. I am getting some dividend component. How much dividend I am getting from business trust? From SPV, 5 lakh rupees. So dividend is always exempt in the hands of the business trust. Always. So what about the investor? That depends. That depends upon if the SPV, that is Z Limited, has opted for 115BAA special provision. If they have opted, then it is taxable in the hands of investor. But if they have not opted, then it is exempt. In this question, check, it is not opting for 115BAA. Therefore, dividend is exempt in the hands of the business trust also, and it is exempt in the hands of the investor also. Why it is exempt in the hands of investor? Because the SPV is not opting for 115BAA. Okay. So check. So business trust is exempt, dividend is exempt in the hands of business trust, and it is also exempt in the hands of the unit holders. Okay. Now the next question is a continuation of what I just said you. That is, if Z Limited, that is the SPV, opts for 115BAA, then also business trust is not liable to pay tax, because dividend income is always exempt If it is received from Z Limited, if it is received from SPV, dividend is always exempt in the hands of business trust. Yes, the status will change in the hands of what? The investor. Now investor will be liable to pay tax. X and Y will be liable to pay tax on the dividend portion. In the previous question, they were not liable to pay tax. Next. What about the interest received by business trust from investment in unlisted debenture? This is taxable in the hands of business trust at MMR. Okay. So this will be taxable in the hands of business trust at MMR, and it will be exempt in the hands of the investor. And last but not least, the rental income component. The business trust is earning some rental income from land and building. That is exempt in the hands of business trust, but taxable in the hands of investor. Investor, it is taxable. See, only two incomes are taxable directly in the hands of investor. One is interest from SPV, second is rental income. Rental income is also taxable in the hands of investor. Now, if it is taxable in the hands of investor, is the business trust liable to deduct TDS? The answer is obviously less. How much TDS? For resident, it is 10%. So how much is the total rental income earned by the business trust? It is 20 lakhs. Out of which 2% will be taxable in the hands of X. 2% of 20 lakhs will come to 40,000. So 40,000 X will pay tax, and 10%, that is Y is holding 10% units in the business trust. So for Y, the taxable income will be 2 lakh rupees. So in case of resident, you will deduct TDS at 10%. In case of non-resident, you will deduct TDS at the rates in force. The rate is not mentioned under the income tax law. It will be the rates in force. I hope it is clear to all of you. So let's move on to the next question. That is question number 8, which is absolutely on penalty computation. There is a form, MNO form, which is taxable at 30%, and they have given us some information. Now, MNO is deemed to have underreported its income since, always remember, penalty is imposed on what? Penalty is always imposed on income assessed minus income processed. Always. Penalty is never imposed on income processed minus what is filed under the income tax return. Remember, see on the board, penalty is never imposed on the difference amount from 143.1 to 139.1. Never. Because this amount is not computed by AO. Only penalty is imposed on that amount which is computed by AO. Therefore, the answer to this question will be, penalty will be imposed on the difference of this amount, that is 143.1 and 143.1. Penalty will also be imposed on difference of this amount, that is 143 and 147. So if 143.3 exceeds the income process, penalty is imposed. If 147 exceeds 143.3, then also penalty is imposed, because in both these cases the income escaped is found by the assessing officer. Okay, then only the penalty is imposed. I hope it is clear to all of you. Now, Mr. N is deemed to have underreported his income. Who is Mr. N? Mr. N is a resident partner of that particular firm. Okay, now whether Mr. N will be liable for penalty just because the firm has escaped the income, the answer is no. Because the firm has escaped the income, the partner has nothing to do with that. Okay, check. Mr. N is deemed to have underreported income if he is a partner of the firm. No, because of this reason he cannot be said to be underreported income. Okay, because the partner firm is making mistake, the partner cannot be held responsible. Yes, he can be said to be underreported income because he has not filed the return and his income is exceeding the basic exemption limit. So if I am an individual, if I don't file the return, and if my income is exceeding the basic exemption limit, then I will be liable for penalty. Okay, so this can be the reason, and therefore the reason is 2 and 3. 2 and 3 taking together will be the correct answer of this particular question. Question number 3. Let's come to question number 3. Assuming that underreporting is not on account of misreporting. It is not a misreporting. Therefore, you will be liable for 50% penalty. And none of the additions or disallowances made in assessment qualifies for 270A6. The penalty leviable at the time of assessment. How much penalty will be leviable at the time of assessment? See, how much income is assessed under the assessment, not reassessment, assessment. I'm not talking about assessment. I'm not talking about reassessment. I'm talking about assessment. How much income is assessed in assessment? 65 lakhs. How much income is processed? 50 lakhs. Therefore, the difference between the two will be called as underreported income. And now you compute tax. How to compute tax? Don't compute tax directly on 15 lakhs. Tax on 15 lakhs plus tax on 50 lakhs. That is tax on underreported income plus tax on processed income. And then you compute tax on processed income. And then you compute the tax and take 50% penalty on that. Okay, I hope it is clear to all of you. Similarly, question number 4. Assuming that underreporting is now misreporting. If it is misreporting, 200% penalty will be imposed. Now you need to compute penalty at the time of reassessment. Again, you need to check how much is income reassessed? 85 lakhs. How much is income previously assessed? 65 lakhs. Therefore, the difference between 85 and 65 will be called as underreported income. 20 lakhs will be underreported income. Now, how will you compute tax on that? Directly compute tax, or you can compute in the formula like this also. The answer will come to same only. Okay. So if you compute tax, you will come to 31.2% tax and then take 200% penalty. Answer will come to 1248. Okay. I hope it is clear to all of you. Just pause the lecture and compute it at your end. Obviously, I cannot compute while speaking. Last but not least, last question in this particular case scenario. Assuming that underreporting is not on account of misreporting. Okay, it is not misreporting. and the underreported income of Mr. N. The penalty leviable under 270 would be what? Say Mr. N has not filed the return, okay, and the AO has done best judgment on him, and the income is 15 lakhs. Okay. Now by default you have to compute tax as per what? Tax as per the new regime. Yes. So we are also computing tax as per new regime also only, because by default is the new regime now. We cannot follow the old regime by default. So how tax will be computed? How underreported income will be computed in case of the assessee who has not filed the return? See, if an individual has not filed the return, the underreported income is income assessed 15 lakhs minus the basic exemption limit. Therefore, the underreported income will be 12 lakh rupees. Okay. Now, how to compute tax on that? Don't compute tax directly on 12 lakhs. I used to say in the class also, you will compute tax on underreported income plus basic exemption limit. You compute tax on entire 15 lakhs and then apply cess on that, and then take what? Take 50% of that, because it is not a case of misreporting. So answer will come to what? 78,000. Therefore, the underreported income is 12 lakh rupees and the penalty is 78,000. I hope this question is clear to all of you. Okay. So let's go ahead with the next case scenario. That is case scenario number 9, which is a beautiful case scenario on TDS. Let's read it once. Mr. Shyam, Mr. Sunil and Mr. Sriram, there are 3 brothers who are resident Indians in independent retail trade business of food grains in Pune, Thane and Nagpur. So these 3 brothers have business in 3 different cities. Now their turnover of the last year is 9 crore, 10 crore and 12 crore as the case may be. They regularly purchase food grains from another resident, Mr. Ashwath, a wholesale trader in Mumbai. The turnover of Ashwath is 18 crore for the last year. So these 3 brothers are the buyer and Ashwath is the seller. Okay. Now they all follow mercantile system of accounting. The aggregate amount of credited by the brothers to the account of Mr. Ashwath during each of the financial year 23-24 is shown in the table below. It may be assumed that the entire amount relating to Mr. Ashwath for a particular month is credited to his account on the last day of that month and is paid entirely on the last date of the immediately following month. So whatever we are purchasing in the current month, we are crediting in the books of accounts on the last day of the month and we are paying on the last day of the next month. Okay. Likewise, Mr. Ashwath also debits the amount of Mr. Sunil, Mr. Sriram and Mr. Shyam on the last day of the month with the amount of sales effected during each month. Then you have been given that how much all 3 brothers purchase from Mr. what? Mr. Ashwath. So Mr. Sunil purchase how much? That is the data which is given here. Mr. Sriram purchase how much? That is the data which is given. And Mr. Shyam purchase how much? That is the data which is given. Okay. Now let's talk about the question. Question number 1. Are the TDS provisions under the Income Tax Act attracted in respect of purchase transaction with Mr. Ashwath? If so, in whose hand? At what rate? At what point of time? Multiple questions are asked. First of all, are the TDS provision attracted? If yes, in whose hand? At what rate? At what point? Ignore one-time transaction of Mr. Sunil's friend Mr. Krishna. Now there is a one-time transaction here. We are ignoring that as of now. Now remember, all 3 brothers have a turnover of 9 crore, 10 crore and 12 crore. Obviously, for 194Q to attract, the question is talking about 194Q. Now for 194Q to attract, the last year business turnover has to be greater than 10 crore rupees. Therefore, in case of Mr. Sunil, it is not applicable because the last year turnover is only 9 crore. Even Mr. Sriram, 194Q is not applicable. Again, the last year turnover is not exceeding 10 crore. In case of Mr. Shyam, TDS will be applicable because the last year turnover is 12 crore. Okay. So, in case of Sriram, in case of Shyam, TDS will be applicable. So, when it will be applicable? When the amount crosses 50 lakh rupees. So, when the amount crosses 50 lakhs, the amount crosses 50 lakhs in the month of October. Check please. If you total this plus this plus this plus this plus this plus this, so you will come to know it crosses 50 lakhs in the month of October. So, when it is credited in the books of accounts on the last day of the month and when it is paid on the last day of the next month. So, when the sales purchase is crossing 50 lakhs in October, so it will be credited in the books on 31st of October. Therefore, the TDS will be applicable on 31st of October. Are you clear? So, this is the answer to the first question. Mr. Shyam is liable to deduct TDS at 0.1% on the amount of each purchase after crossing the threshold of 50 lakhs at the time of credit. That is from 31st October 2023. Okay. And the first 2 brothers are not applicable 194Q because they are not having a turnover of more than 10 crore in the last year. I hope it is clear to all of you. Okay. Now let's go to question number 2. Are the provision of TCS applicable under the Income Tax Act attracted in respect of the sale transaction effected by Mr. Ashwath? If so, from whom? Does he has to collect tax? At what rate? At what point? ignore again the one-time transaction of Mr. Sunil's friend, Mr. Krishna. Now, in the first two cases, Mr. Sunil and Mr. Sriram's last year turnover is less than 10 crore, but the seller's last year turnover is more than 10 crore. Correct? So in the first two cases, the seller is liable to collect TCS. Okay? In the first case, Mr. Sham is liable to deduct TDS. In the case of Mr. Sunil and Mr. Sriram, seller is liable to collect TCS. Now, TCS is collected under 206 subsection 1H on receipt basis. So, you need to check when the TCS, when the sale is crossing 50 lakhs. The sale is crossing 50 lakhs here in the month of November for Mr. Sunil, and for Mr. Sriram, it is crossing in the month of October. But TCS is not applicable on accrual basis. TCS under 206C1H is applicable on receipt basis. So when is the receipt happening? So for November, the receipt is happening in December. Therefore, the TCS is applicable in December. For October, the TCS will be applicable in November because the receipt is happening in November. So in case of Mr. Sunil, the TCS will be collected in December. In case of Mr. Sriram, the TCS will be collected in what? In November. Check it please. Question number 2. I hope it is clear to all of you. Okay. I hope it is clear. Now question number 3. What would be the applicable rate of TDS if Mr. Ashwath fails to furnish PAN? So if the buyer does not give PAN, generally if the buyer does not give PAN, the seller has to deduct the TDS at the rate of 20%. But in case of two sections under income tax law, that is 194Q and 194O, if the seller does not give PAN, then in that particular case, you have to deduct TDS at only 5%. These are two exceptional sections where TDS is not deducted at 20%, but it is only deducted at 5%. Okay, this is one amongst them. Similarly, generally, if the TCS, if the PAN is not given by the seller, then in that case, if the PAN is not given by the buyer, then TCS is generally collected at twice the rate or 5%, whichever is higher. If the PAN is not given in case of TCS, TCS is collected at twice the rate or 5%, whichever is higher. But in this case, the TCS will be collected at twice the rate or 1%, whichever is higher. Therefore, in this case, the TCS will be 1%. So in MCQ 1, if PAN is not given, TDS will be 5%. In MCQ 2, the PAN is not given, the TCS will be 1%. Okay. I hope it is clear to all of you. Now, what would be the TDS or TCS implication in respect of single purchase transaction by Mr. Krishna from Mr. Ashwath? Let's see what Mr. Krishna has purchased. Mr. Sunil's friend, Mr. Krishna, who commenced retail business. Now, if you have commenced retail business in the current year, then TDS will not be applicable because your last year turnover is not more than 10 crore rupees. Okay. So 194Q will not be applicable. But yes, is Mr. Ashwath liable to collect TCS? Yes. Mr. Ashwath will be liable to collect TCS. Check. When he will be liable to collect TCS? He will be liable to collect TCS on 2nd of July on 10 lakh rupees. Okay. Because Mr. Ashwath's last year turnover is already more than 10 crore. And Mr. Ashwath is selling to Mr. Sunil, Mr. Krishna, how much? 60 lakh rupees goods. And he is receiving the money on 2nd of July. So on 2nd July, he will collect TCS on 10 lakh rupees. Okay. You can check it please. So on 2nd July, he will collect TCS how much? 10 lakh rupees. He will collect 0.1%. That is the date of receipt. TCS under 206C1H is applicable on receipt basis, not on credit basis. I hope it is clear to all of you. So let's move on to the next question. That is question number 10. Please all of you, case scenario number 10. Mr. B is an interior decorator by profession. Now he also delivers online lectures on interior decoration via e-commerce platform Indeco Academy. So Indeco Academy is working like what? Amazon. Okay. The relevant information from Mr. B's Indeco Academy account is given here under. Date of service to the account of Mr. B, 31st May, 31st October, 31st March. Date of payment to Mr. B, 10th June, 10th October and 10th of April. 2 lakh, 1 lakh 50, 1 lakh 40. In addition to above, Mr. B received 20,000 directly from a student. Instead, through Indeco Academy payment portal. Mr. B has not furnished his PAN or Aadhar to Indeco, but has furnished his driving license for KYC documents. Now, on 5th of May 2023, Mr. B provided interior decorating service to Mr. N in Mumbai, having business turnover of 1.2 crore during the previous year 22-23 for his office premise as well as his residential premise. The consideration for which was rupees 40,000 and 60,000 respectively. Mr. B has provided his PAN details to Mr. N for invoicing purpose. Mr. B's gross receipt from interior decoration profession, excluding fees for online services from the clients in India, including N in total in previous year 23-24 is 40 lakhs, and rest of the things I will read after some time. Okay, I will read after some time when the question is required. Now the question number 1, is Indeco required to deduct tax at source on the amount received or receivable by Mr. B? If so, what is the amount of tax to be deducted? Now remember, suppose if you are purchasing something through Amazon, then if you are purchasing something through Amazon, then Amazon is liable to deduct TDS under 194O, yes or no? Now Amazon is liable to deduct TDS under 194O at the rate of 1%. 1% of the gross amount at the time of credit or at the time of payment, whichever is earlier. Now in this case, how much you have purchased through Amazon? Let's see. Pay attention please. You have purchased 5 lakh rupees, 2 lakh rupees first you have purchased. Okay. Then you have purchased 1 lakh for 50,000 services and then 1 lakh 40,000 services and something which is directly provided but not paid by you. Suppose, if you purchase through Amazon something, but if you pay directly to the seller, then also it is deemed to be credited by Amazon. Do you remember that? If I purchase something through Amazon, but I directly pay to the seller, then that is also deemed to be credited by Amazon, and Amazon is liable to deduct TDS on that also. So this will also come. Now, in this case, the other party, the seller should give PAN or Aadhar, but the seller is not giving PAN, seller is not giving Aadhar, but seller is instead giving what? Driving license. That is not a relevant document under income tax law. Driving license is not a sufficient document. Therefore, under 194O, if the other party, that is the seller, does not give PAN, then I should deduct TDS at 5%, not 20%. So, if I total all the payments, it comes to how much? 5,10,000. I am supposed to deduct TDS at the rate of 5% on 5,10,000, and therefore the answer comes to 25,50,000 rupees. I hope it is clear to all of you. Okay. Second, is Mr. N required to deduct tax at source under 194J? If so, what is the amount of tax to be deducted? Now, is Mr. N an individual? Yes. Is Mr. N's last year business turnover more than 1 crore rupees? Yes. Therefore, Mr. N is liable to deduct TDS under 194J. But, in 194J, we only deduct TDS for business purpose and not for personal purpose. Therefore, he will deduct TDS only for the purpose of what? Only for the purpose of interior decorator services for office premise. He will not deduct TDS for what? Interior decoration services for residential purpose. Because 194J does not cover residential purpose. It only covers office purpose, business purpose. Therefore, Mr. N will not deduct TDS on 40,000. He will deduct TDS only on he will not deduct TDS on 60,000. Sorry. He will deduct TDS only on 40,000 at the rate of 10%. So no TDS on personal purpose, only TDS on official purpose. Therefore, 4,000 will be the TDS. I hope it is clear to all of you. Okay. Next one, is Mr. N required to deduct TDS under 194M? Remember, if you are not liable to deduct TDS under 194N, if you are not liable to deduct TDS under 194J, which Mr. N is not liable to deduct TDS under 194J for personal purpose. So if you do not come under 194J, you may come under 194M, but for coming under 194M, your payment of the entire year or the credit of the entire year should exceed 50 lakh rupees. Now your personal purpose 194J is only how much? It is 60,000 rupees, merely 60,000 rupees. Therefore, even 194M will not be applicable in this case. Is it clear to all of you? I hope it is clear to all of you. So if J is not applicable, then 194M is definitely applicable, provided the limit should cross 50 lakh rupees. Otherwise, 194M is also not applicable in this case. Now, question number 4. What is question number 4? Is Mr. B required to deduct equalization levy on the amount payable to Tumble INC or Doodle INC? If so, what is the amount of levy to be deducted? Now let's see what kind of services Tumble INC and Doodle INC is giving us. Shall we see that? Let's see. Let's see here. Come here. Further, 1,10,000 is payable by B to Tumble INC, Tumble LLC, a social networking website having no office in India. Tumble does not have any office in India. And we are paying 1,05,000 to Doodle INC for giving online advertisement for the purpose of attracting foreign clients. So we are making them payment for online advertisement. This is not sufficient information to deduct equalization levy. Let me read the question ahead. Though Doodle INC, USA has an office in India, the said office is involved in providing designing services, nothing in relation to online advertisement. So therefore, what we are paying? We are paying Doodle INC and we are paying Tumble INC some amount for online advertisement. Do they have a permanent establishment in India? No, they don't have permanent establishment with respect to online advertisement. Therefore, they do not have permanent establishment in India. Are they non-resident? They are non-resident. Are they providing you online advertisement service? Yes, they are providing online advertisement service. Are you making payment of more than 1 lakh rupees? Yes, I am making payment of more than 1 lakh rupees to them, to both of them. Therefore, I am liable to deduct equalization levy at the rate of 6% as per Finance Act 2016. Therefore, in both the case, I am liable to deduct TDS equalization levy how much? 6%. 6% compute, it comes to 6,600 and 6,300. Yes, I am liable to deduct equalization levy of 6% on both the amounts. If I do not deduct, then related consequences will follow. Okay, that is not asked over here, so I am not computing that. Now, what is Mr. B's gross tax liability? Assuming that he opted out of the default regime, it means he is following the old regime. Now, let's see what all incomes Mr. B is earning. First of all, Mr. B is earning some 40 lakh rupees from here. See here. Can you see this? 40 lakh rupees from gross receipts from interior decoration. Okay. Interior decorator profession, he is earning some 40 lakh rupees. So that we will write here. Then after that, he is earning some online income from Indeco Limited. That is from Amazon like company. 5,10,000 he is earning from online company. Okay. 5,10,000, that is the income. Then he is earning some 4 lakh rupees, some more 4 lakh rupees from here also. Check. Let me check. Just a second. See here, he is earning some 4 lakh rupees from here. From a foreign country, he is earning some 3.5 lakh rupees after deducting TDS of 50,000. Check. So 3,50,000 he received after deducting TDS of 50,000 rupees. So he is earning some 4 lakh rupees from there also. So total he is earning how much? Total he is earning 49,10,000 rupees. Okay. Now, if I follow 44 ADA, can he follow 44 ADA? Yes, he can follow 44 ADA. He is doing interior decoration business. Therefore, it is a notified profession under 44 ADA. Therefore, he can follow 44 ADA. If he follows 44 ADA, then his income will be 50% of his gross receipt. 50% of gross receipt comes to how much? 2455. But as per the books of account, his income is how much? His income is 24 lakhs only. Now, in the question, it is written that he does not get his books of accounts audited. If he does not get his books of accounts audited, then he has to show the income as how much? 2455. Yes, if he wants to show the income as 24 lakhs, then he needs to get his books of accounts audited, correct? Because if he needs to show the income lower than 50% also, then audit is mandatory. Maintenance of books of accounts is also mandatory. But he is not doing audit, therefore he has to show the income as per 50% as per 44 ADA, and not on 24,55,000. You are supposed to compute the tax. How much tax will come? It comes to 5,70,960 rupees as per the old regime. Check it, please. Okay. So let's move on to the next case scenario, which is on section 94B, transfer pricing. On 1st of April 2023, UI Limited is an Indian company, borrowed 50 crore rupees, 9.5% rate of interest. So this is UI Limited. It has borrowed 50 crore rupees from MINC, a USA company, thereby increasing its total borrowing to 65 crore. So earlier the borrowing was 15 crore. Now further 50 crore we have taken. Therefore the borrowing has increased to 65 crore. The said loan is guaranteed by HINC. So there is another company, HINC, which is guaranteeing such loan, which is also a US entity. The place of effective management of both MNH has a place of effective management in USA only. The total assets of UI is 180 crore. What is the total assets of UI? The total assets of UI is 180 crore. Now, the UI imported turbo equipment worth 30 crore from HINC. Import duty 4.5 crore on the same was paid by UI Limited. The equipment was sold to T Limited for 40 crore. Normal GP margin of UI Limited in similar uncontrolled transaction is 20%. Let me read the question first. The net profit of UI for the AY 24-25 is 8 crore after debiting interest of 6 crore, out of which 1.25 crore interest pertaining to local borrowing, depreciation of 2.5 crore and income tax of 1.5 crore. Now we need to answer all the questions based on transfer pricing 94B, and transfer pricing method is also applicable in some of the question. Now what is the amount of interest to be allowed in computation of interest in computation of total income of UI Limited for AY 24-25? If for AY 23-24 there was an interest expenditure disallowed to the extent of 4 crore under section 94B. Now pay attention please, all of you. Last year there is an disallowance under 94B of how much? 4 crore rupees. Now in the current year they are asking how much interest will be allowed. Now remember, 94B says very clearly that we will disallow lower of the two. Interest in excess of 30% of EBITDA we will disallow, or the interest paid to associate enterprise, whichever is lower, we will disallow that much. Okay. Interest paid to what? Associate enterprise, or interest in excess of 30% of EBITDA, whichever is lower, we will disallow. Therefore, indirectly, we will allow how much? We will allow up to 30% of EBITDA. We will allow up to 30% of EBITDA, whatever interest is there, we will allow. Above 30% of EBITDA, whatever interest comes, we will disallow that. Okay. Now pay attention, please. It's a very beautiful question. It's a very, very, very beautiful question. You have to pay absolute attention over here. Pay attention, please. First of all, we need to find out whether UI and whether HINC, are they associate enterprise or not? Okay. See, we have taken a total loan of how much? 65 crore rupees. Okay. Out of which UI has given me guarantee. How much guarantee? The said loan is guaranteed by HINC. So we have taken a loan in the current year of 50 crore rupees and the said loan is guaranteed by HINC. So if we are taking a loan of 50 crore rupees, out of 65 crore rupees, 50 crore is guaranteed by HINC. Therefore, HINC and UI Limited are deemed to be associate enterprise because in 92A it is very clearly written, if one entity guarantees at least 10% of the borrowing of the another entity, then both of them are deemed to be associated. By that logic, by that particular fact, both HINC and UI Limited are deemed to be associated. Now, second thing, if I take a loan from third party, MINC is the third party for me. MINC is not my associate. If I take a loan from third party, but it is guaranteed by my associate enterprise, is HINC my associate enterprise? The answer is yes, because HINC is guaranteeing 10% or more of the loan which I have taken. Okay. Therefore, if I take a loan from a third party, that is MINC, and if my associate enterprise guarantees that loan, then that interest will also be subject to what? 94B. Are you clear? Therefore, first we need to prove the fact that the interest which UI is paying to MINC is subject to 94B. Now, is it subject to 94B? The answer is yes. Why the answer is yes? Because I am paying interest to a party, to a third party, obviously to a third party, but the loan is guaranteed by what? My associate enterprise. Okay. Now, how much interest will be allowed? Up to 30% of EBITDA we will allow you. We will not allow you more than 30% of EBITDA. Okay. Let's see the EBITDA. The net profit is 8 crore. The interest is 6 crore. Therefore, you have to add the interest. You have to add the depreciation. You have to add the tax. Therefore, if you add all these things, you will get 18 crore as EBITDA. Now, 18 crore ka 30% take, it comes to 5.4 crore. Up to 5.4 crore we will allow. Okay. We'll allow up to 5.4 crore. Now, how much is the interest paid to the associate enterprise in the current year? So, you have taken a loan from your MINC, how much? 50 crore rupees, 9.5%. So, how much interest you are paying to them? You are paying 50 crore, 9.5%, 4.75 crore you are paying to them. Okay. Therefore, interest for AY 23-24 that can be claimed. How much is allowed in the current year? Up to 30% is EBITDA allowed. 18 crore, 30% comes to 5.4 crore. You can claim up to 5.4 crore. Therefore, how much interest of last year which is disallowed under 94B can be claimed in the current year? Because the law says that whatever interest is disallowed under 94B can be carried forward for 8 years and can be allowed in the subsequent year subject to the limit of 30%. So, if some interest of 4 crore was disallowed in the last year, you can carry forward in the current year. And if it comes within the limit of 30%, you can claim that also. So, listen carefully. It's a tricky question. Huh? What is your EBITDA? EBITDA is 18 crore. How much will be allowed in the current year? Up to 30% we can claim. So, up to 30% means 5.4 we can claim. Now, how much is the interest of the current year? 50 crore, 9.5%. This is the interest of the current year. But how much is allowed in the current year? Up to 5.4 crore we can claim. Therefore, how much we can claim for last year? We can claim 0.65 crore for last year also. Are you clear or not? Because the 30% comes to 5.4 crore and the current year interest to associate enterprise amounts to only 4.75 crore. Therefore, remaining 0.65 crore I can claim for the last year also. Because both of them taking together come within the limit of 5.4 crore. Therefore, how much interest will be allowed to me? 5.4 crore rupees of interest of current year and last year plus 1.25 crore of the current year local borrowing. That will not come under the limit of what? Under the limit of what? 94B. So therefore, the total interest which I will be allowed is 6.65 crore. Check it please. 6.65 crore is the total interest. What is the breakup of that? 5.45 crore includes the interest paid to MINC. It also includes the balance of the last year within the limit of 30%. And 1.25 crore is the interest which you pay for the local borrowing, which you can check over here, out of which 1.25 crore pertains to local borrowing. So that will also be allowed in the current year. The total comes to 6.65 crore. I hope it is clear to all of you. Okay. Coming to question number 2. Question number 2 is a question on resale price method. You are buying something from your associate enterprise and then you are selling. So what is the method to compute transfer pricing in such case? If you buy from associate enterprise and sell to some third party, the first method is you need to find out resale price. At what price you are reselling that? You are reselling that at 40 crore. So first of all, write down that. After that, what is the normal GP margin in that? The normal GP margin is 20%. You have to remove that. The normal GP margin in such transactions, in uncontrolled transaction, is 20%. You have to remove that. After that, you need to remove the purchase related expenses. What is the purchase related expenses? You are paying some import duty of 4.5 crore. You have to remove that. Okay. and then you will get the arm's length price. This should have been your price, 27.5 crore. But what is the price at which you are purchasing? You are purchasing at 30 crore. So what is the extra price that you are paying? You are paying 2.5 crore, and therefore that should be the adjustment which has to be made under question number 2. Because question number 2 asks the transfer pricing adjustment for the arm's length price. Therefore you should add 2.5 crore rupees over here. I hope it is clear to all of you. Is this clear? Now let's come to the next question. If UI Limited repatriated the excess money on 31st March, if UI Limited repatriated the excess money, see, remember whatever is the transfer pricing adjustment which is added, you need to bring back to India within 90 days from the due date of filing of return, correct? If UI Limited repatriated the excess money by 31st of March, what will be the interest income that would be added to its total income for AY 25-26? If SBI's 1 year's marginal rate of lending rate is 11.25% on 1/4/2024 and 10.25% on 1/4/2025, assume that UI suo moto made the primary adjustment and filed its return of income on 30th November. Remember, if you bring the money within 90 days from the due date of filing of return, no interest. But if you don't bring the money within 90 days, you will be charged interest from 30th November itself. From 30th November itself, you will be charged interest, including the 90 days period. And what will be the rate? The rate will be the SBI's marginal cost of lending rate on the first day of the previous year. What is the first day of the previous year? It is 1.14/2024. So whatever is the SBI's marginal cost of lending rate on the first day of the previous year plus 3.25%. So 10.25 plus 3.25%, that comes to 14.5%. So 2 crore 50 lakh rupees is the money which you have not brought within 90 days. You are bringing the money on 31st of March. So if you are bringing the money on 31st of March, you will be charged interest for all the period, including the 90 days period. So it comes to 121 days divided by 365 into 14.5% into 2 crore 50 lakhs. You have to pay this much amount of tax on the interest. Okay. I hope it is clear to all of you. Now, if UI decides not to repatriate the excess money, instead pay additional income tax on the entire income, then what would be the additional income tax? It will be nothing but 2 crore 50 lakhs into 20.9664. How did I get to 20.9664? It is 18% additional tax plus 12% surcharge and 4% cess. You have this option, correct? If you don't want to bring back the money to India, you can pay 18% tax, 14%, 12% surcharge and 4% cess. That comes to 20.9664. Okay. And one last thing. If UI decides to pay additional tax on 15th of March, okay. If UI decides to pay additional tax on 15th of March, then it has to pay interest from 30th November till 15th of March. Are you clear? So it has to pay interest from 13th of November till 15th of March because it is bringing back the money after 90 days. The 90 days expires on when? On 20th Feb. The 90 days expires on 20th Feb. You are bringing the money on 15th of March. Therefore, you have to pay interest including the 90 days period. So here you can see 2 crore 50 lakhs into 14.5% into 105 divided by 365. If you compute from 30th November till 15th of March, it will come to what? 105 days. You can check it. Okay. And the rate of interest obviously will remain same at 14.5%. And the last question. In addition to the fact given in the case scenario, assume that on 23rd of August 2023, UI has entered into an agreement for sale of turbo equipment with Y. So on 23rd August, UI has entered into an agreement with Y. Okay. An Indian company not related to UI. Y Limited has already entered into an agreement on 23rd August 2023 for sale of agreement to K, INC and unrelated party. And Y has also entered into an agreement before that only. So Y and K has already entered into an agreement on 21st August and UI and Y has entered into an agreement 2 days after that on 23rd August. Now Y Limited has already entered into agreement. Okay. Now UI holds 28% of the voting power of K, INC. Now UI and K are what? Are associate enterprise. Now which of the following are associate enterprise or deemed associate enterprise? Obviously UI and K are associate enterprise. Yes or no? Definitely UI and K are associate enterprise. There is no doubt about it. Second, is UI and Y also associate enterprise? The answer is yes. Why? Deemed to be associated. Why? Because if you enter into a transaction with some third party and the third party already has a prior agreement with your associate enterprise. Do you remember that? If I enter into a transaction with a third party and the third party already has a prior agreement with what? With my associate enterprise, then then the third party will also be deemed to be associate enterprise. Yes or no? I hope it is clear to all of you. Therefore, H, K, Y, everybody is what? Deemed to be associated with each other. I hope it is clear to all of you. So here they are applying the concept of what? Deemed associate enterprise. Let me explain you once again. Here, Is UI and K are associated? Definitely they are associated because they have 20% stake. Is UI and Y also associated? Yes. Why UI and Y are associated? Because Y has already entered into a prior agreement with my associate enterprise. Therefore, UI and Y are also associated. And UI and H are already associated, that we already know in this question. UI and H are associated, that we already know in this question. Correct? So this is what this beautiful question is all about. So let's move on to the next question. Question number 12. It's a very simple question, nothing great as such. The amount of income tax that is required to be deducted by a cooperative bank under 194N during the previous year 23-24 in respect of withdrawal made by A and B. Now, how much withdrawal A has made? A has made for withdrawal of 20 lakhs, then 25 lakhs, then 35 lakhs, and then 25 lakhs. And A has been regularly filing his return of income. So if somebody has been regularly filing the return of income, then the threshold for TDS under 194N is 1 crore rupees. So how much is more than 1 crore? 105 lakhs is the total withdrawal. Therefore, on 5 lakh rupees, 2% TDS will be deducted in case of A. Now, B has not been filing his return of income. It is written in the question very clearly. Check. See. B has not filed the return of income for the last 3 years. Now, if for the last 3 years you are not filing the return of income, then what is the threshold? Then the threshold is only 20 lakh rupees. Above 20 lakh rupees up to 1 crore, it is 2%, and above 1 crore, it is 5%. Now, how much B has withdrawn? B has withdrawn total 98 lakhs. So, therefore, above 20 lakhs up to 1 crore, that comes to 78 lakhs. The bank will deduct TDS at the rate of 2%. Are you clear? I hope it is clear to all of you. Okay. So, this is the question on 194N. Next, identify the accounts which are required to be reported in relation to specified financial transaction SFT in the statement of financial transaction by the cooperative bank based on the mentioned facts for previous year 23-24. So which all accounts are required to be reported in SFT? See, in one of the case, one of the client is withdrawing more than 50 lakh rupees or more from the current account. Check please. Who is withdrawing more than 50 lakhs from the current account? Mr. B. So Mr. B's account has to be reported in SFT because it is very clearly written in the provision of SFT that if your customer is withdrawing 50 lakh rupees or more from your current account, then you have to report that in SFT. So the bank has to report Mr. B's transaction in SFT. Okay, this is the first thing. Second transaction which needs to be reported is the credit card bill of 10 lakh rupees or more. See, one of the customer is paying a credit card bill of more than 10 lakh rupees. Check. One of the customer of cooperative bank paid 12 lakh rupees credit card bill out of 15 lakh rupees. See. So if any customer is paying a credit card bill of 10 lakh rupees or more, the bank is liable to report that particular transaction in SFT. So these are the two transactions which are required to be reported in SFT. Apart from that, no other transactions are required to be reported in SFT. Now, what is the amount of penalty leviable under 271FA? Now, first of all, what is 271FA? 271FA is the penalty for not filing the SFT on time. Sir, what is the time limit to file an SFT? The time limit to file an SFT is 31st May. After the financial year ends, financial year 23-24 ended, then by 31st May 2024, you are supposed to file an SFT. If you don't file an SFT by 31st May, then from 1st June onwards, you are liable for a penalty of 500 rupees per day. Up to when? After some days, the government will send you a notice and they will give you some time to file. Even after that, if you don't file, then it is 1000 rupees per day. See what the assessee has done. Assessee was given a notice on 30th September and was told to file by 30th October. Still he did not file. He filed on 25th of November. So till 30th October, he will be liable for, from 1st June till 30th October, he will be liable for 500 rupees penalty. And after that, he will be liable for what? 1000 rupees penalty for 25 days. Check please, 26 days, whatever it is, from 31st October to, from when? From 31st October to 25th of November. So for first 152 days, how did I come to 152 days? From 1st June to 30th October, it comes to 152 days, 500 penalty. And after that, you'll be liable for 1000 rupees penalty. Check it please. I hope it is clear to all of you. And the last question in this particular MCQ, it was a very simple MCQ. Let us assume that on 26th of Feb 2024, as a result of business reorganization of a cooperative bank, the cooperative bank is entering into a reorganization, that is, it is entering into some amalgamation, etc. It is succeeded by another cooperative bank. Assume that the deduction allowable under section 32 is 3,50,000 and the predecessor cooperative bank has incurred an expenditure of 30 lakh rupees in voluntary retirement scheme. So how much deduction will be allowed to the predecessor cooperative bank? Now, for this, you need to apply section 44DB, with section 44DB, which says that the depreciation deduction and the VRS deduction will be allocated between predecessor and successor in what ratio? From 1st April till 1 day prior to the date of amalgamation, it will be given to predecessor. And from date of amalgamation till 31st March, it will be given to the successor. Therefore, both these expenses will be allowed from 1st April till 1 day prior to this, till 25th of December, 25th of Feb to the predecessor. So we need to count from 1st April till 25th of Feb. How many days comes? It comes to 331 days. And the remaining days, that is from 26th of Feb till 31st of March, remaining number of days will be given to what? Successor. Now you have to segregate this into two parts. Okay. What is the depreciation? The depreciation is 3,50,000. Divide this into two parts. 3,50,000 into 331 divided by 366 days. Similarly, VRS also divided into two parts, but VRS is the total VRS 30 lakhs. It is not allowed in one shot, in one time. It is allowed in 5 years. Therefore, how much VRS is allowed in the current year entirely? 30 lakhs divided by 5, that is 6 lakhs. So you have to divide 6 lakhs into this ratio of 331 is to 35. So 6 lakhs into 331 divided by 366 will come to 542, 622. So this and this is the total amount of deduction that will be allowed to the predecessor, and balance amount of deduction will be allowed to whom? Will be allowed to the successor. I hope it is clear to all of you. Okay. So let's move on to the next case study, that is case study number 13, which is again on some transfer pricing, etc. X Private Limited is an Indian company. Y Inc. is a private company incorporated in USA. Okay. And its income is not chargeable to tax in India. Both are promoted by Mr. Aayush, who holds 30% equity share capital and voting power in both X and Y. The balance sheet of X as on 31st March 2024 is given to us. Okay. So there is some fixed asset, there is some paid up capital, loan, etc. Further additional information is given to you. The loan was advanced by Y to X on 1st July in rupee terms and carries 6.5% interest. For borrowers with similar risk profile who are not associated the enterprise of Y, Y advances loan at 4%. X has maintained such information and documents in respect of international transaction as has been prescribed under 92D, but has not reported the transaction as international transaction. X does not make any adjustment to its total income on account of application of provisions of Chapter 10 of the Income Tax Act in return of income. From the information given above, choose the most appropriate answer to the following question. First of all, are X and Y associate enterprise? If so, why? See, X and Y, these are two different companies. One is Indian company, one is foreign company. Now, are both of them associated? Yes, they are associated because of two reasons. Why? First, because Mr. Aayush is a common shareholder. Mr. Aayush holds 30% in X. Mr. Aayush holds 30% in Y. Therefore, X and Y are deemed to be associated. Correct? This is the first reason because of which both of them are associated. Second, now Mr. X has an asset of 1,200 million and Y is giving a loan of 620 million. So if one entity gives loan of at least 51% of the total book value of assets of another entity, then also both of them are deemed to be associated. Correct or not? So if X has a asset of 1,200 million and Y is giving a loan of 620 million, then also both of them are having what? A relationship of 51%. So in that case also both of them are deemed to be associated. So they are associated because of two reasons. Reason number one, that is 30% shareholding. Reason number two, that is because of 51% of the book value of the asset is financed by Y to X. Okay. So this is both the reason because of which both of them are deemed to be associated. Okay. Now question number two, what is the amount of primary adjustment required to be made to the total income of X? Now it is very simple. How much loan is given by Y to X? 620 crore, 620 million. Now 620 million is how much? Let's talk in crores. 620 million is 62 crores. So Y has given a loan of 62 crores to X at a rate of interest of 6.5%. Whereas X takes loan from others at 4%. So when we take loan from others, we take at 4%. But when we take loan from Y, that is our associate enterprise, we take at 6.5%. Therefore, the differential amount. See, suppose I am X, you are Y. I am taking loan from you at 6.5%, higher rate of interest. It means I will book higher expense. From others, I will take loan at 4%. Therefore, the differential amount has to be added back as transfer pricing adjustment. Therefore, 62 crores into 2.5%, that is excess interest that I am paying to you. Excess interest that I am paying to you. Multiplied by 9 by 12. Why 9 by 12? Because the loan is taken on 1st of July. Therefore, we will take the interest only for 9 months. Okay. Therefore, this is the amount of interest which has to be added back to your transfer pricing adjustment. Okay. Now, third one. If X has accepted the primary adjustment made by AO on 31st March. Suppose the AO has made a primary adjustment on 31st March. X has accepted that. What should X do if it does not want to treat the excess money as deemed advance and include interest on the same in the total income? See, if AO has added some income, AO has added some primary adjustment, you have accepted that. Now you don't want to pay interest on that, interest on the secondary adjustment. What should you do? First, you should repatriate the excess money to India within 90 days. This is the first option you have, correct? Repatriate the money within 90 days in India. What is the second option? Pay additional tax of 20.9664, which we have seen in the previous questions also, and pay interest up to the date of payment of additional tax. The best thing would be to bring the money within 90 days in India. If you bring the money within 90 days in India, no tax, no interest, nothing. But if you don't bring the money in India within 90 days, then whenever you will bring the money, till that period you have to pay the interest, and then you have to pay additional tax of 20.9664. Therefore, the answer to this question is do either two. If you do two, if you follow point number 2, that is the best. If you cannot follow point number 2, then you follow point number 3 and 4 together. That pay interest up to the date of bringing the money to India, and then pay additional tax, one-time tax. And after that, nobody will ask for secondary adjustment. Okay. Next question. If X has accepted the primary adjustment made by the AO on 31st March, and the excess money has not been repatriated to India up to 31st March 2026, what would be the consequence? If X has not opted to pay additional tax, then X has to pay interest. Interest on how much? Whatever is the amount. This is the primary adjustment, 1,16,25,000. On that, X has to pay interest. How much interest? In which year this interest will be charged? This interest will be charged in 25-26. So you have to take the SBI rate on first day of the financial year in which the interest is charged. So SBI rate on 1/4/2025 is 10%, plus you have to apply 3.25% on that. So this is the primary adjustment multiplied by 13.25%. You have to pay interest of this particular amount for the entire year, because till 31st March 2026, that is for 12 months, you are not bringing the money back to India. So you have to pay interest on this much amount. Okay. Now, which factor is relevant in determining whether the penalty under 270A of the Income Tax Act will be leviable in respect of the primary adjustments to X total income? So now this is a theoretical question. I'm not much interested in that. The question is asking which factor is relevant in determining the penalty under 270A. What is 270A penalty? It is a penalty for under-reporting or misreporting of income, 50% to 100%. Which factor is relevant? X has not reported the transaction as international transaction. Yes, this is a relevant factor. Do you remember that? If you do not report your transaction under the form 3CB as per sorry, if you do not report the transaction under form 3CB under section 92E, then it is deemed to be misreporting. And if it is deemed to be misreporting, then you will be liable for a penalty of how much? 200%. There are many reasons for making a transaction as deemed misreporting. One amongst them is not reporting the transaction in form 3CB. So if you have not reported the transaction as international transaction, you'll be liable for a penalty of 200%. Okay. Last question. In the scenario given above, what would be the situation on account of application of transfer pricing provision if X, the Indian company, would have been the lender and Y, the US company, would have been the borrower? Suppose if the Indian company is the lender and the foreign company is a borrower, then if I lend at 6.5%, then the government should not have any problem, correct? Because if I lend at 6.5%, then I'm charging interest at the rate of 6.5% and I'm paying tax on 6.5%. Then I will not apply transfer pricing provision, because if I apply transfer pricing provision in that case, then the interest income will fall to 4% and the transfer pricing provision will not apply. Do you remember? Section 92C, section 92 subsection 3 says what? The transfer pricing provision shall not apply if it leads to what? A reduction of income or increase in loss. See, today I am showing income at 6.5% as interest. If I apply transfer pricing, I have to show income at 4%. Then that will reduce my income now. Therefore, transfer pricing provision will not apply in that case. Check. Okay. I hope it is clear to all of you. Let's move on to the next case scenario. That is case scenario number 14. LPG, a partnership firm, is there engaged in the business of manufacturing of garment. It furnishes you the following data for the year ended 31st March 2024. There are some expenses, there are some partners salary, some interest to partners, etc., which is given. There is some turnover which is given, and then they have given some additional information below. Okay. Now let me read the first question. How much interest can the firm claim as deduction for AY 24-25? Now pay attention please. First of all, the firm has paid an interest of 5,40,000, out of which 1,20,000 is paid to Gopal for the loan given by Gopal HUF. Now it is not paid to the partner. It is a loan given by the Gopal HUF. Who is the partner in the firm? The partner in the firm is Gopal. Is Gopal's HUF partner in the firm? No. So interest paid to Gopal's HUF will not be covered in 40B. It will be fully allowed. So that will be fully allowed. 1,02,000 fully allowed. Okay. Now forget about this 1,02,000. 1,02,000 is fully allowed because it is not paid to partners. It is paid to partners HUF, and partners HUF is not the partner in the question. Now out of 5,40,000, 1,20,000 is fully allowed. Now what is left? 4,20,000 is left. Now you have made some mistake over here. What mistake has been made by the assessee? First of all, they have paid interest at the rate of 16%, which they should have not done. They should have paid interest at how much percent? 12%. Similarly, they have paid interest from 1st of July, whereas in the deed they have mentioned on 1st of Jan. On 1st of Jan, you are changing the deed, but you are paying interest on a retrospective basis, not allowed. You should have paid interest for only 3 months, but you have paid interest for 9 months. So let us find out the capital amount first. How will I find out the capital amount? 4,20,000 is the interest. You have paid how much percent interest? You have paid interest for how many months? You have paid interest for 9 months. You should have paid interest for only 3 months. So I will find out the capital first. So I will multiply by 12, divide by 9. That will give me the amount for the entire year. Then I will divide by 16% because that will give me the amount of capital that needs to be found out over here. Be very careful. This is a very, very important adjustment. Pay attention, please. 4,20,000. I have made 2 mistakes. First, I have paid interest for 9 months. I should have paid only for 3 months. Second, I should have paid interest of 12 months. I have paid 16%. So I am rectifying that mistake first. 4,20,000 is for how many months? It's for 9 months. So if it is for 12 months, how much it is? I am converting that into 12 months. Then I am dividing that by 16% so that I can get the capital amount. My capital amount is now 35 lakhs. Okay, 35 lakhs is my capital amount. On that, I will compute now correct interest. How much is the correct interest? 12% is the correct interest. Multiplied by how much is the correct period? Only 3 months because you have changed in the deed from 1st of Jan. So multiply by 3, divide by 12. Therefore, the correct interest should be 1,05,000. Therefore, what is the total interest that should be allowed to the firm? 1,20,000 to Gopal's HUF and 1,05,000 to the partners. Therefore, the total interest should be 2,25,000 rupees. I hope it is clear to all of you. Okay. Now coming to question number 2. What is question number 2? How much salary can the firm claim as deduction for AY 24-25? Now, for salary to claim, you need to compute book profit. Now, how will you compute the book profit? You will start with 4,72,000. Okay. So 4,72,000 is what is your net profit as per PNL. Now, what is book profit? It is nothing but make all adjustments as per section 28 to 43. Make all business and profession adjustment and then add back remuneration. So I will make all the business and profession adjustment. First of all, I took the PNL profit 4,72,000. Then I will add back the interest and remuneration which is debited to PNL. How much interest and remuneration is debited to PNL? This is the remuneration, this is the interest that I will add back, that I've added back. Then I will allow the interest which is allowed to the assessee. How much interest is allowed to the assessee? That we have already computed in the previous question. That is 2,25,000. Whatever interest is allowed as per 40B, that has to be reduced to compute the book profit. So that I will reduce. So that I'm reducing. Check please. So interest is reduced now. Okay. After that, I will reduce unabsorbed depreciation also. How much unabsorbed depreciation is there? 1,50,000. Listen always. To compute the book profit, you have to reduce unabsorbed depreciation. Why? Because unabsorbed depreciation comes from section 28 to 43. Whatever comes from 28 to 43, you have to adjust. You will not adjust business loss as of now. Business loss is not adjusted to compute what? To compute the book profit. But unabsorbed depreciation is adjusted to compute the book profit. So you will reduce what? Unabsorbed depreciation. That will give you the book profit of 15,25,000. Now compute the remuneration. Up to 3 lakh, it is 90% of book profit or 2,70,000, whichever is higher. Above 3 lakh, it is 60% of book profit. Therefore, the answer comes to 10,05,000. But what is the actual remuneration paid to the partners? Who are the working partners? Is Jay a working partner? Mr. Madhav is not working partner. So don't compute the remuneration of Madhav. Compute the remuneration of Jay. Compute the remuneration of Gopal. Don't compute the remuneration of Madhav because Madhav is sleeping partner. Compute the remuneration of these two partners. It will come to 3,60,000 and 3,36,000. Therefore, the actual remuneration is how much? Actually 6,96,000. But the maximum is how much? 10,05,000. Therefore, how much will be allowed? Only 6,96,000 will be allowed. And therefore, this is the answer to this particular question. I hope it is clear to all of you. Okay. Now coming to question number 3. The business loss and unabsorbed depreciation allowed to be set off while computing the total income of the firm for AY 24-25 are how much? Now see, unabsorbed depreciation will be fully allowed. Okay, there is no problem in unabsorbed depreciation, but there is a restriction on business loss. Why, sir? Why? Because one of the partner in the last year has died, and in place of that partner, a new partner has been admitted. So because one partner died and in place of that partner, new partner was admitted. So this problem has been solved because one partner died and in place of that immediately a new partner is admitted. So this problem is solved. But one more partner is retired on the same date. The one more partner which was their partner in the last year that is retired on the same date. So his proportionate share will not be allowed as deduction in the current year for the purpose of loss and carry forward of set off of loss. Because you know section 78(1) says that if a partner retires or dies and if a remaining part, if a new partner is not brought in place of him, then his proportionate loss will be disallowed under section 78(1). Now, why the proportionate loss of Jayesh will not be disallowed? Because in place of Jayesh, a new legal heir has been admitted. But in case of Raj, there is no one who has been admitted. Therefore, out of the total loss, that is out of the loss of 3 lakh, all the partners are sharing profits and losses equally. 25%, that is 1/4 of the loss, will not be allowed to be carried forward and set out. Therefore, out of 3 lakh, only 2,25,000 will be allowed to be carried forward and set out. Therefore, the loss of 2,25,000 will be allowed and the UAD of 1,50,000 will be allowed under the income tax law. I hope it is clear to all of you. Now, the next one, what would be the total income of the firm? Now, it is very simple. Book profit, we have already computed in question number 2. Then remuneration, we have already computed, reduce the remuneration and then reduce the loss. That's it. That will give you what? The total income, which is 6,04,000 rupees. And UAD, that is already computed while computing the book profit. Therefore, we are not going to reduce UAD once again. From book profit, we will reduce remuneration. From book profit, we will reduce brought forward losses of 2,25,000. That will give us the PGBP or total income. I hope it is clear to all of you. Now let's move on to the next question. That is question number 15. Please all of you pay attention. X Limited is an Indian company incorporated in October 2022 with an objective of manufacturing medicine using state-of-art technology previously unused in India. One of the incidental business objects of X as per the memorandum of association is trading in futures and options on the Bombay Stock Exchange and the National Stock Exchange. It commences production from 1st December 2022 from its newly constructed manufacturing facility in Uttar Pradesh. Its registered office is also situated at the said manufacturing facility. Now, Y Inc. is a private company incorporated in foreign jurisdiction. X holds 30% of the nominal value of the shares of Y. Y has lent an amount of 50 crore as 6% to X on 1st April 2023. X paid the interest due for financial year 23-24 on 31st March 2024. The transaction is at arm's length price and X has not availed any other loan. Now, the profit before giving effect to the interest, tax and depreciation is 6 crore rupees, which includes dividend of 7,50,000 received by X from Y on 1st July. It earned 2,50,000 from FNO during the financial year 23-24. Additional information, X has registered a patent in India for treatment of novel virus, which it has developed in collaboration with Y. 90% of the total expenditure has been incurred in Uttar Pradesh, while the remaining has been incurred by Y outside India. X receives royalty of 5 crore by permitting other companies to use this patent. The total expenditure incurred for earning such royalties 42 lakh rupees. Let us start the question. Okay, if you want, you can pause the lecture. You can read the question once. Now, I will explain the question along with the MCQs. What would be the amount of disallowance, if any, of interest paid by X to Y in computation of total income of X for AY 24-25. Now, are X and Y associated enterprise? The answer is yes, because one entity holds how much? One entity holds 30% of the equity shares of the another entity. Therefore, both of them are deemed to be associate enterprise. If X and Y are associate enterprise, now is 94B applicable here? Yes, it is applicable, because Y is giving X some loan. How much loan is given? Y has given loan of 50 crore to X. That amounts to 6%. So what is 6% of 50 crore? That comes to 3 crore rupees, somewhere around that. 1.8 crore, something around that. Okay. So what is 6% of 5 crore, 50 crore, whatever it is. Okay. Now, how much will be the disallowance under 94B? That is the question. It is interest in excess of 30% of EBITDA. What is 50 crore? 6%. It comes to 3 crore. So this is the interest paid. Okay. What is EBITDA now? Let's see the EBITDA. What is the EBITDA? They have given all the information. The profit before giving interest, before giving effect to interest, tax and depreciation is 6 crore, which includes dividend of 7.5 lakhs. Okay. Now, this is the EBITDA. EBITDA is 6 crore. Okay. So 30% of 6, they have directly given the EBITDA, because they have given that 6 crore is the profit before interest, tax and depreciation. Okay. Therefore, the EBITDA is 6 crore. So 30% of 6 crore comes to how much? 1.2 crore. Now, how much is the interest paid to associated enterprise? Let's see. The interest paid to the associate enterprise is how much? The interest paid to the associate enterprise is, now the interest paid to associate enterprise is also 3 crore. Sorry, it is not 1.8 crore. It is 3 crore. Therefore, how much is the amount will be disallowed? So whatever is the interest paid in excess of 30% or interest paid to associate enterprise, whichever is lower, therefore the answer comes to 1.2 crore. That will be disallowed under 94B. And therefore the answer to this question is 1.2 crore. That will be disallowed under 94B. Okay. Now the question number 2. Therefore interest allowed will be how much? If 1.2 crore is disallowed out of 3 crore, therefore 1.8 crore will be allowed. Okay. This is the question which we need to answer. At what rate of tax will the income of X from manufacturing business of dividend, FNO, trading be taxed, assuming that X opt for the provision of 115BAA and 115BAB as the case may be? Now, which section is applicable for him? Is he liable? Is he eligible for 115BAA or is he eligible for 115BAB? First of all, we need to find out that. See, he is doing manufacturing. I agree. He is manufacturing. He is incorporated in this business. But the problem with him is he is engaged in other business activity also. Now remember, if you are engaged in any other business activity other than manufacturing, then you are not eligible for 115BAB. 115BAB is only applicable if you are engaged in manufacturing activity. Otherwise, if you are engaged in other business activity, you are not eligible for 115BAB. Therefore, he is eligible for what? 115BAA. BAA is open for everyone. So therefore, all his income will be taxable at what? 22%. He is eligible for 115BAA. He is not eligible for what? He is not eligible for 115BAB. Check it here. Okay. Now, which of the statement is correct as regard taxability of royalty? Now, how much royalty is earning? He is earning some royalty by selling patent, etc. Now remember, X is a resident. Condition number 1. 75% of the expenditure is done in India. So if you are a resident and if you are incurring 75% of the research expenditure in India, then your royalty will be taxable at a special rate of 10% under 115BBF. But under 115BBF, you will not get any deduction of any expense. Therefore, here your royalty can be taxed at how much percentage? It can be taxed at 10% of 5 crore rupees. You will not get deduction of expenses. Now, please, it is a special provision covered under chapter 12. I hope it is clear to all of you. So your royalty will be taxable at 10% without deduction of what? Any expense. Therefore, your royalty will be taxable at 5 crore rupees. I hope it is clear to all of you. Now, if X desires to avail the beneficial rate of taxation under 115BAA or BAB, as the case may be, then it cannot claim additional depreciation. Yes, additional depreciation is not allowed. But can he claim 80JJAA? Yes, 80JJAA is allowed to every special rate, whether it is 115BAA, 115BAB, 115BAC, 115BAD or 115BAE. Every kind of special rate assessee is eligible for what? 80JJAA. But additional depreciation is not allowed under any of the special tax rate. So the answer to this question will be point number 4. I hope it is clear to all of you. Now let's move on to the next question. That is question number 16, case scenario number 16. Pay attention please. DEF Inc., a company incorporated under the laws of country A, is engaged in management consultancy services. It has set up a branch office in India. Okay, in India they have a branch office. India has a DTAA with country A. Okay. Now during the financial year 23-24, it earns the following income in India. Fee from technical services 75 lakhs from ABC Limited, an Indian company, in pursuance of an agreement made with it approved by central government. The tax rate on such income under India country A tax treaty is 20% on gross income. The fee for technical services is not effectively connected with the branch of India. DEF incurred some expense of 3 lakh rupees. Shares of Bottle Private Limited are sold for 2 crore 60 lakh rupees. Other income 10 lakhs. All the above income has been credited to the statement of profit and loss account. Now DF has made an investment of 100% equity in the Bottle Private Limited shares, purchased for 1 crore 75 lakhs. On 5th November, it is 2004. Sorry. The said shares were purchased out of the foreign exchange USD 3 lakh 50 brought from outside India. Now we need to answer the following question. First, in the context of the provisions of 115JB, which is MAT, state which of the following statement is correct. Now, in the context of the question, statement given in point number 3 is correct. Why? I'm telling you the reason. The reason is the provision of 115JB are attracted in the hands of DEF Limited, since it is a resident of a country with which India has a DTAA, and the branch of DEF constitutes permanent establishment in terms of such agreement. Remember, when MAT is applicable to foreign company, MAT is not applicable to foreign company. Let me tell you when it is not applicable. If foreign company is a resident of a country with which India has a DTAA and that company does not have a P in India, if that company does not have a P in India, then MAT is not applicable. But if a foreign company is a resident of a country with which India has a agreement, and if that company has a PE in India, then that company is liable for MAT. Then they are not escape from MAT. If they want to get escape from MAT, they should not have a permanent establishment in India. But unfortunately, this company DEF has a permanent establishment in India. Therefore, it is liable for MAT. I hope it is clear to all of you. Now, question number 2. What is the rate at which the fees for technical services received by DEF is chargeable to tax in India? See, the services provided by DEF, to ABC, in the nature of technical service are of 75 lakh rupees. Okay. Is there an agreement between both the Assessees, yes, there is an agreement between ABC and DF. Is it approved by central government? Yes, it is approved by central government. Therefore, the provisions of 115A will apply. Now, what does 115A says? It says that 20% or DTAA rate, whichever is lower. Now, the rate mentioned in 115A, it is 20% plus cess and surcharge also sometimes. But the rate mentioned in DTAA is without surcharge and cess. Therefore, the treaty says 20%. The act also says 20%. Which 20% you will take? You will take the 20% of treaty, because the treaty 20% is without what? Without surcharge and cess. Therefore, that is more beneficial. Therefore, you will apply what? You will apply flat 20% on 75 lakhs. That is DTAA rate will apply as it is without surcharge and cess. You will not apply the income tax rates of 115A. Are you clear? Because if you apply the income tax rate of 115A, you have to apply the surcharge also of 4%, which you will not apply because the law says you have to apply whichever is lower rate. Okay. Now, in respect of the sale of shares of the Bottle Private Limited, which of the following statement is correct? Now see, you are selling the shares of the Bottle Private Limited. So remember, as per section 112, if a non-resident or foreign company is selling the shares of a private company or a closely held company, then they are liable to tax at 10%. But they have to lose two things in life. First, they will not get indexation. Second, they will not get the benefit of first proviso to 48, that TTBR, TTSR calculation. These two things they have to sacrifice. And therefore, the answer to this question is point number 3. That this is taxable at 10% because non-resident and foreign company selling the shares of closely held company. It is taxable at 10% without the benefit of indexation and without the benefit of what? Foreign conversion. They will not get the benefit of this. And the last but not least, which of the following statement is correct, assuming the rates specified in DTAA are the same as provided under the Income Tax Act? Now remember, whether a foreign company is liable to MAT, yes, a foreign company is liable to MAT, but they are exempted from MAT in certain incomes like capital gain on security, like dividend, like royalty, like FTS and interest. These 5 incomes foreign companies are not liable to MAT if their normal rate is less than the MAT rate. If they are chargeable at less than the MAT rate, that is 15%. If they are normally chargeable at less than 15%, they are not liable for MAT. So in this case, the foreign company is earning 2 things. One is they are earning royalty, FTS, which is chargeable at 20%. So whether MAT will be applicable on that case? The answer is yes, because the normal rate is not less than 15. The normal rate is more than 15. Therefore, they will be chargeable on MAT on that particular income. But they are earning one more income, that is capital gain on security. Are they normally chargeable at lower than 15%? The answer is yes, because they are normally chargeable at what? Lower than 15%. That will not be subject to MAT. Therefore, the MAT will be applicable on FTS, but the MAT will not be applicable on capital gain of Bottle Private Limited shares. Check this please. Therefore, the answer to this question is point number 1. Check it please. Okay. I hope it is clear to all of you. So let's move on to the next question. That is question number 17, which is a beautiful question. The following details pertain to Mr. Sahil and his best friend, Mr. Akhil. What are these people doing? These people are remitting some money outside India. Now, do you know that if you remit some money outside India, then there is a provision of TCS which is applicable under section 206C subsection 1G. So these people are remitting some money outside India. Therefore, TCS provisions will be applicable over here. Now, from where they are remitting? They are remitting some money through HDFC Bank, and they are remitting some money through Axis Bank. Now, what I have done, I have just noted down the transaction in the order in which it has happened. First, this transaction has happened. Then this transaction has happened, 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 then this transaction happened. I have just noted down in the order of the date in which it has occurred. Okay, because that is very much important while calculating the TCS. Okay, now in his friend, his Akhil is also doing some transaction that we'll talk sometime later. First of all, question number 1, is HDFC Bank required to collect TCS on the amount remitted by Mr. Sahil? If so, what is the amount of tax to be collected? See, what is HDFC Bank over here? The HDFC Bank is the authorized dealer. The authorized dealer is supposed to collect TCS if the amount crosses 7 lakh rupees. If you remit more than 7 lakh rupees outside India, then you have to collect 0.5% or 5% in some cases. 5% in most of the cases and 0.5% if the assessee has taken a loan from where? From a financial institution in India and remitting the money outside India for the purpose of what? Education. Now let's see. When is the first time that you are remitting money outside India? The first time you are remitting money outside India is on 10th of May. So first time you are remitting 1,20,000. Therefore, on this, no TCS will apply. When is the second time then that you are remitting money? The second time you are remitting money on 1st of July, 1,50,000. So again, it does not crosses the limit of 7 lakh. So again, the TCS will not apply. When is the third time that you are remitting money? The third time you are remitting money here on 5th of July, 3.5 lakh. Again, the limit of 7 lakh is not crossing. When is the fourth time that you are remitting money? The fourth time that I am remitting money on 29th of September. Okay. So on 29th of September, fourth time I am remitting money. How much money I am remitting? 1,20,000. Now, when I am remitting 1,20,000, now if I total all the 4 transactions, it comes to how much? It comes to 7,10,000. Therefore, is it crossing 7 lakh? The answer is yes. Now, because it is crossing 7 lakh, on excess amount, I will collect how much TCS? The HDFC Bank will collect TCS how much? 5%. Why 5%? Because I am remitting outside India out of my saving. If I would have remitted outside India by taking a loan from a financial institution, then it would have been 0.5%. I am not remitting out of taking a loan. I am remitting out of my saving. Therefore, 5% TCS will apply. Sir, why are you merging Axis Bank and HDFC Bank both? Because the CBDT circular says that to compute the limit of 7 lakh rupees, you have to merge all the dealers and then compute. Okay, do you remember that? Sir, then how HDFC Bank will come to know that how much you have remitted to Axis Bank, and how Axis Bank will come to know how much you have remitted to HDFC Bank? Do you remember that? The circular says that you have to give a declaration to the bank that how much you have remitted through the previous dealers. So when you go to HDFC Bank, you have to give a declaration that how much you have remitted through Axis Bank. When you go to Axis Bank, you have to give a declaration to the HDFC Bank that is how much you have remitted through HDFC Bank. Okay, so from the previous dealer how much you have remitted, you have to give that particular declaration to the current dealer. Okay, therefore, so on 7,10,000 I will collect TCS. HDFC Bank will collect TCS of how much? Of 5%. Okay, now so on 29 September, check here, 5% TCS will come to 500 rupees. Okay, 500 rupees of 10,000 will be 5% of 10,000 will come to 500 rupees. Now next transaction. What is the next transaction? When is the next time that HDFC is liable to collect TCS? The HDFC is liable to collect TCS on the 6th transaction also, on 1,35,000, 5% that will come to 6,750. So on 1,35,000, 5% will come to 6,750. So these are the 2 times that HDFC is liable to collect TCS. Now the next question is, when is Axis Bank liable to collect TCS? Now when is Axis Bank liable to collect TCS? Let's see. The first time Axis is liable to collect TCS on 11th of October on 3,50,000 rupees, on 3,50,000 rupees which is remitted outside India. Now already 7 lakh is exhausted. You will not get the benefit of 7 lakh for every bank separately. The 7 lakh is cumulative of all the banks. Okay, it is not separately for every bank. Therefore, you have already got the benefit of 7 lakh rupees earlier. So now you are not going to get the benefit of 7 lakh again. Now why you have taken 0.5%? Because now you are taking a loan from an Indian bank, check, and you are sending the money outside India. So this is sending outside, you are sending outside India by taking what? Loan from a financial institution. Therefore now you will be subject to a lower TCS rate of 0.5% on this amount and also on this amount. So Axis will collect TCS on 11th of October and then on 10th of Jan. Check it please. On 11th of October at 0.5%, which comes to 1,750, and on 10th of Jan again 1,750, that is 3,50,000 into 0.5%. I hope it is clear to all of you. Next question: is tax required to be collected at source on the amount remitted for tour package to USA by Mr. Sahil? See, Mr. Sahil is going out of India for some tour package for which he is paying some 5,20,000 rupees as the payment to the overseas tour package and program. Remember, for overseas tour package and program, there is no limit of 7 lakh. So for overseas tour package program, you have to collect TCS directly 5% up to 7 lakh, and above 7 lakh, you have to collect how much? 20% TCS. So therefore here on 5,20,000, you will collect how much TCS? Directly 5%. Check it please. So 5% on 5,20,000, no exemption of 7 lakh. And if it would have been more than 7 lakh, then above 7 lakh, it would have been 20%. Okay. Therefore the answer is directly how much? 5,20,000 into 5%, that comes to 26,000 rupees. Now, does Make My Trip required to collect TCS on the amount received for tour package of Bali from Mr. Akhil? Now Mr. Akhil is a non-resident. You can check it over here. Now he has come to India for limited purpose, and when he came to India, he booked a trip for Bali. So remember, 206C1G does not apply to a non-resident who visit India. There is a CBDT notification on the same, that if a non-resident visit India and if he purchases something, some tour package, etc., then 206C1G is not applicable. Therefore in case of Mr. Akhil, the TCS will not be collected. Therefore, no TCS is required to be collected in case of Mr. Akhil. Now, next one. What is the total income of Mr. Akhil? Assuming that he has shifted out of the default regime, it means Mr. Akhil is following what? The old regime. Now, let's compute the total income of Mr. Akhil. What is the total income of Mr. Akhil? What all incomes Mr. Akhil has earned? First of all, Mr. Akhil has a business of some retail shop in India from which he is earning 4,20,000. Further, he has some interest on fixed deposit of 1,20,000 and he also has some interest on saving bank account. So these are some of the incomes that Mr. Akhil is earning. So 4,20,000 is from business, 1,20,000 is interest on FD and 8,000 rupees interest on saving bank. Therefore, the GTI of Akhil is 5,48,000. Out of that, Mr. Akhil will get deduction of what? 10,000 up to 10,000 under 80 TTA subject to actual saving interest. The actual saving is only 8,000. Therefore, he will get deduction of saving bank interest of 8,000 rupees. Therefore, his total income as per the old regime is 5,40,000. Now, what would be the amount of tax liability in the most beneficial manner of Mr. Akhil? Now, when the question says most beneficial manner, you have to compute both old regime and new regime. Now, as per the old regime, I will compute tax on 5,40,000. But as per the new regime, I have to add back this 8,000 rupees. But because under the new regime, you don't get the deduction under 80 TT of chapter 6A. Okay. So that's as per the new regime, the total income will come to how much? 5,48,000 rupees. But as per the old regime, the income will remain 5,40,000. Therefore, compute tax on 5,48,000 as per new regime and 5,40,000 as per old regime, and then see whichever is lower, and the answer comes to new regime. The new regime is more beneficial over here. You can check it over here. I hope it is clear to all of you. Okay. Coming to the next question, question number 18, please. This is also a beautiful question. Let's go through this question once. So now what has happened in this question? It's a long question. I'm not reading the question. I'm directly reading the MCQs of question number 18. It's a simple question. What is the amount of interest allowable as deduction under section 24 to Mr. Sachdeva? Now listen, Mr. Sachdeva has taken some loan for a property. He has bought a residential property for which he has taken a loan. And this property he has let out on rent. So now remember, on let out property, there is no limitation on interest deduction. It is fully allowed. So how much interest is there? It is 40 lakhs, out of which only 37 lakh is paid. Now it doesn't matter under house property, whatever interest is accrued, it will be fully allowed. It is not allowed on payment basis. It is allowed on accrual basis. Therefore, entire interest, first of all, under a let out property, there is no limitation of 2 lakh rupees. Secondly, it is not subject to payment. It is allowed on accrual basis. Therefore, entire 40 lakhs will be allowed as deduction in this particular question. Okay. Now, the second question is, what is the amount of deduction permissible to Mr. Sachdeva under chapter 6A? Now, see, Mr. Sachdeva has made multiple payments which can be qualified under chapter 6A. First of all, he has made a principal repayment for his house of 30 lakh rupees and 5 lakh rupees to different banks, but he will be allowed a principal repayment of how much? 1,50,000 under ATC. After that, he has also paid 20,000 rupees as a claim to New India Insurance for his health. So that also he can claim under ATD. Then he has paid some 50,000 as interest for education loan of his daughter. Okay. So that also he can claim under ATE, correct? And then he has taken some electric vehicle on loan. He has taken some electric vehicle on loan on which he has paid some interest, but that interest is also allowed only up to how much? Only up to 1,50,000 rupees under section 80 EEB. So these are the different sections under which Mr. Sachdeva has taken the benefit under the income tax law under chapter 6A. ATC 1,50,000 maximum, ATD 20,000 maximum, it is 25,000, but he has paid only 20,000. Therefore, only 20,000 will be allowed. ATE unlimited interest, but he has paid 50,000, he will get deduction of 50,000. And ATEEB maximum 1,50,000 for electric vehicle. Okay, so he can claim this deduction. Next question, is notional interest on interest free deposits chargeable to tax? Now see, there is a case law on this particular thing in your study material, but now that case law is removed. Why it is removed? Because unfortunately or fortunately, whichever way you take, the chapter of house property and salary is not there in your syllabus. So they should not ask you such kind of questions in the exam. Yes, if house property chapter would have been there in your syllabus in CA final, they should have asked such question. But nevertheless, this case law was there earlier. Now it is removed, but still they have put the what case scenario on that particular thing over here. But still I will answer you. Suppose I have given my property on rent to someone. Okay. Therefore, my tenant will give me what? Will give me security deposits. So whatever security deposit he is giving me, am I supposed to pay tax on the notional interest of that particular security deposit? The answer is no. I am giving you a property on rent. You are giving me 5 lakh rupees security deposit. On that security deposit, the government is saying that, the assessing officer is saying that you should charge some notional interest and pay tax on that. Therefore, the court has said that you should not do all those things. There is no concept of notional interest on what? on security deposit. Therefore, that should not be subject to tax. This is what question number 3 is all about. Question number 4. The AO came to know about the transaction of sale of property at BKC Mumbai on 15 December 2023 and wants to hold Mr. David as an agent of Mr. Ajay. Can he do so? If not, why? Now, who is Mr. David? See here, Mr. Ajay, who is a non-resident, sold his property at BKC to another non-resident, Mr. David. So, Mr. Ajay is a brother of Mr. Sachdeva. So, Mr. Sachdeva's brother Ajay is a non-resident. He is selling his Mumbai property to another non-resident. So, it is written in section 163 that if a non-resident sells his property to another non-resident in India, if a non-resident transfers a capital asset to another non-resident in India, which what Ajay is doing to Mr. David, then the buyer will be said to be what? The agent of that particular person. The buyer will be called as what? The agent of that person. Sir, where it is written? It is written in section 163. Therefore, yes, he can hold Mr. David as an agent as per the provisions of the Income Tax Act. I have written the reason over here. If a non-resident transfers any property in India to a resident or non-resident, then the buyer is an agent. So, if non-resident is transferring any property in India to a non-resident or to even resident, then the buyer will be considered to be an agent. He has to take care of each and every tax implication. Therefore, he is what? Mr. David is an agent in this particular question. And last but not least, in whose hands would Raisa's rental income of house property at Wada will be taxable? See, who is Raisa? Raisa is Sachdeva's daughter. Sachdeva's daughter, Raisa, is there. Let's see over here. Yes. So, Sachdeva has transferred his property to his daughter, okay, on her birthday. Now, she is a minor daughter. So, what provisions will apply? The provisions of deemed owner will apply here. Don't apply the provision of clubbing. Clubbing provisions are not applied over here. And in clubbing provision, there is a concept that if the income has to be clubbed in the hands of the parents, then you have to check parents, which parent has higher income, mother has higher income or father has higher income. There is no concept of such provision under deemed owner under section 27. And here, father is transferring the property to child, minor child, and father is transferring a immobile property, a house property to child. Therefore, the provisions of clubbing will not apply. The provisions of section 27 deemed owner will apply. Therefore, all this emotional information like wife has more income, etc., all of them does not hold good in this case. Yes, that is relevant under the provisions of clubbing, but such incomes are not clubbed. Such incomes are deemed to be owned by what? Mr. Sachdeva. Therefore, Mr. Sachdeva will be liable to pay tax on this particular income deemed owner under section 27. I hope it is clear to all of you. So let's move on to the next question, that is case scenario number 19, which is on 35 AD, AMT, etc. Multiple questions are covered in this particular case scenario. Assuming that PQR LLP has fulfilled all the conditions specified for claim of deduction under 35 AD and has not claimed any deduction under chapter 6A under heading C, deduction in respect of certain incomes, what would be the quantum of deduction under section 35 AD? How much deduction will be allowed to PQR LLP? Let's see. What he has purchased. He has purchased a land of 75 lakhs that is not allowed for deduction. Then he has incurred a capital expenditure of 3 crore rupees, out of which 1.25 crore is land. Again, that is not allowed as deduction. See, 3 deductions are not allowed under 35 AD. One is land, second is goodwill, third is financial instrument. Therefore, what is allowed is only 1.75 crore rupees. Therefore, 1.175 lakhs will be allowed as deduction to the assessee. I hope it is clear to all of you. Question number 2. Assuming that PQR LLP has another existing business of running a 4-star hotel in Ahmedabad, which commenced operations 15 years back, the profit from which are 130 lakhs. What would be its income chargeable or loss under the head PGBP for AY 24-25? Now remember, in this business, the assessee is earning how much profit? 80 lakhs. In the current business, the assessee is earning profit of 80 lakhs. And how much deduction assessee is getting out of 80 lakhs? 175 lakhs they are getting deduction. Therefore, there is a loss of 95 lakhs in 35 AD business. Now, can I set off this against my another 4-star hotel? The answer is yes. A 35 AD business loss can set off only against 35 AD income. It cannot set off against other incomes. Therefore, I can set off this against what? Another 35 AD business. Therefore, I can set off this against what? Against my 35 AD business, that is against my 4-star hotel. Therefore, my ultimate profit will come to how much? This is 95 lakh loss. This is 130 lakhs positive income profit. Therefore, my ultimate profit will come to 35 lakh rupees. I hope it is clear to all of you. Okay. Now, let's go to another question. If out of amount of 1.25 crore paid for acquisition of land, 75 lakh is paid by way of cash, what would be the answer to 1 and 2? It will remain same. Arey, land is anyways not allowed as deduction. So what difference will it make whether you make the payment in cash or whether you make the payment in check? It will not make any difference. Anyways, land is not allowed as deduction under 3580. So whether you pay by cash or online, it doesn't matter. It will remain same. Okay. Next question. Considering the assumption given in question number 2. Okay. We need to continue with question number 2. What would be the tax payable rounded off by PQR Limited for AY 24-25? Now we need to make two calculations. First, the tax will be calculated on the normal provision. On normal provision, 35 lakh is your total income after all deductions, and 31.2% will be your tax rate. That is 30% tax for the firm. For LLP and firm, it is 30% tax and 4% cess. And second calculation that you have to make is you need to make calculation as per AMT. Why? Because the assessee is a partnership firm LLP and they are claiming what? 3580. So as per AMT, what deduction? What we will do? 35 lakh is the profit. Okay. We need to add back the deduction claimed under 3580. Okay. So whatever the deduction claimed has to be added back to find out the adjusted total income, and then you can claim depreciation on that much portion. Okay. So it is a building, 175 lakh is building, you can claim 10% depreciation on that, and therefore my adjusted total income comes to 192.5 lakhs. Now here also there is a catch. The tax rate under AMT is 18.5% for firm LLP etc. For cooperative society it is 15%, but for others it is 18.5%. Here you have to apply 12% surcharge. Why? Because the adjusted total income is more than 1 crore. Because the adjusted total income is more than 1 crore, you have to apply surcharge of 12% plus 4% cess you have to apply. Okay. So therefore your answer will come to what? Whatever your answer, therefore your answer will come to 41,48,140. Whichever is higher will become your answer, and the higher answer is 41,48,140. I hope it is clear to all of you. Next question. Would Mr. P be eligible for deduction under 80 JJAA in AY 24-25? If so, what is the quantum of deduction? Yes, definitely they are eligible for 80 JJAA. There is no harm in that. 80 JJAA is available. But here there are 5 kind of employees which we are hiring. See, 5 kind of employees we are hiring, and 80 JJAA, you have to employ the person for how many days? Sorry, at least 240 days. But if you are engaged in C on the board, if you are engaged in apparel business, if you are engaged in footwear business, or if you are engaged in one more business is the leather business. If you are engaged in these 3 business, then 150 days are sufficient. Okay. So in this case, 150 days of employment is sufficient. Now you have to check the employee's emolument has to be at less than or equal to 25,000. It should not be more than 25,000. Therefore, wherever the emolument is more than 25,000, that will not be allowed. Further, you have to check the employees have to be participating in the recognized provident fund. So it is written in the question that the casual employees do not participate in the recognized provident fund. Only the regular employees participate in the recognized provident fund. Therefore, you will not get the benefit of 80 JJAA for casual employees. So you will get the benefit of 80 JJAA for the first category of employees, for the second category of employees, and for the fourth category of employees. I hope it is clear to all of you. Now, for the fourth category of employees, also you will get. Why? Because if you count from 1st November to 31st March, it comes to around 152 days, and 150 days is sufficient for apparel business, leather business, and what? Footwear business. Therefore, you have to multiply now 40 employees into 24,000 into how many months? Into 6 months. Then 80 employees into 24,500 into how many months? Into 6 months. Then 30 employees into 25,000 for how many months? For 5 months. Then whatever is the amount coming, you have to multiply by that by 30%, and therefore your answer will come to 63,81,000 rupees. This is your correct answer. I hope it is clear to all of you. Now let's move on to the next case scenario, that is case scenario number 20. What is happening in this particular case? Again, the provisions of 194Q, 2061H, all of them are mixed in this particular question. Let's read the question number 1. Are provision of TDS and TCS under Income Tax Act attracted in respect of purchase or sale of transaction between Harshit and Pranav? If so, what is the quantum of tax to be deducted for the previous year 23-24? Now let's see. Harshit is a buyer and Harshit's last year turnover is 9.9 crore. Now if buyer's last year turnover is less than or up to 10 crore rupees, then buyer is not liable to deduct TDS under 194Q. But let's see the turnover of Pranav. The turnover of Pranav for last year is 10.10 crore. Therefore, Pranav will be liable for TCS. Okay. Pranav will be liable for TCS. The buyer will not be liable for TDS. When is the TCS applicable under 2061H? TCS is applicable on receipt basis, and it is applicable if the sale exceeds 50 lakhs. So the total sale made by Pranav to Harshit is 80 lakhs. But on the first sale, they will not collect TCS. On the second, because it is only 20 lakhs. On the second sale, it is 25 lakhs, again no TCS. But on the third sale, they will collect TCS. Why they will collect TCS on the third sale? Because the third sale is crossing 50 lakh rupees. So how much amount is crossing 50 lakhs? The 15 lakh rupees is crossing 50 lakhs. Okay, 15 lakh rupees is crossing 50 lakh, because when third sale is made, the total sale is 65 lakhs. Therefore, on 15 lakhs, the Mr. Pranav will collect TCS at the rate of 0.1%. And then on 15 lakh rupees also, Mr. Pranav will collect TCS at the rate of 0.1%. Check it please. Okay. So Mr. Pranav will collect TCS on 15 lakhs on 18th October. That is on this particular sale. And on 11th of Feb, he will again collect TCS at the rate of 0.1% on 15 lakh rupees. I hope it is clear to all of you. Now, what is the second question? In case of failure to furnish PAN by the deductee. Now, if the other person does not give PAN, how much TCS has to be collected? Generally, if the other person, that is the buyer, does not give the PAN, then you have to collect TCS at the rate of 0.1% or twice the rate or 5%, whichever is higher. It is twice the rate or 5%, whichever is higher. But in this case, in case of 206C1H, if the buyer does not give the PAN, then it is twice the rate or 1%, whichever is higher. Therefore, here it is only 1%, 1% and 1%, not 5%. Okay. But otherwise in TCS, it is maximum 5%. Is Thomas Cook required to collect tax at source on receipt of 5 lakh from Mr. Pranav for holiday package to Singapore? See, if you are going for a holiday package outside India, then the TCS will be how much? The TCS will be 5% up to 7 lakh, and above 7 lakh it is how much? It is 20%. There is no exemption of 7 lakh for OTPPs. For overseas tour program and package, directly TCS is applicable from the very first OP. Yes, up to 7 lakh it is 5%. Above 7 lakh it is 20% from 1st October 2024. Okay, so up to 7 lakh it is 5%. So you are going for 5 lakh rupees. So on 5 lakh rupees, 5% will come to how much? It will come to 25,000 rupees. I hope it is clear to all of you. What is the amount of tax to be collected from Mr. Pranav in respect of remittance of amount of overseas for his son and daughter's education? Now remember, you need to check he is sending the money outside for son's education and daughter's education. Now we need to check from where he is sending the money. If he is taking a loan from a financial institution in India, then the TCS will be 0.5% after 7 lakh. But if he is taking a loan, not loan from the financial institution, but if he is sending the money out of his saving out of India, then it is 5% up to 7 lakhs and it is exempt up to 7 lakhs and then it is 5% after that. So let's see what is he doing first. First, he has taken a loan of 15 lakh rupees from Bank of India on 1st of Feb for his son's education. So he will get an exemption of 7 lakh here. Okay. And on balance 8 lakh rupees, 0.5% TCS will be collected. Why 0.5%? Because he is taking loan from a financial institution in India and sending money outside India for children's education. Now, when he is sending the money for the second time, he is sending 12 lakh rupees after 15 days. The first remittance was made on 1st of Feb and the second remittance is made on 15th of Feb. So on 15th of Feb, he is sending out of his personal saving. Now, he will not get 7 lakh exemption once again because the 7 lakh exemption is aggregate of the entire financial year. He has already taken the 7 lakh exemption over here when he was sending for the first time. Now, directly 12 lakhs will be subject to what? 5% TCS. Why directly 12 lakh? 7 lakh is already exhausted on 1st of Feb. Now whatever money he is sending will be subject to 5% TCS. Why sir 5%? Because now you are not taking loan from financial institution and sending. You are directly sending from your personal saving. Therefore this amount will be subject to directly 5% TCS. Check it please. So the first amount will be subject to 0.5% on 8 lakhs and second will be directly 5% on 12 lakh rupees. I hope it is clear to all of you. Last question but not least. Are TCS provisions attracted in respect of remittance of gift to sister? If so, what is the amount of tax to be collected from Mr. Pranav? See, he is sending some 5 lakh rupees, 7 lakh, I don't know how much money he is sending for his sister. He is sending 7 lakh rupees to his sister outside India. Has he already exhausted 7 lakhs limit? Yes, he has already exhausted the limit of 7 lakh. Now, is he sending outside India to sister for education purpose? No. Is he sending for medical purpose? No. So apart from that, if you send for any other purpose, it is subject to 20% TCS. Therefore now on 6 lakh rupees, 20% TCS will be collected because it is neither for education nor for medical. On 6 lakh, 20% will come to how much? 1,20,000 rupees will be subject to TCS. I hope it is clear to all of you. So let's move on to the next question. That is question number 21. Now again, this is on 10AA, 35AD, AMT, so on and so forth. Okay. So let's see the question now. What is the amount of deduction under 10AA and 35AD available to Ganga LLP while computing income under the regular provisions of the Income Tax Act. Now, how much is the deduction available under 35AD and 10AA? Let's see. For 35AD, Ganga has incurred a capital expenditure of 97 lakh, out of which 32 lakhs is land. Therefore, under 35AD, Ganga will get deduction of how much? 65 lakhs. Are you clear? I hope it is clear, because land is not allowed as deduction under 35AD. Now, for 10AA, Ganga will get deduction of how much? Whatever is the profit of SEZ multiplied by whatever is the export sales divided by whatever is the total sales. So what is the total sales? Total sales is 160 lakhs. Okay. So 60 lakhs is the profit from SEZ. Multiplied by export sales is 120 lakhs and total sales is 160 lakhs. So this is the deduction they will get. But this is not the business within 5 years. The business has commenced in 2018-19 and this is the 6th year of business. If 2018-19 is the first year, 18-19, 19-20, 20-21, 21-22, 22-23 and 23-24 is the 6th year of the business. Therefore, it will be eligible for only how much? 50% of the deduction. So because after 5 years, you get only 50% deduction under 10AA. Therefore, I am claiming how much? Only 50% deduction. Okay. I hope it is clear to all of you. So therefore, you will get deduction of 22.5 lakhs. Now, the next question is, what is the tax liability of Ganga LLP computed under the regular provision of the Income Tax Act? Now, let's see what is the profit of Ganga. The profit of Ganga as per 35 AD is 160 lakhs and as per profit of SEZ is 60 lakhs. So let me write both the profit first. 35 AD is how much? 35 AD 160 lakhs and SEZ it is 60 lakhs. Then you will claim both the deductions. You will claim 35 AD deduction 65 lakhs which you have computed in the previous question, and then you will compute the 10AA deduction of 22.5 lakhs. Therefore, the total income of Ganga comes to 132.5 lakhs. On that, we will apply 30% tax as per the regular provision, 12% surcharge because the income is more than 1 crore and 4% cess. I hope it is clear to all of you. Okay. Now, what is the alternate minimum tax payable by Ganga as per 115 JC? So for alternate minimum tax, we need to compute the adjusted total income. Now, how to compute the adjusted total income? Whatever is the total income, that I will write first. Then I will add back 10AA, then I will add back 35 AD, and then I will take normal depreciation, additional depreciation if applicable on 35 AD asset. So that I will minus, that will give me the adjusted total income. On that I will apply 18.5% tax, 12% surcharge and 4% cess. That will give me what? That will give me the tax as per what? As per AMT, and that I will pay under the what? Alternate minimum tax. Now, is there any MAT credit available? See, MAT credit will not be available. Why, sir? Why? Because when is MAT credit available? When the MAT liability is more than your normal liability. But in this question, unfortunately, the normal liability is slightly more than the MAT liability. Can you check this? Because the normal liability is more and the MAT liability is less, the question of MAT credit will not arise. Therefore, in this question, MAT provisions will not apply. Okay. And last but not least, what is the income to be declared by Mr. Ganesh for AY 24-25 under the head PGBP, so that he makes maximum tax saving without getting the books of accounts audited? Now let's see what is the income of Mr. Ganesh. Mr. Ganesh is one of the partner of LLP. Now he is doing a business of manufacturing of leather. His turnover of last year is 180 lakhs and in the previous year, that is in the current year, he has a turnover of 200 lakhs. Now he has made a payment of 23-24 190 lakhs. The profit for 23-24 as per the books of accounts is 12.10 lakhs. Out of the turnover of 200 lakhs, 190 lakhs is through RTGS and NEFT and remaining 10 lakhs is by way of cash. Okay. Now what is the Mr. Ganesh preferences? Mr. Ganesh preferences, he doesn't want to get his books of accounts audited. So let him follow what? 44AD. So 44AD can he follow? Yes. His turnover is exactly 2 crore. He can follow 44AD, and out of 2 crore, 190 lakhs is received through online modes. So on that much income, he will show 6% as deemed income, and on remaining 10 lakhs, he will show 8% as deemed income. Therefore, Mr. Ganesh can easily show 12.2 lakhs as his income, and therefore Mr. Ganesh can be safely classified under what? 44AD, and without books of accounts being audited, he can show 12.2 lakhs as his profit. I hope this case scenario is clear to all of you. Now let's move on to the next question, that is question number 22. Okay. Now what is given in this question? Let's read the first question first of all over here. How much tax to be deductible at source on the fee for technical service paid to XYZ INC? Now you are paying some fee to XYZ INC. Let's check how much fee you are paying to XYZ INC. Now, T Limited, an Indian company, a wholly owned subsidiary of Falcon Limited, paid 50 lakh rupees to XYZ INC country M as fee for technical service. Now, how much? Generally, fee for technical services is covered under 115A. But always remember, when it is covered under 115A, if there is an agreement between both the party and the agreement is approved by central government, then 115A is applicable. If there is no agreement, or if there is an agreement which is not approved by central government, if these conditions are not mentioned, then 115A is not applicable. Then in that case, what will happen? Then you will deduct TDS at the normal rates. And what is the normal rate for a foreign company? It is 40%. Therefore, you will deduct TDS at 40%, 40% tax and 4% cess. That will come to 41.6%. Why I am not applying 20% rate of 115A? Because there is no agreement which is approved by central government. Therefore, I have to apply the normal rate. Okay, 50 lakhs, 41.6%. That is the tax I am going to deduct in this particular case. Okay. Now, how much of the dividend received by T Private Limited would be liable for tax for the assessment year 2024-25? Now, let's check how much dividend they have earned. The dividend which is earned by T Private Limited, they have earned dividend of 550 lakhs. So I'm writing 550 lakhs as dividend received. Now remember, for a domestic company, whatever dividend is received by a domestic company, out of that, if they distribute the dividend to their shareholder at least 1 month prior to the due date of filing of return, they will get deduction under 80M. Remember that? So this company has received dividend of 550 lakhs. Now, whatever dividend they will distribute till 1 month prior to the due date of filing of return, that much they will get as a deduction under 80M. Now, there is some mistake in the question, so we will rectify that first. First of all, interim dividend of 250 lakh is distributed on 12th November 2024. And they have declared some interim dividend 250 lakhs, final dividend 230 lakhs on 12th November 2024. And this is declared on 10th of November 2023. Okay. So which dividend will be allowed as deduction? Listen carefully. 250 lakhs is distributed as interim dividend on 10th November 2023 and final dividend of 230 lakh is distributed on 12th November 2024. And you have to distribute the dividend 1 month prior to the due date of filing of return. Now this company is subject to transfer pricing. Therefore, this company is liable for what? This company is subject to transfer pricing. You can check over here. They are having some associate enterprise outside India. Therefore, the due date of filing of return of this company is 30th November. Always remember. For transfer pricing assessee, the due date of filing of return is what? 30th November. Now, if the due date of filing of return is 30th November, they should distribute the dividend by 31st October. Now, is this dividend distributed by 31st October 2024, 250 lakhs? The answer is yes. Is the final dividend distributed by 31st October 2024? The answer is no. That is distributed after 31st October 2024. Therefore, final dividend will not be allowed as deduction. Only interim dividend will be allowed as deduction because that is distributed 1 month prior to the due date of filing of return. And therefore, the final taxable dividend will be 550 lakhs minus 250 lakhs, which will come to 300 lakhs. I hope it is clear to all of you. Okay. Now, let's move on to the next question. How much of the head office expenditure can be claimed by Indian branch of Falcon Limited for the assessment year 24-25? Now, remember, if a foreign company or a non-resident has a branch in India, then that particular foreign company will get some deduction in India. How much deduction will be allowed to that foreign company? To the Indian branch. So if a foreign company, say if Apple has a branch in India, and if Apple allocates its head office expenses to Indian branch, then the Indian branch will get deduction as per section 44C. They will not get the entire amount allocated to the Indian branch. They will get the amount allocated to the Indian branch compared with 5% of adjusted total income, whichever is lower. That much amount will be allowed to the Indian branch. Now we need to see in this question, how much is the amount allocated by the head office to the Indian branch? First of all, they have directly given us the adjusted total income check, 80 lakhs. And how much has been allocated by the branch over here? They have allocated around 18 lakh rupees to the Indian branch. You can check over here. So how much is allowed as a deduction of head office expenses allocated to the branch? Amount allocated to the branch, which is 18 lakhs. Compare with 5% of the adjusted total income. You have to compare with 5% of 80 lakhs. 5% of 80 lakhs comes to how much? It comes to 4 lakhs. Therefore, whichever is lower will be allowed as deduction. And therefore, the lower comes to how much? The lower comes to 4 lakh rupees. And 4 lakh rupees will be allowed as deduction to you. Okay. I hope it is clear to all of you. Now, the next question has little bit problem in the clarity. There is no clarity in the question. That is the reason I can have two views in the next question. Question number 4. Can Income Tax Department prefer appeal before ITAT in respect of complete relief obtained by the Falcon from CIT appeal? Now, generally, if the Income Tax Department wants to appeal to ITAT, then the tax effect has to be more than 50 lakh rupees. If they want to appeal to ITAT, the tax effect has to be more than 50 lakh rupees. If they want to appeal to High Court, it has to be more than 1 crore. If they want to appeal to Supreme Court, it has to be more than 2 crore. So these are the limits which are given under section 268A of the income tax law. Correct? Now we need to see what will be the tax effect? See, it is written in the second paragraph that a survey has been conducted and in that 90 lakh undisclosed assets were formed. And this 90 lakhs, if they appeal, okay, the assessee preferred an appeal to CIT appeal and assessee got the relief on this 90 lakh rupees. Now, if the department appeals, how much tax they are going to get? Now, the question is very silent about the tax. See, there is a survey which has happened because of which undisclosed asset of 90 lakh has been found at the assessee's premise. Assessee filed an appeal. Assessee won the case at CIT appeal. At CIT appeal, assessee won the case. Now the department wants to file an appeal. Now, we need to assume one thing over here, that if this undisclosed asset is covered under section 68 to 69D, where it is covered, if this undisclosed asset is covered under section 68 to 69D, then definitely the tax will come to 78%, correct? If any income is found under section 68 to 69D, then it is covered under what? Under 78% tax. And if we take 78% tax of 90 lakhs, then definitely the department can appeal on this. But if we take the undisclosed asset is not forming part of section 68 to 69D, suppose it is not falling under section 68 to 69D, then in that particular case, you will apply normal tax rates. Normal tax rate of a company is 25 or 30%. If you apply 25 or 30%, or even if it is a foreign company, it is 40%. Then in that case, the tax will come below 50 lakhs and therefore the appeal cannot be filed. So I think so the institute has assumed over here that it is a case of what? It is a case of section 68 to 69D. Yes, if you are making that assumption, then it is fair enough. Yes, as the tax liability is more than 50 lakhs, therefore the department can appeal to ITAT. I hope it is clear to all of you. Okay. So let's move on to the next case scenario number 23. This is a beautiful case scenario on the provisions of ULIP, unit linked insurance policy. Mr. Manoj is aged 45 years. He is a resident Indian. He has the following insurance policy and ULIP. A and B is the insurance policy. C, D, E, F are the ULIPs. Okay. Now we need to answer the following question. Which are the life insurance policies excluding ULIPs, in respect of which Mr. Manoj would be eligible for exemption under 1010D, in respect of maturity proceeds, and what is the quantum of deduction which would be available under ATC in respect of premium paid on such policies for AY 24-25. Assume that Mr. Manoj does not have any ULIP only for the purpose of answering this question. Now we need to answer. He has two life insurance policy A and B. We need to answer which is eligible for exemption and how much deduction will be allowed under ATC. These are the two questions which are asked under question number 1. Now see. For life insurance policies, you need to check whether it comes within the percentage or not. So first of all, we will see the date of policy. The date of policy is 2016. If the policy is issued on or after 1st April 2013, we need to check whether the annual premium should not exceed 10% of the sum assured. Okay. Now the annual premium is 50,000 rupees and the sum assured is how much? 6 lakh rupees. So is it within the limit of 10%? The answer is yes. Therefore, policy A will be exempt. It is not subject to tax because the annual premium is up to 10% of sum assured. For policy B, the annual premium is 40,000 and the sum assured is 3.5 lakh. So now if I check the percentage, it goes beyond 10%. Therefore, policy B will be taxable. Therefore, I have answered my first question. Only A is exempt, B is not exempt. Okay. Now, how much deduction will be allowed under ATC? Under ATC also, the law says up to 10% of sum assured we will allow. So here, is your 50,000 within 10%? Yes. So this 50,000 will be fully allowed. Is this 40,000 within 10%? No, it is going beyond 10%. So up to 10% we will allow. So what is 10% of the sum assured? The sum assured is 3.5 lakh. What is 10% of that? It is 35,000. So 50,000 of policy A and 35,000 of policy B. Total comes to how much? 85,000. That much will be allowed as deduction under ATC to you. I hope it is clear to all of you. Okay. Now coming to question number 2. Which are the ULIPs in respect of which Mr. Manoj would be eligible for exemption under section 1010D in respect of maturity proceed? Choose the option most beneficial to Mr. Manoj. So see, Mr. Manoj has 4 ULIPs. ULIP C, ULIP D, ULIP E, ULIP F. Now, there is an amendment came in ULIP around 2 years back in Finance Act 2021. What does the amendment say? If a ULIP is issued on or after 1st of February 2021, remember the date. If a ULIP is issued on or after 1st Feb 2021, then in that case, you have to fulfill 2 criteria to get exemption. First, you have to fulfill the criteria of percentage, that it should not exceed 10% of the sum assured. If that is fulfilled, you need to fulfill one more criteria, that it should not exceed that 2,50,000 rupees per annum. The premium should not exceed, the aggregate annual premium should not exceed 2,50,000 per annum. Therefore, First of all, what I am doing? First of all, I am checking whether all the ULIPs are coming under the new law or not. The first ULIP is coming under the new law because it is issued on 1st Feb 2021. The second ULIP is not coming under the new law. The second ULIP is coming under the old law. So only percentage criteria will be checked for the second ULIP. The third ULIP is also coming under the new law because it is issued on 1st March 2021. The fourth ULIP is also coming under the new law because that is also issued on what? On or after 1st Feb 2021. Therefore, first of all, let's not consider C, E and F as of now. Let's consider the old ULIP first of all. In old ULIP, what are you going to check? Only the percentage criteria. The annual premium is 3 lakh and the sum assured is 30 lakhs. Therefore, the old ULIP is by default exempt because 3 lakh divided by 30 lakhs comes to exact 10%. It is within the percentage limit. Therefore, it is fully exempt. Now, let's talk about C, E and F. Can I make all three of them exempt? The answer is no. I cannot make all three of them exempt. The reason why I cannot make all three of them exempt, because if I make all three of them exempt, the aggregate premium of all three of them which are issued on or after 1st Feb 2021. See, remember, when you aggregate the premium now, you will not take the old ULIPs which are issued before 1st Feb 2021 because in that case, you are only going to check the percentage criteria. When you aggregate the premium to find out 2,50,000, you will only take those ULIPs which are issued on or after 1st Feb 2021. Therefore, I will aggregate C, E and F. If I aggregate all three of them, it crosses 2,50,000. Now I have an option. Either I can make ULIP E exempt or I can make ULIP C plus E exempt. If I make ULIP F exempt, if I make ULIP F exempt, then I have to pay tax on ULIP C and E. Or if I make ULIP C and E exempt, then I have to pay tax on ULIP F. Now the question is saying, find out the most beneficial one. Which is the most beneficial one? So I need to find out the tax on all of them. How much tax I will be liable to pay on all of them. Then I will be able to find out now which is most beneficial. How to compute the capital gains? In this case, whatever amount is received by you minus whatever premium you have paid over the years. So in ULIP C, I will be receiving in 2000, I don't know whenever it is 2030, maturity is 2030. In ULIP C, I will be receiving 11 lakh rupees and I will be paying premium of how much? Premium of 9 lakh rupees from 2021 to 2030. Therefore, in ULIP C, the capital gains will come to 2 lakh rupees. Similarly, in ULIP E, the capital gains will come to 4,40,000, 17 lakhs minus the premium over the years. Similarly, in ULIP F, the capital gains will come to how much? 5,50,000. Now, what options I have? Listen carefully. I have two options. Either I will exempt C and E and pay tax on F, or I will exempt F and pay tax on C and E. Now, what is more beneficial according to you? It is better that you pay tax on F and exempt C and E, because if I pay tax on F, I have to pay tax on 5,50,000, and if I exempt C and E, then I will get exemption of what? 4,40,000 plus 2 lakh, that is 6,40,000. Therefore, it is better to exempt what? C and E and pay tax on what? F. That is most beneficial for me. Therefore, which all ULIPs will be exempt? D is anyways exempt and C and E will also be exempt in this exercise. Therefore, C, D and E is exempt in this particular case. I hope everybody understood this. Why I chose C and E over F? Because C and E over F has more capital gains. So it is better to exempt those policies which has more gain rather than to exempt those policies which has lesser gain. I hope it is clear to all of you. Now question number 3. Question number 3 and question number 4 is almost similar to what we have done in the previous question. Considering the option chosen in MCQ2 above, what would be the capital gains computed under 45(1)(b)? So we have already done the capital gains. If we choose C and E to exempt, if we choose C and E to exempt, what will be the capital gains that we have to pay tax on? 5,50,000. That we have already computed, and therefore the answer to this question will come to how much? 5,50,000 rupees. I hope it is clear to all of you. What would be the total tax deductible under 194DA during the previous year 23-24 on payment of maturity proceeds of life insurance policy to Mr. Manoj? See, the company will deduct TDS. You are maturing 2 policies in the current year. 2 life insurance policies are maturing in the current year. One is policy A is maturing. Second is policy B is maturing. Now, obviously, in 194DA, it is very clearly written that TDS will be deducted only on those policies which are taxable. If the policy is exempt, TDS should not be deducted. Now we have already concluded that policy A is anyways exempt. Therefore, TDS will not be deducted on policy A. But the policy B is taxable. Policy B is taxable because the premium is more than 10% of sum assured. Therefore, on policy B, TDS will be deductible. On how much amount TDS will be deductible? Under 194DA, 5% TDS will be deducted. 5% TDS is deductible under 194DA. But the question is not percentage. The question is amount. The amount is the amount paid by the insurance company. How much amount is paid by insurance company? 4 lakh minus how much premium you have paid over the last 7 years from 2017 to 2024? 2,80,000. Therefore, 4 lakh minus 2,80,000 will come to 1,20,000. On 1,80,000, 1,20,000, the company will deduct how much TDS? 5% TDS will be deducted by the company. I hope this question is clear to all of you. So let's move on to the next question. That is question number 24, case scenario number 24. Flags Private Limited is a very simple question and small question. Flags Private Limited availed online digital advertisement. Whenever online digital advertisement will come, assume that there is going to be the question on what? The question on equalization levy provided by Marshall Inc. in USA March 2024. It paid 10 lakh and 10 lakh rupees, and amount outstanding on 31st March was 2 lakh rupees. For the said online advertisement service. Therefore, the total service which is availed by Flags Private Limited is of 12 lakh rupees. 10 lakh is paid, 2 lakh is outstanding. Okay. Now, Marshall Inc. is also an e-commerce operator who sold goods to customers resident in India for 180 lakhs during the financial year 23-24. Also during the same year, Marshall Inc. sold goods of 70 lakhs to customers outside India, but using the IP address of India for the purchase of those goods. On the basis of the above facts given above, choose the most appropriate answer to the following question. Let's answer the following questions. It's a very small MCQ. In respect of the amount paid or payable by Flags Limited for advertising services provided by Marshall Inc., which of the following statements are correct? Remember, how much advertisement cost Flags Inc. has incurred? 10 lakh rupees they have paid, and 2 lakh rupees they have further incurred, but they have not paid. So in all, they have incurred total 12 lakh rupees. For what? For online advertisement, and it is paid to Marshall Inc. We are assuming that Marshall does not have any permanent establishment in India. We have to assume that, otherwise the question is irrelevant. In the question, it is not written whether the Marshall has a permanent establishment in India or not. We are assuming Marshall does not have a P in India. Therefore, Flags Inc., Flags Limited has to deduct equalization levy at the rate of 6% of 12 lakh rupees. Therefore, it has to deduct how much? 72,000 by what? They have to deduct 72,000 and pay to the central government by 7th of the following month. Okay. Now, the next question is, would Flags Limited be liable to pay interest and penalty if the amount of equalization is remitted by 20th June? Definitely, because the equalization levy has to be remitted by 7th of the following month. Even if it is of March, you have to remit by 7th April. Now, if you are remitting on 20th of what? June 2024, then you will be liable for interest at the rate of 1% per month or part thereof, and you will also be liable for penalty. Okay. Yes, it will be liable for both interest and penalty. Interest how much? They are not asking how much interest. They are just asking whether they will be liable for interest and penalty. Yes, you will be liable for interest and penalty for late payment of equalization levy, and you will also be liable for penalty for late payment of equalization levy. Okay. Question number 3. Would equalization levy be attracted in the hands of Marshall, being an e-commerce operator for sale of goods in India? The answer is yes. Why? Because Marshall, count the condition. Marshall is an e-commerce operator. Marshall is a non-resident. And Marshall does not have a PE. We are assuming that. Okay. And Marshall is selling in India goods of 2 crore rupees or more, or selling in India, selling outside India through IP address located in India. Even if you sell to the residents in India, if you sell to the Indian residents, then that is also covered in the limit of 2 crore. Or if you sell outside India, but if you are using the IP address of India, that is also covered in the limit of 2 crore. So they are selling more than 2 crore rupees goods, 2 crore or more. Therefore, equalization levy of 2020 is applicable in this case. 180 lakhs you are directly selling to Indian customers, and 70 lakhs you are selling outside India, but it is using the IP address located in India. Therefore, that will also be covered under what? The limit of 2 crore. The total comes to 250 crore. Therefore, Marshall will be liable for equalization levy under 165A, which was introduced in Finance Act 2020. How much equalization levy? Only 2%. The 2020 equalization levy talks about only 2%, not 6%. So therefore, Marshall will be liable to pay equalization levy of how much? 5 lakh rupees. I hope it is clear to all of you. Let's move on to the next question. The following information pertains to Mr. Apurva, Indian citizen. He is an Indian citizen and he is a non-resident in India. So remember, he is an NRI, NRI and NRI. And he is earning the following incomes. Okay, let's see what all questions are there in this particular MCQ. Question number 1. What is the amount of dividend taxable in the hands of Mr. Apurva, and at what rate TPO Limited will deduct the TDS on the dividend income distributed to Mr. Apurva? Now, so remember, At what rate dividend is taxable in the hands of non-resident? Dividend is taxable in the hands of non-resident at always 20% tax. So this will be taxable at 20% plus 4% cess as per 115A. Okay. Secondly, do they get any deduction? They don't get deduction of any expenditure against dividend for non-resident. Not even that 20% deduction of interest on loan, which is generally available against dividend. It is available against dividend, that if you take a loan and invest in the shares, then you get the interest of 20% against the dividend income. That is not available for non-resident. Okay. So therefore 20% TDS will also be deducted under section what? Under section 195. Therefore, what is the dividend income which is earned by the Mr. Apurva? 1,30,000. Therefore, entire 1,30,000 will be taxable in the hands of Apurva, and it will be taxable at 20.8%. The TDS will also be deducted at 20.8% only. I hope it is clear to all of you. Question number 2. Assuming for the purpose of this MCQ, only for the purpose of this MCQ, assume that Mr. Apurva is a resident. Now, if he is a resident, then 1,30,000 will be subject to deduction. What deduction? He has taken some interest on loan for purchasing the shares of TPO Limited. Can you check that? And he has paid interest of how much? 30,000 rupees. So he will get deduction of how much? Not 30,000 entirely, but he will get deduction of up to 20% of the gross dividend. So if Mr. Apurva is resident, then he will get definitely the deduction of interest on loan taken to invest in the shares of TPO Limited. Therefore, how much he has invested? I don't know how much he has invested, but he has earned a dividend of 1,30,000. He will get deduction up to 20% of the dividend. That comes to 26,000. Plus. What is the tax rate for TDS for resident? The tax rate for TDS for resident on dividend, it is 10% under 194 without cess. So under 194, now the TDS will be deducted at 10% without cess. Therefore, the taxable dividend will be 1,04,000. This 26,000 which was not allowed to non-resident will be allowed to Apurva over here if he becomes a resident. Okay. And the TDS section will also change for resident. It is 194. It is not what? 195. Okay. I hope it is clear to all of you. What is the amount of interest on debenture of SLP Private Limited taxable in the hands of Mr. Apurva, and at what rate? Ignore surcharge and cess. Now, this dividend interest on debentures subscribed in convertible foreign exchange, it will be taxable under section 115A, not under 115C2I. Sorry, it is wrongly written. It is taxable under 115A. Why, sir? Why it cannot be taxed under 115C2I? No, 115C2I does not cover debentures of private company. It covers debentures of only public company. Go and check. 115C2I, which is a special provision for non-resident, which is a special provision for NRI, which is given under chapter 12A, which is given under section 115C2I. It is specifically only for what? Only for debentures of public company, deposits of public company, government security, and the last one is shares of public and private company both. Okay, shares of both public and private are covered in 115C2I, but debentures of public company are not covered. So this will be taxable at what? This will be taxable at how much? This will be taxable directly at whatever interest you are earning. Okay. 1,35,000. This will be directly taxable at 20% under section 115A. Under why 115A? Because it is purchased in foreign currency. Therefore, it is taxable under 115A. Otherwise, it would have been taxed at what? Slab rates. If it would have not been in foreign currency, we would have taxed at normal rates, slab rates. It would have not been taxed at special rate. I hope it is clear to all of you. Now, the fourth question. What would be the amount of LTCG taxable in the hands of Mr. Apurva on sale of debentures of Fixed Limited? Now, Fixed Limited is a public company. Okay, be careful. Fixed Limited is a public company. So, is the debenture of public company covered under 115C2I? Yes, it is covered. Okay. So, how much long-term capital gains will be taxable over here? So, we need to check at what price they have sold, at what price they have purchased. They are selling the debentures of Fixed Limited for 18,25,000. On that, they are paying brokerage of what? 7,000 rupees. So, 18,25,000 rupees is their gross consideration, and 7,000 is the expense on transfer. Therefore, 18,18,000 is your what? Net sale consideration. Minus, what is the cost of acquisition of these debentures? These debentures were purchased in convertible foreign exchange on 10th June 2004. It is not 2024. Sorry, it is 2004 for 4,65,000. Okay, so you are purchasing for 4,65,000 rupees. Okay, so if you are purchasing for 4,65,000 rupees, you have to reduce that particular thing from here. Okay, now. He reinvested the sale proceeds of 4,80,000 for purchase of listed shares of Indian company. So now within 6 months, if you are reinvesting, then proportionate capital gains will be exempt for you. How much capital gains will be exempt? Whatever capital gains is coming over here, you have to take the exemption as follows. How much exemption I have to take, sir? You have to take the exemption as follows. Pay attention, please. Whatever it is coming. Suppose this is coming to 13,53,000. Let me count. 18,18,000 is my net consideration, minus 4,65,000 is my 13,53,000 is my long-term capital gains. Now, how much is exempt? From that, it is exempt under 115F. A special provision will be applicable for you because you are an NRI. You are buying the debentures of public limited company, which is specified asset under 115C2I. Third, you are buying in foreign currency. Fourth, after selling this asset, you are purchasing another debenture within what? 6 months check for how many rupees? For 4,80,000 rupees. Therefore, you're in 115 you will get exemption. How much? 13,53,000 into amount reinvested is 4,80,000 divided by 18,18,000. This much amount will be exempt. So exempt this much amount, the balance will come to 9,95,772. And the last question is, what will be your answer if Apurva is a resident? If Apurva is a resident, then Apurva will not get the benefit of section 115F. Then Apurva has to pay tax on what? 13,53,000 rupees, because on debentures anyways you don't get indexation, so you have to directly compute like this only, the way we have computed, assuming that non-resident. So for resident also the same computation will be there. 13,53,000 will be taxable, but resident will not get the benefit of what? Section 115F. I hope it is clear to all of you. Okay. Now next question is a combination of income tax and equalization levy. Are we going to deduct TDS under income tax law, or are we going to deduct equalization levy under Finance Act 2016? It's a combination of that. Okay. So there are a lot of things which are over here. Let me read the question once for you all. Omega Inc., a country F company, maintains an online web platform through which it provides end user computer software, an end user license agreement. So there is a foreign company which is providing some computer software etc. to a company, Taylor Limited. An Indian company has entered into contract for 6.7 crore with Omega Inc. for the financial year 23-24, which is approved by the central government. So Omega is providing some services to what? To Taylor Limited, and Taylor Limited is paying some amount of 6.7 crore to Omega during the financial year 23-24, which is approved by the central government. Now, what is the broad terms of this end user license agreement between the two companies? What is the broad agreement between Omega and Taylor? What is the terms of the agreement that is mentioned over here? Grant of license. Omega grants Taylor Limited a limited non-exclusive license to install, access, display and run the click wrap web-based computer software on a single local hard disk or other permanent storage of one computer. Taylor Limited should not make CWCS available over a network where it could be used by multiple computers at the same time. So Omega is providing you some software which you can use for one time. You cannot use it for multiple users. It has to be used on single computer by a single person. It cannot be used for multiple purpose. Reservation of rights and ownership. Omega reserves all the rights. Omega is not giving you the rights of the computer software. All rights are not expressly granted to Taylor Limited in this EULA. The CWCS is protected by copyright and other intellectual property laws and treaties. Omega Inc. owns the title, copyright and other intellectual property rights in CWCS. The CWCS is licensed only for use and not any other purpose, not sold. Omega does not have any office in India. So it is very important that Omega does not have any branch in India, office in India, permanent establishment in India. Okay. Now, they have given us the extract of Article 12. They have given us the extract of what? Article 12. There's a mistake over here. I'm just removing this mistake. I will read this Article 12 between India and country F after some time. Now, is Taylor Limited India is required to deduct tax at source on the payment made to Omega in Inc? If yes, what amount of tax is required to be deducted at source on the said payment? See, India has a DTAA with country F. So we need to read the provisions of DTAA, and then accordingly we will come to know that whether the Taylor Limited is liable to deduct tax or not. Remember, Omega is in country F, Taylor is in India. Omega is providing us some services. We are making some payment to Taylor of 6.7 crore. We need to answer whether we are liable to deduct TDS. First of all, we need to find out this transaction is taxable where. First of all, is this a royalty? Yes, it can be called as a royalty. Therefore, this transaction will be taxable where? In the country of Omega or in our country, Taylor Limited country, that is in India. We need to find out that. For that, we are reading DTAA. Royalties and fees for technical services arising in a contracting state and paid to a resident of other contracting state may be taxed in that other state. Okay. So what does this sentence say? This sentence says that the royalty should be taxable in the resident country. Where should the royalty be taxed? Royalty should be taxed in the resident country, not in the source country. How did you interpret this, sir? I will read it once again for you all. Royalties and fees for technical services. Royalties and fees for technical services arising in a contracting state. Where it is arising? It is arising in India and paid to a resident of other contracting state. It is paid to a resident of which contracting state? It is paid to the resident of contracting state F. May be taxed in that other state, may be taxed in F. So as per this particular point, this point number 1, it should be taxed in country F and not in country India. It should not be taxed in India. It should be taxed in country F. But the point number 2 says that it can be taxed in the contracting state where they arise. The point number 2 says that it can be taxed in India also, but the tax in India should not be more than 10%. If it is more than 10%, it should not be taxed in India. If it is less than 10%, yet it can be taxed in India. Now you only tell me. First paragraph says that the royalty should be taxed in the resident country, that is country F. The second point says that it can be taxed in India. It may be taxed in India, provided India should not charge more than 10% tax. How much tax India is charging on royalty? India is charging 20% tax on royalty. Therefore, it cannot be taxed in India. It could have been taxed in India if India would have charged less than 10% on royalty. In this case, India is charging 20% tax on royalty as per 115A. Therefore, it cannot be taxed in India. Therefore, in this case, the royalty cannot be taxed in India. Therefore, no, the trailer limited is not required to deduct tax at source. In this case, the trailer limited will not deduct the tax. Now, will your answer change if is equalization levy attracted in respect of the consideration received by Omega for country F from trailer limited? The answer is yes, because you are not deducting the TDS. Now you are liable to deduct what? Equalization levy at the rate of 2%. The Omega INC is liable to pay what? Equalization levy at 2%. Equalization levy is why applicable? Because TDS is not applicable. See, both TDS and equalization levy cannot be applicable at the same time. Either TDS will be applicable or equalization levy will be applicable. If TDS is applicable, equalization levy cannot be applicable. If equalization levy is applicable, TDS cannot be made applicable. So in this case, because the income of Omega INC is not liable to tax in India, the Omega is liable for what? Equalization levy at the rate of 2% of the consideration as per Finance Act 2020. Now, will your answer change if there is no DTAA between India and country F? Yes, my answer will change. Who is preserving Omega INC? Omega INC is preserved by DTAA. If DTAA is not there, then definitely we will take tax from Omega as the royalty is accrued in India. When is royalty accrued in India? If the services are utilized in India, it is accrued in India as per section 915. Therefore, if there is no DTAA between India and country F, the Omega INC cannot be preserved. Omega INC will be liable to tax in India. Therefore, in that case, Omega INC will be liable to tax how much? 20% tax as per 115A, because they are providing us royalty and there is an agreement between both the country. It is mentioned in the question that there is an agreement between India and country F. It is approved by central government also. In the 4th line you can check. Therefore, this 6.7 crore will be subject to 20% tax. It will be subject to 2% surcharge because the income is more than 1 crore for foreign company. Therefore, surcharge of 2% will apply and 4% cess will also apply. Therefore, the tax will be 1 crore 42 lakhs 14,720 rupees. Now, in this case, if we are deducting the TDS, whether equalization levy will be applicable, then the equalization levy will not be applicable because it is subject to income tax. Therefore, now equalization levy cannot be made applicable in this particular case. I hope it is clear to all of you. So this is what this beautiful question is all about. So let's move on to the next case scenario. That is case scenario number 27. Sharma Private Limited files its return of income on 30th September, declaring a loss of 18 lakh rupees. The tax rate applicable to the company is 25%. Okay. The tax auditor in his report has reported a disallowance of 2,80,000 towards personal expenditure. But S, that is company, did not disallow the same. Now, do you remember that if a tax audit reports a particular item in the tax audit report, but if you don't disallow that in your return, then while processing the return, there will be a mismatch and the software will add back that expenditure. Do you know that? So that is what is going to happen over here. Which of the following statements regarding penalty on addition of 2,80,000 towards personal expenditure is correct? Since 2,80,000 is an adjustment referred in 143(1), no penalty is leviable in respect of this addition. I have already told you, whatever is added under 143(1) while processing the return, on that amount penalty is never imposed. Penalty is always imposed if AO increases your income while doing the assessment or while doing the reassessment. So if there is some addition while processing the return under 143(1), penalty will never be imposed on that, and therefore the answer to this question is point number 3. Okay. Now, what is the amount of penalty leviable under 270A as a consequence of assessment under 147 if addition was not on account of misreporting? So it's not a case of misreporting, it's a case of underreporting. Therefore, the penalty of 50% will be applicable on you. But for that, we need to find out how much is found as an income while computing the 147 assessment. Okay, so they are asking under 147 now. The income assessed is 3,20,000. What is the income previously assessed? The income previously assessed was 11,60,000 loss was there. Okay, so now 3,20,000 is your income assessed and previously assessed is 11,60,000 loss. Therefore, if I make the addition of this, it will come to 14,80,000 as what? As your income. And in case of loss, I have already told you, you don't have to follow that big formula to compute tax. You can directly compute tax on 14,80,000. That is how much? 25% tax on 14,80,000, as the tax rate of the company is 25%. It is given in the second line, and 4% cess you can apply, and therefore the ultimate tax will come to 384,800. On that you will apply 50% penalty. Therefore the penalty will come to how much? 192,400. Okay, I hope it is clear to all of you. Now the next question is, assuming that the additions made in the order under 147 are not on account of misreporting. It is a case of underreporting, but only on account of underreporting. S seeks to claim immunity for imposition of penalty under 270A and initiation of proceeding under 276 of the Act by filing an application in this regard before the AO. What are the other conditions that needs to be satisfied in this regard? Pay tax and interest. Yes, definitely. If you want to get immunity from section 270A penalty, first of all, you can get immunity from only 50% cases. You cannot get immunity from 200% cases. If there is a misreporting in your case, then immunity is not possible under 270A. So under which section immunity is available? Immunity is available under 270AA. For that, you need to follow the following conditions. First, you should pay the tax within 30 days from the receipt of notice of demand. You should pay the interest within 30 days of the notice of demand. Second, you should file an application within 1 month from the end of the month in which the order is received. Third, you should not file an appeal against the original order. If you fulfill these conditions, you are liable for what? You are eligible for immunity. First, you should pay the tax and interest as per the order within the period. Okay, you should pay the tax as per the order under 147 within the period specified in the notice of demand. No, not only tax is not sufficient. You have to pay the tax, you have to pay the interest. Therefore this point number 1 is a correct sentence. Okay, then after payment, you should not contest the addition. You should not contest the addition. No appeal should be filed against the order. So I have told you now, you should pay the tax and interest within the period mentioned in notice of demand, and you should not file an appeal against your 147 order. If you fulfill these two conditions, that is point number 1 and point number 4. One more condition is there. You need to also make an application. That is not mentioned here, so we are not talking about that. Therefore the answer to this question is point number 1 and point number 4. I hope it is clear to all of you. Okay. So let's move on to the next case scenario, that is case scenario number 28. Now it is a beautiful case scenario on taxation of trust under section 12AB and also certain institutions and associations covered under 1023C. Now pay attention please. What is the first question? Seva Niketan wants to avail exemption under 1023C clause subclause 2AD and subclause 3AE in respect of educational institution and hospital for the previous year 23-24. Can it do so? Now remember, if you are registered under 1023C and if you are running a hospital as well as education institution both, then your aggregate receipt of both of them taking together should not be more than 5 crore rupees. If I am running a hospital and education institution both, I am registered under 1023C, the aggregate receipt of both should not be more than 5 crore. Now in this case, it is more than 5 crore, as you can check. The education institutions revenue receipts is 3.1 crore and hospital receipts is 3.4 crore. The aggregate receipt of both should not be more than 5 crore. It is more than 5 crore. Therefore, you cannot get the exemption over here. Okay. No, it cannot, since the aggregate receipt from the education and hospital exceeds what? 5 crore. Therefore, you cannot take the advantage of 1023C, clause 2AD and clause 3AE. I hope it is clear to all of you. Okay. Now, we have done this example a lot of time earlier also. Now, what amount of corpus donation received by the trust would not be part of total income for the previous year 23-24? We need to say how much corpus donation will not be subject to tax. Remember, when corpus donation is not subject to tax, there is an amendment made by Finance Act 2021, which says that when you receive a corpus donation and if you invest that corpus donation in the mode specified in 11.5, when you receive a corpus donation and if you invest in the mode specified in 11.5, then it is not subject to tax. Now, how much corpus donation you have received in the current case? You have received corpus donation of 55 lakh rupees. Let's see how much you have invested in the mode specified in 11.5. The corpus donation received during the year, you have invested 10 lakh in the post office saving account. Is this amount specified in 11.5? The answer is yes. Therefore, 10 lakh would be exempt. 10 lakh would not be taxable. Second, you are investing in the Canara Bank fixed deposit. It's a government bank fixed deposit. Therefore, this is also covered in 11.5. This is also exempt. Then you are investing some NBFC, some money in the NBFC. Is NBFC covered in 11.5? No. I have told you mainly government entities investments are covered in 11.5. Therefore, this is not subject to what? This is not subject to exemption. Therefore, out of 55 lakhs, you have only invested 15 lakhs at proper place. 10 lakh rupees in post office saving account and 5 lakh rupees in Canara Bank fixed deposit. Therefore, out of 55 lakhs, only 15 lakh will be exempt. That will not be subject to tax. The remaining entire amount will be subject to tax. I hope it is clear to all of you. Okay. Now, the question number 3 is, what would be the amount of specified income taxable at the rate of 30% under 115 BBI for 23-24? Now, what is specified income? If you do certain violations which are mentioned under the income tax law, which are mentioned under 115 BBI, specified violation if you do under 115 BBI, you will be liable for flat 30% tax without any deduction. Now, what are those violations? See, what are the multiple violations that you have done? I have mentioned over here. First, you have received a corpus donation for the purpose of purchasing what? Building of the trust. Okay. You have been receiving the corpus donation for purchasing what? For purchasing building of the trust. But you are purchasing what? You are purchasing computer out of that corpus donation. Are you violating the provision? Yes. You have been given the corpus donation for purchasing building. The corpus is for building, but you are using for computer. Therefore, 115 BBI will apply on that 30 lakh rupees. Second, you have been told to invest the corpus donation where? In the mode specified in 11.5, but you are investing in NBFC 10 lakh rupees. So that 10 lakh rupees will also be what? Will also be subject to what? Will also be subject to the provisions of 115 BBI. I hope it is clear to all of you. Then 6 lakh rupees of last year. Last year you have accumulated some 6 lakh rupees. Okay. Now what is your duty? If you have accumulated that last year 6 lakh rupees, you should apply that 6 lakh rupees in the current year or within 5 years for specified purpose. Now you are using that money to make donation to another charitable trust. This is violation of section 11 subsection 2. Therefore, again, this will be subject to what? This will be subject to 30% tax under 115 BBI. These are the 3 mistakes that you have done in this particular question. Therefore, your total amount which will be subject to 115 BBI 30% tax will be 46 lakh rupees, and therefore the answer to this question is 46 lakh rupees. Okay. Now coming to the next question, that is also a beautiful question. What would be considered as application of the trust for the previous year 23-24 except excluding the unconditional accumulation of 15%? Forget about that 15% accumulation. What is other than 15%? What will come in the application? Assuming that it has fulfilled the relevant conditions stipulated under section 12A. Now pay attention please, all of you. You have done lot of application over here. Now which all amount will be considered as an application? First of all, let me go one by one. You have purchased a computer of 80 lakh rupees. Will this entire 80 lakh rupees be considered as application? No. Why? Because out of this 80 lakh rupees, 30 lakh rupees you have violated under 115 BBI. That cannot be considered as application. Second, if you take a loan and if you purchase an asset, that is also not allowed as an application. Remember, there is an amendment on this also. If I take a loan and if I purchase an asset out of loan, that is not considered as an application. Yes, when I will repay the loan, at that time I will consider that as an application. I will not get an application while buying the asset out of loan. Therefore, this will also not be considered as application. Yes. 25 lakh rupees I have received as a voluntary contribution from my donors. With the help of that, I have purchased asset. So that will be considered as an application for the purpose of section 11 and 12. So this is the first application that I will consider for the purpose of 11, 12. Okay. Second application, I have made a donation of 10 lakh rupees, but out of it, in point number 6, I made a donation of 10 lakh rupees, but out of that, 2 lakh rupees is given as a corpus donation. Now you know that you get the deduction of donation given to another charitable trust, provided it should not be a corpus donation. Corpus donation given as a donation will not be allowed as deduction. If I give a donation to you and if I say you that it is a corpus donation, I will not get the deduction. Therefore, out of 10 lakh, only 8 lakh is eligible. Only 8 lakh is eligible for deduction. But in 8 lakh also there is an amendment made by Finance Act 2024 which says that only 85% of 8 lakh will be allowed as deduction. Remember or not? Only 85% of the donation will be allowed as deduction. Therefore, out of this 8 lakh, only 6.8 lakhs will be allowed as deduction, because 85% of 85% of 8 lakhs comes to how much? It comes to 6 lakh rupees. Therefore 6 lakhs will be allowed as deduction. 6.8 lakhs will be allowed as deduction out of it. So total how much happens? 25 lakhs this will be allowed, 6.8 lakhs this will be allowed. Now one last thing which is covered in point number 5. Remember, there is an amendment which came in Finance Act 2021. I would like to tell you all once again the amendment made by Finance Act 2021. That is from 1st April 2021 the amendment has come. That is, if you receive a corpus donation, then it is not exempt unless you put that corpus donation in the mode specified in 11.5. So I received corpus donation on or after 1st April 2021. If I want to make it exempt, I have to invest that in the mode specified in 11.5. So I received corpus donation, for example, and I invested. Now, when I withdraw that corpus donation and apply that for the objects of the trust, then I will not get the deduction. Do you remember that? When I withdraw that amount from the 11.5 mode and apply for the objects of the trust, it is not allowed as a deduction. Yes, when I put back the money, at that time, where I put back the money, when I put back that money to the 11.5 mode, in that year I will get the deduction under income tax law. So here, check me please. You are depositing back some money in post office saving, utilized for purchase of building. So you are now putting back the money in what? In the mode specified in 11.5. 2021 you are putting back 10 lakh and 21-22 you are putting back 5 lakh. Remember, the amendment came from 21-22. So if you are putting back the money with respect to 21-22, that will be considered as application. But whatever money you have put back for 2021, that will not be considered as application, because at that time this amendment was not applicable. This amendment is applicable from 1st April 2021. Therefore, the amount put back in the mode specified in 11.5, whatever it is, post office, saving bank, wherever you are putting, okay. So this 5 lakh will be considered as application. Therefore, the total application will be 25 lakhs voluntary contribution, 6.8 lakhs donation, and 5 lakh rupees which you are putting back in the mode specified in 11.5 with respect to the donations of 1st April 2021 and there onwards. Okay. Therefore, the total will come to 36.8 lakhs, and therefore this is the answer to this question number 4. I hope it is clear to all of you. Beautiful question it is. And last but not least, Seva Niketan claims that the anonymous donation received are not liable to tax under 115 BBC. Wrong claim. Anonymous donations are subject to 30% tax plus 4% cess. But from that you will get one exemption under 115 BBC. How much exemption? 20 lakhs is the anonymous donation in the question, as you can check over here. How much? 20 lakhs. You can check over here. Okay. Out of that, you will get the deduction of 5% of total donation or 1 lakh, whichever is higher. What is the total donation? The total donation in the question is 105 lakhs. You will get exemption of how much? 5% of total donation or 1 lakh, whichever is higher. And therefore the answer comes to 5.25 lakhs will be exempt. Therefore the taxable amount will be 14.75. Now what ICAI has done over here, that is wrong. They have taken 30% of that. That is correct. But they should have also taken cess over here. Na? Anonymous donations are also subject to cess. They have not included cess over there. They have given the answer without cess. And therefore the answer will come to 4,42,200, which is wrong. Definitely wrong. You should also apply 4% cess on this particular question. Then only the answer will be absolutely correct. Okay. So let's move on to the next case scenario. That is case scenario number 29. Now there are 3 to 4 people over here. Mr. Arvind, Mr. Arjun, Mr. Anand and Mr. Akash. Okay. So these are 4 people, out of which 3 are doing some business and 1 is doing some profession. Okay. Now we need to answer. Mr. Akash is doing some interior decoration profession. Rest of the 3, Arvind, Arjun and Anand, are doing some kind of business over here. Okay. Now pay attention please. Now we need to answer the questions based on section 44 AD and ADA, that is presumptive income. Now which of the following individuals are eligible to declare income on presumptive basis under the provisions of the Income Tax Act 1961 for AY 24-25? So let's first of all find out who all are eligible for presumptive income. Let's see. Is Arvind eligible? Yes, Arvind is doing business and his turnover is 95 lakh. He is eligible. Is Arjun eligible? Arjun is doing business and his turnover is 2.8 crore. Now we need to check. If a turnover of a business is more than 2 crore and up to 5 crore, up to 3 crore, sorry, amendment made by Finance Act 2023. If the turnover is more than 2 crore and up to 3 crore, then you have to check that your cash receipt should be up to 5% of total turnover. Okay. So what is the cash receipt? The cash receipt is 8 lakh rupees. And what is the turnover? Turnover is 2.8 crore. So 8 lakh divided by 2.8 crore. Is it less than 5%? Is it up to 5%? The answer is yes. Therefore, even Mr. Arjun is eligible for 44 AD. Okay. If the cash receipt would have been more than 5%, Mr. Arjun would have not been eligible for 44 AD. Third one, is Anand eligible? Anand definitely not eligible because Anand's turnover is 5 crore rupees. Anand is not eligible for 44 AD. Fourth, is Akash eligible? Yes, Akash is also eligible. How come, sir? Akash gross receipt is 52 lakhs. Here also there is an amendment. If the cash receipt is up to 5% of total receipts of your gross receipt or turnover, whatever you say, if the cash receipt is up to 5% of your gross receipt, then here also you can enjoy 44 ADA, 44 ADA up to 75 lakh rupees. Okay, so here the cash receipt is 2 lakh rupees, total receipts is 52 lakhs. If I divide this, then I will get less than 5%, and therefore I will get the benefit of what? Up to 75 lakh. So therefore even Akash is eligible. Therefore Arvind is eligible, Arjun is eligible, Akash is eligible. Only Anand is not eligible because Anand's turnover is way more than 3 crore rupees. Okay, so this is the answer to the first question. Now the second question, which of the following individuals have to mandatorily get their books of accounts audited under 44AB for AY 24-25. Now who are supposed to get their books of accounts audited for AY for 24-25? None of them, because see, Arvind is following 44AD. He will not get the books of accounts audited. Arjun will not get the books of accounts audited. Even Akash will not get the books of accounts audited because these three people are following 44AD or ADA. Now what about Anand? Anand is not following 44AD. But is Anand eligible for tax audit? No. Why, sir? Because Anand will come in the turnover limit of 10 crore. Why, sir? Because do you remember that if your cash receipt is up to 5% of total receipt, and if your cash payment is also up to 5% of total payment, then the turnover limit for tax audit is 10 crore in case of business. Now Mr. Anand's cash receipt I have already seen. It is what is the total receipts of Anand? Total receipts of Anand is 5.5 crore. What is the cash receipt of Anand? It is 2.27 lakhs. Therefore 27 lakhs divided by 5.5 crore will come to 4.91%. Therefore cash receipt is up to 5% of total receipts. Now what is the total payment? The total payment of Anand is 4.5 crore. What is the cash payment of Anand? The cash payment of Anand is 22 lakh rupees. How much? 22 lakhs. Therefore 22 lakhs divided by 450 lakhs, that also is within 5% of total payments. Therefore the cash receipt is also up to 5% of total receipts, and cash payment is also up to 5% of total payments. Therefore Mr. Anand will enjoy tax audit benefit up to 10 crore rupees. Up to 10 crore rupees he is not liable for tax audit. Therefore even Anand is not liable for tax audit. None of them are liable for tax audit. I hope it is clear to all of you. Okay. Question number 3. What is the amount of profits and gains of business chargeable to tax in the hands of Mr. Arvind, Mr. Arjun, Mr. Arvind first, Mr. Arjun and Mr. Anand, assuming they wish to make maximum tax saving, but they don't want to get their books of accounts audited. They are not interested in audit and all. So what will be the maximum profit? What is the maximum tax saving that Mr. Arvind can do? Arvind can follow 4480, because if he doesn't want to do tax audit, then he has to follow 4480. And how much will be his income? See, the total turnover of Arvind is 95 lakhs. Out of his 85 lakhs is received through NEFT RTGS on or before the due date. So on 85 lakhs, his deemed income will be 6%. And on remaining 10 lakhs, his deemed income will be 8%. Therefore, Arjun's income will be 5.9 lakhs. What about Arjun? Arjun's total turnover is 2.8 crore. How much is received to NEFT and RTGS? 2.65 crore. Therefore, on 265 lakhs, Arjun will show deemed income at 6%, and on remaining 15%, he will show deemed income at what? 8%. Okay. Who is the third person which is asked over here? What about Anand? For Anand, 4480 is not applicable. For Anand, whatever his actual profit is, that is 30 lakhs, he has to show his actual profits. Therefore, Arvind will show 5.9 lakhs without audit. Arjun will show 17.1 lakhs without audit, and Anand will show 30 lakhs without audit. Anyways, for Anand, the audit limit is 10 crore rupees. Okay. So these are the three amounts: 5.9 lakhs, 17.1 lakhs and 30 lakhs respectively. I hope it is clear to all of you. Now, question number 4. Would your answer to MCQ 3, that is the profits and gains of business chargeable to tax in the hands of Mr. Arvind, Arjun and Anand, undergo a change if they decide to get their books of accounts audit? Now let's check. Will they be benefited if they audit? First of all, what is the Arvind's income without audit? It is 5.9 lakhs. What will be the income if he does audit? It will remain 5.9 lakhs. So for Arvind, it will not change. Okay. Now let's talk about Anand first. For Anand, the audit is not applicable. Only Anand has to show 30 lakhs. Anand is not liable for audit. So for Anand also, it will not change. Now for Arjun, what is the income without audit? It is 17.1 lakh. How much income will be there if he does audit? If he does audit, it will come down to 15.5 lakh. Yes. Therefore, for Arjun, it is beneficial to do audit. Okay. Therefore, in case of Arjun, the answer will change. In case of other two, the answer will not change. I hope it is clear to all of you. Why in case of Arjun, the answer will change? Because if Arjun does audit, the profit falls. If it falls, then it is beneficial for you. You should go for it. Okay. That will be great for you. And last but not least, last question. What is the due date of filing of return of Mr. Arvind, Arjun, Anand and Mr. Akash if they wish to make maximum tax savings? See, for Arvind, if he want to make maximum tax saving, he will go for 4480. For him, the due date will be 31st July. For Arjun, if he wants to make maximum tax saving, he should do audit, and if he does audit, the due date will become October. It will not remain July. For Anand, it is always going to be July only because audit is not applicable for him. So for Anand, the due date will remain July. And for Akash also, he is not doing audit. For him also, the due date will remain what? The due date will remain July only. Okay. The due date will remain July. Check it, please. So for Arjun, the due date will change because of the audit. But for rest of the three, the due date will not change because they are not interested in doing what? Audit. Because without doing the audit also, their income is lower than what? The normal profit. I hope it is clear to all of you. So this is what this question is all about. I hope it is clear. So let's move on to the next question. Question number 30 now. There is an LLP who has filed the return of income for AY 23-24 declaring total income of 18 lakhs on 2nd December 2023. Okay. Now, question number 1 says what? For the purpose of answering this question alone, assume that the intimation under 143.1 was sent to Mrs. LMN LLP on 1st of Feb 2025. Would such intimation be valid? Now, what is the time limit to send an intimation? It is 9 months from the end of the financial year in which the return was furnished. Now, when was the return furnished? The return was furnished on 2nd December 2023, as you can see over here on the second line. So this is which financial year? This is financial year 23-24. Now, it has to be sent within 9 months from the end of this year. So the intimation should have been sent by which date? 31st December 2024. Now, when are you sending the intimation? On 1st Feb 2025. Therefore, it is late. And therefore, the answer to this question is question number 2. Point number 2. Okay. I hope it is clear to all of you. Let's move on to the next question. For the purpose of answering this question alone, assuming that in case of Mrs. LMN LLP, certain other incomes which has escaped assessment and came to AO, AO's notice subsequently in the course of reassessment proceedings were also assessed or reassessed in the reassessment order made under 147, in respect of which provision of 148A were not complied with. Examine whether the action of the AO is valid while making the assessment order. Now the question is, first of all, if AO starts your assessment under 147 and during the assessment proceeding, if he finds some other incomes, can he charge the other income? The answer is yes, because he has the power to charge other income noticed during the assessment proceeding. Now the question is, for the other income which is noticed during the assessment proceeding, is he supposed to follow the procedure given under 148A? The answer is no. The procedure should not be followed for other income noticed during 148A. The procedure should be followed under 148A, that is the inquiry before assessment. It is the very clearly it is written, it is an inquiry before assessment. It is not inquiry during the assessment. So once the assessment has started, and if the AO finds new income during the assessment proceeding, he can charge that income without any inquiry under 148A. Therefore, the action of the assessing officer is what? Valid. There is no need to separately send an inquiry notice every time an assessing officer finds some new escaped income. Once the proceeding is initiated, after that there is no need for an inquiry under 148A. 148A inquiry is required before starting the proceeding and not after starting the proceeding. I hope it is clear to all of you. Let's move on to the next question. Compute the amount of penalty to be levied under 270A of the Income Tax Act at the time of assessment under 143, assuming that it is not a case of misreporting. Now it's a very simple question. How much is the income assessed under 143? The income assessed under 143 is 35 lakhs. And how much is the income processed under 143.1? It is 22 lakhs. Therefore, under reporting income formula is what? Income assessed 35 lakhs minus income processed 22 lakhs. 13 lakhs will be subject to what? Will be called as under reported income. On that 13 lakhs, you will compute tax at 31.2%, that is 30% tax, 4% cess. And on that you will apply 50% what? Penalty. That will come to 2,02,800, and that is the answer to this particular question. Next question. Compute the amount of penalty to be levied under 270A at the time of reassessment now. And this is also on account of misreporting. It means here you will apply what? 200% penalty. Now, at the time of reassessment, how much was income? 42 lakh was assessed. Therefore, how much will be under reported income? Income reassessed minus income previously assessed. Therefore, 7 lakh rupees will be subject to what? Will be subject to tax. Therefore, this will be 2,18,400. Of that, 200% penalty will be imposed because it's a case of misreporting. Okay. Now, question number 5. In continuation of question number 4, assuming reassessment order made under 147 was received on 12th of December 2025 and Mrs. LMN LLP does not prefer an appeal. Now, can Mrs. LLP make an application for grant of immunity? No, they cannot make an application for grant of immunity because just few questions back I have told you that immunity under 270 AA is only applicable for 50% penalty cases. It is not applicable for 200% penalty case. And in this question, there is how much penalty which is imposed on you? There is a 200% penalty imposed on you. Therefore, immunity will not be applicable in this particular case. I hope it is clear to all of you. So let's move on to the next question, that is case scenario number 31. In this case scenario, again, there is a question on 44AD and 44AE also. What is AE? AE talks about that truck wala provision, that goods carriage provision. Okay. So there are 4 assessees, ABN company, LMN company, PQN company and XYN company. Okay. Now, the very first question, which of the 4 entities are eligible to declare income on presumptive basis under Income Tax Act? Remember, ABN company is eligible because it is doing business and the turnover is up to 2 crore. It is eligible. LMN company, it's a firm. It is doing business, applying, hiring goods carriage. Therefore, it is eligible for 44AE because it does not own more than 10 goods carriage. You can check the maximum goods carriage are 10. Third, PQN company is not eligible because LLP is not eligible if under 44AD. 44AD is only applicable for resident individual, resident HUF and resident firm. It is not applicable to LLP. XY and firm also eligible. They are eligible for 44ADA because they are a firm and they are having a turnover of up to 50 lakh rupees. They are also eligible. So who is not eligible? PQN company, LLP is not eligible for presumptive income. I hope it is clear to all of you. Okay. Now let's move on to the next question. Pay attention, please. What is the next question? What is the business income to be declared by ABN company and PQN company for AY 24-25? So how much business income ABN company will declare? See, the turnover of ABN company is 25 lakhs. We need to find out the business income of ABN company and PQN company, assuming that they wish to make maximum tax saving but without getting their books of accounts audited. They don't want to get the books of accounts audited. It means they want to follow presumptive income if it is applicable. Okay. For ABN company, how much income will be taxable? See, out of 200 lakhs, 170 lakhs is received by online modes by due date of filing of return. You can check over here. 150 lakh is received by NEFT. Okay. And then 20 lakh is further received by RTGS NEFT. So out of 200 lakhs, 170 lakh is received by online mode till the due date of filing of return. Therefore, that will be subject to 6% deemed income. And the remaining 30 lakhs will be subject to 8% deemed income. Therefore, the total income of ABN company will be 12.6 lakhs without getting the books of accounts audited. Now, what is the total income of PQN company? See, for PQN company, there is no presumptive income. Therefore, whatever is the actual profit as per books of accounts, they have to show that. So, for PQN company, 4.5 lakhs will be the taxable income on which they will pay tax. Okay. I hope it is clear to all of you. Now, coming to question number 3. What is the business income of LMN company? What is LMN company? Assuming that it wants to make maximum tax saving without getting the books of accounts audited. Now, what is LMN company doing? LMN company is engaged in plying, hiring, leasing of goods carriage. Now, it has 10 garages and they have the details given below in point number 2. Now, we need to make the calculation over here. First of all, we need to divide all the vehicles into 2 categories, light vehicle, heavy vehicle. Sir, how do we decide that? If the gross vehicle weight is more than 12,000 kg, it becomes heavy. And if it is up to 12,000 kg, it becomes light. Sir, what is the need to do this? The need to do this is because for heavy vehicle, the deemed income is 1,000 rupees per ton per month. And for light vehicle, it is flat 7,500 per month or part of the month. So therefore, the first one is light, the second is light vehicle, the third one is light, the fourth is light, the fifth is also light. But the sixth vehicle is of more than 12,000 kg, therefore it is heavy. Now, the number of vehicles is given here, the date of purchase is given here, date of put to use is not relevant. What is relevant is for how many months you are owning the vehicle. So in first case, you are owning the vehicle from May to March, that is 11 months. So it is 7,500 into 3 vehicles into 11 months. Okay, that comes to 247,500. In the second month, you are owning from 31st July. It means you are owning for 9 months. So 9 months into 2 vehicle into 7,500, it comes to 1,35,000. Like that, you have to multiply all of them and get the answer. For the last one, it is 13,000 kg. So 13,000 kg is 13,000 kg is 13 ton. So for every ton, it is 1,000 rupees after 12,000 kg vehicle. So here the deemed income will be 13,000 rupees into 2 vehicle. into 4 months, because from December to March it will be 4 months. A part of month is considered as a complete month. Okay, so therefore if I total all of them, I will get the answer as 6,36,500. I have done the calculation for you all. You can check it over here. Okay, therefore the answer will come to 6,36,500, and therefore the answer to this question is 6,36,500. But if do you remember, an assessee following 44 AE is also eligible for working partners remuneration and interest. It is also eligible for 40B benefits. Now 40B benefit is not available for 44 AD assessee. It is not available for 44 ADA assessee, but it is available for 44 AE assessee. Therefore this assessee will also get the benefit of what? This 2 lakh rupees. Therefore 6,36,500 minus 2 lakh rupees interest and remuneration. The answer will come to how much? 4,36,500, and that is the taxable profit on which the assessee will pay the tax. Okay, now coming to the next question. What is the income to be declared by XYN company? Who is XYN company? XYN company is the firm. Okay, if under the head PGBP, if they wish to make maximum tax saving without getting the books of accounts audited. Now what is the gross receipts of XYN company? It is 50 lakhs, and it is doing interior decoration. Is it eligible for 44 ADA? The answer is yes. 44 ADA covers interior decoration, and 44 ADA covers partnership firm also. Therefore 50 lakhs, 50% is the deemed income, and therefore 25 lakhs will be the taxable profit of this particular assessee. They will not get remuneration and interest deduction. No. 44 AD and ADA assessee do not get the deduction of remuneration and interest covered under 40B. That benefit is only available for AE assessee, not for AD and ADA assessee. All of them are very beautifully written in our books, and we have also interlinked all of them very beautifully in our books. You can go and check. Okay, now one last question in this particular MCQ. Would your answer to MCQ 3 and MCQ 4 change if the firms decide to get their books of accounts audited? Let's see. If LM company wants to get their books of accounts audited, will your answer change? The answer will change, because if LM company wants to get their books of accounts audited, they will show the profit as 4.1 lakhs, and then profit of 4.1 lakhs is lesser than what we have shown earlier, correct? And this profit is after deduction of interest and remuneration. Therefore how much we are showing? 436,500. If they do audit, what will be the profit? 4.1 lakhs. Therefore the answer will change definitely. Now would the answer to MCQ 4 also change? The answer to MCQ 4 will also change. How it will change? Because if we go as per what? If we go as per what this particular company's actual profit, the actual profit is 20 lakhs. No doubt we will do what? We will, this is after deduction of what? Remuneration and interest. Okay, now we will add back the remuneration and interest. Therefore in this case also the profit will change. Okay, so check it please. Yes, there would be a change in both answer to MCQ 3 and MCQ 4, because the actual profit is different as compared to what you are showing in the deemed profit. I hope it is clear to all of you. Now let's move on to the next case scenario, which is one of the favorite case scenarios of ICI. They have put this case scenario a lot of time in different kind of RTPs and MTPs, and even in their study material there is a question based on this, which is on conversion of capital asset into stock in trade, and then stock in trade is sold, and then you are investing some money in 54 EC bonds. So it's a combination of all of them together. So let's read the question first. Question number 1. What is the amount of capital gain chargeable to tax in the hands of Miss Malika for AY 24-25? Now, Miss Malika has purchased the land for 50 lakhs in 2008, and then on 30th September 2022, she converted the land into what? Stock in trade. At that time, the FMV of the land was 300 lakhs. So remember, when you convert a capital asset into stock in trade, so FMV on the date of conversion becomes your full value of consideration. Therefore, my full value of consideration will be how much? 300 lakhs, which is 3 crore. What is the cost of acquisition? The cost of acquisition of the land is 50 lakhs. I will multiply by the indexation of the year in which I converted. In which year I converted? I converted in 22-23. So 22-23 indexation is how much? 331, which is not written here. I am writing here. So I will multiply by 331 and divide by the indexation of the year of purchase. The year of purchase is 2008-2009. 2008-2009 you have purchased. Therefore 50 lakhs into 331 divided by 137. This is your long-term capital gains. But remember, this is the total long-term capital gain. This will not be chargeable to tax in the year 24-25. How much will be taxable? Let's see. Now on this land, she has constructed 20 apartments of equal size, out of which the cost of the apartment of construction is 15 lakh rupees, out of which she sold 14 apartments during the year Jan 2024 and Feb 2024. So on this land, she has constructed 20 apartments. Out of that, she has sold 14. So 14 out of 20 comes to how much percentage? It comes to 70%. Therefore, you can say 70% of the SIT is now sold. Therefore, 70% of this particular capital gains will now be chargeable. 70% of this will come to how much? 179,19,708 into 14 divided by 20. This much will be chargeable in AY 24-25. I hope it is clear, because that much SIT is sold in the current year. Now, to save this, you are investing some amount of 20 lakh rupees in what? In NHAI bonds, and 20 lakh rupees in rural electrification bond in the month of June. So whatever you have invested within 6 months from the date of sale of SIT. When are you selling the SIT? In Jan 24 and Feb 24. So from Jan 24 to Feb 24, within 6 months of that, whatever you are investing in what? In the NHAI or RECL bonds, that much will be allowed to you under 54 EC. Whatever you have invested after 6 months, that will not be allowed as exemption. So how much you have invested? You have invested 40 lakh rupees. Therefore, after reducing 40 lakhs, your answer will come to 85,43,796 will be chargeable to tax in the current year. Okay, I hope it is clear to all of you. Now question number 2. What is the amount of income chargeable to tax in the hands of Mr. Malika under PGBP? Now under PGBP, how much will be subject to tax? How many flats you are selling? You are selling 14 flats. You are selling one flat at what price? At 40 lakhs. Therefore 14 into 40 comes to how much? 5 crore 60 lakhs. Now you need to reduce two costs. One is the cost of land and second is the cost of construction. How will you compute the cost of land? The cost of land will be the cost of what? The FMV taken for computing capital gains. That becomes the cost now while computing the PGBP income. Therefore, how much was the FMV? It was 3 crores. So you have to take 70% of that, because you are selling only 70% of the flats. Now you are not selling the entire 20 flats. You are selling only 14 flats. So therefore 70% of 3 crore comes to how much? It comes to 2 crore 10 lakh. This will be the cost of land, which will be the FMV of the land. What is the cost of construction? It is given 15 lakh rupees in the question, as you can see. So 15 lakhs is the cost of construction for 14 flats. That will again come to 2 crore 10 lakh. Therefore ultimately the PGBP income will be 1 crore 40 lakhs. Okay. Now let's go ahead. What is the amount of income chargeable to tax under the capital gains and PGBP in the next year? In the next year, see, Malika is selling the remaining 6 flats. Remaining 6 flats are held as stock in trade on 31st March, but it got sold in April 2024 for rupees 40 lakh rupees per apartment. Therefore on that the remaining capital gains will now be subject to tax. Remaining capital gains is how much? Whatever was capital gains coming earlier minus this amount. This amount will be your remaining capital gains. So what was the capital gains which was coming earlier? 179,19,708 minus 125,43,795 was subject to tax earlier. So you can say 70% was taxed earlier. Now 30% will be taxed now. So 30% will come to how much? 30% will come to this much. And now in this year also you have invested what? You have invested 10 lakh rupees in rural electrification bond in June, and then again 10 lakh rupees in what? In December, sorry. So whatever you have invested in December, that will not be eligible, because you are selling the flats in April, you are investing in December, so it is beyond 6 months. So whatever is beyond 6 months, that will be allowed, that will not be allowed. With whatever is within 6 months from the date of sale, that will be allowed. So the one you have invested in the month of what? September. See, remember, this 20 lakh invested in March, that is already covered in the last year. This 20 lakhs invested in June, that is also covered in the last year. 40 lakhs you have already taken exemption in the last year. This 10 lakh invested in September, you can claim exemption in the next year. This 10 lakh invested in December, that will not be allowed as exemption, because this is beyond 6 months from the date of sale. Therefore what is allowed from this as an exemption? Only 10 lakh rupees will be allowed as exemption from this particular amount. Okay. Now how much will be the PGBP? Same PGBP. 40 lakhs you are selling one flat for, into 6 flats, 240 lakhs is your what? Is your sale consideration, minus what is your cost of land? It will be 30% of your FMV. Your FMV is 3 crore. 30% of that comes to how much? 90 lakhs. And what will be your cost of construction? It will be 15 lakh rupees per flat cost of construction into 6 flats. That is 90 lakhs. Therefore the answer will come to how much? The answer will come to 60 lakhs. Therefore the complete answer is 43 lakhs 75,912 will become your capital gains, and 60 lakhs will become your PGBP income. And one last question over here is, not last question, second last question. Is the annual value of penthouse held as stock in trade taxable? If so, under which head, and what is the amount taxable for the AY 24-25? Now let's see, some penthouse has been purchased by this person. What is the penthouse? Let's see the penthouse where she also holds a penthouse in Nagpur, which was completed in March as stock in trade. She has let out the penthouse to Mr. Aarish for how much? 60,000 rupees per month, to whom she has furnished a PAN. He paid, that is the tenant is paying the municipal tax of 7,200. Okay. Now she is letting out the penthouse for 60,000 rupees per month. Therefore the total annual value will be 7,20,000. From that, she will not get the deduction of municipal tax. Why? Because the municipal tax is paid by the tenant. If the tenant pays the municipal tax, then the owner will not get the deduction under house property. Therefore, she will only get 30% standard deduction. Therefore, this will be taxable. Yes, 5,04,000 will be taxable under income from house property, and deduction of municipal tax will not be allowed to the assessee. I hope it is clear to all of you. Last but not least, is Mr. Harish, who is the tenant? Who is the tenant? You are giving this penthouse to whom? You are giving this penthouse on rent to Mr. Harish. Is Mr. Harish liable to deduct tax at source on rent paid to Mr. Malika? If so, what is the amount to be deducted? Yes, Mr. Harish is a salaried individual. Therefore, a salaried individual will not deduct TDS on rent under 194I. But definitely, because the rent per month is more than 50,000 rupees, therefore he will deduct TDS under 194IB. On the last month, 5% he will deduct on the entire financial year. Therefore, yes, he has to deduct 5% of the total rent. The total rent is how much? 60,000 into 12, 7,20,000. On 7,20,000, he will deduct how much? He will deduct 5%. That comes to how much? 36,000. And that will be deductible from the rent payable for the month of March. Because in IB, why IB is applicable for Mr. Harish? Because Harish is a salaried individual. See in the question, it is very clearly written. Mr. Harish is a salaried individual. Can you see this? Salaried individual. Therefore, Mr. Harish is liable to deduct TDS under 194 IB in the last month at the rate of 5% on the total amount. Okay. I hope it is clear to all of you. So let's move on to the next case scenario. That is case scenario number 33. The very first question over here, it's a very good case scenario. It's a very different kind of case scenario. It's not a repetitive case scenario. There are some very good and new questions, very fresh question which you have not seen in the earlier case scenarios. Okay. Now question number 1, is Wellness Private Limited required to get its books of accounts audited under 44AB? The answer is yes. Now we don't have to answer only yes or no. We need to answer why. See, the turnover is more than 1 crore. But there is also a 10 crore limit, sir. Yes, 10 crore limit is applicable if your cash receipt is up to 5% of your total receipts and your cash payment is also up to 5% of your total payments. Now in this question, if you see the cash receipt is 5.5 crore rupees, 5.5 lakhs. Check here. The assessee has sold some goods to some customer and received the money in cash. Check. So now cash receipt is 5.5 lakhs. The total receipts is how much? 1.1 crore. So the cash receipt is within the limit. 5.5 lakhs if I do 5.5 lakhs divided by 110 lakhs, it comes to 5%. So I am fulfilling this condition. But I am violating the condition of cash payment. The cash payment in my question, when we will read the question ahead, will come to know that it is 7 lakh and the total payment is 7 crore 8 lakh 44,500. Okay. So the cash payment is much more than 5%. Therefore, what is the reason for doing audit? The reason for doing audit is because the turnover is more than 1 crore and because unfortunately the cash payment is more than 5%. Okay. Therefore, yes, since the turnover is more than 1 crore and since the cash payment during the year exceeds 5%, we will be liable to do tax audit. And therefore, the answer to this question is yes, because of reason number 2 and reason number 5. Okay. I hope it is clear to all of you. Let's go on to the next question. What is the amount to be disallowed for non-deduction of tax at source while computing the PGBP income? Okay. So how much income, how much expenditure you will disallow for not deducting the TDS? Now, first of all, we need to see which all payments we have made. First of all, you have made a payment of around 35 lakh rupees as a remuneration to 20 specialists, but you have not deducted the TDS. TDS is not deducted. Okay. You have not deducted TDS on this. So if you have not deducted TDS, TDS is applicable. This expenditure will be disallowed to the extent of 30%. Similarly, there are 3 staff to whom you are paying 25 lakh rupees. All of them have total income more than 8 lakhs. You should have deducted TDS here also. Here also you have not deducted the TDS. So here also 30% will be disallowed. So 30% of 35 lakhs will be disallowed first. Then 30% of 25 lakhs will be disallowed. Okay. Then you are giving some wages to security guard or housekeeping. It is not more than 15,000. So it is not disallowed for TDS. So it's okay. So it is only 15,000 rupees. So TDS disallowance will not happen over here because for TDS disallowance the limit should cross now. The other person should earn more than what? The taxable limit. Otherwise, why will I deduct the TDS? Okay. Similarly, on computer purchase, there is no deduction of TDS. Similarly, on payment of interest to bank, there is no deduction of TDS. Again, the administration expenses are less than 8,000 rupees. So again, no TDS. Against advance to supplier for some amount, again, no TDS will be applicable on that particular case. So therefore, the TDS is only applicable in the first 2 cases. that is on 60 lakh rupees, you should have deducted TDS. And now if you have not deducted TDS on 60 lakhs, so 30% of 60 lakhs will be disallowed in your hands. Okay, so 30% of 60 lakhs comes to how much? It comes to 18 lakh rupees. So 18 lakhs will be disallowed because of non-deduction of TDS. I am not saying this is the total disallowance. This is the disallowance because of non-deduction of TDS, because the question is also asking that only. The question is asking how much expenditure will be disallowed because of non-deduction of TDS. The question is not asking the total disallowance. The total disallowance is more than this. Okay, that will come to know in the next question. Compute the amount of depreciation allowable under section 32 for previous year 23-24 on the computer purchase. So how much depreciation will be allowed to us? Now let's see. What is the computer price of the computer? The computer is purchased for 3,50,000 on 15th May, but it is put to use from 15th of October. So you will get depreciation not 40%, only half, that is 20%. Okay, therefore the value of the computer is how much? The value of the computer is 3,50,000. But you have taken a loan to purchase this computer. The loan is taken on 15th of April. You have taken the loan on 15th of April and you have paid interest of 34,500. So the interest which you have paid for 11 and a half month. How 11 and a half month? You are paying the interest from April 15 till 31st March, obviously. Okay, this is the interest for the entire year. So the interest has been paid for 11 and a half month, but the interest from 15th April to 15th October will not be allowed as an expense, but it will be capitalized to the cost of the asset. So the interest of 6 months out of 11 months, total interest is how much? 34,500. Therefore the interest of 6 months out of 11.5 months will be capitalized to the cost of asset. Therefore the total cost of asset will come to how much? 3,68,000. Did you understand what I said? 3,68,000 will be the total cost of asset. On that you will get how much? 20% deduction, and therefore the answer of depreciation will come to how much? 73,600 rupees. I hope it is clear to all of you. Now, what is the total income of Wellness Private Limited? Let's compute the total income of Wellness Private Limited step by step. First of all, the turnover of Wellness Private Limited is 1.1 crore. Therefore, the turnover will be 1.1 crore. Revenue is 1.1 crore. Now we will start to remove all the expenses. Remuneration and staff to salary will be allowed after disallowing 30% expenditure. Therefore, the total expenditure was 60 lakhs. 18 lakh is disallowed as we have already discussed for non-deduction of TDS. Therefore, 42 lakhs will be allowed as deduction. How much is the depreciation on computer? 73,600 is the depreciation on computer plus. How much is the total interest paid by the assessee? 34,500, out of which how much is capitalized? 18,000 is capitalized. Therefore 16,500 should be allowed as revenue expenditure, definitely, because the interest which is paid for the period after 15th October should be allowed as a PGBP expense, yes or no, under section 36 subsection 1 clause 3. So that I am taking as a deduction, and then I am taking some deduction of 70,000 what as an admin expense which is paid. Admin expense paid in cash allowed? Yes, it is allowed, because it is less than 10,000. It is 8,000 rupees to per person per day. Therefore that will also be allowed. That 70,000 will also be allowed. Therefore if I reduce all these things, the answer will come to 66 lakhs 39,900 rupees. This is the total income on which Wellness Private Limited is liable to tax. Okay, now is any penalty imposable on the company for cash received from customer X? If yes, how much? Yes, you are selling some goods to some customer, you are billing 5,50,000 rupees to a customer. Now if you do a transaction of 2 lakh or more with any person in a day, then you cannot receive even a single rupee in cash. Okay, so if you do a transaction, are you doing a transaction of 2 lakh rupees or more with Mr. X on 26th June? Yes. Now you cannot receive a single rupee in cash as per section 269 ST. If you receive any amount in cash, that will be liable for penalty under 271 DA. Now you have received this amount in cash in 4 installment, 1,50,000 first, then 75,000, then 175, then 1,50,000. This entire amount will be subject to tax under what? This entire amount should be subject to penalty under section 271 DA. Therefore yes, penalty is leviable, and 5,50,000 rupees penalty will be leviable under 271 DA. So this is what this beautiful case study is all about. Okay. Now one last case scenario, that is case scenario number 34, which is there in front of you all. Let's discuss that. Okay. Now the AO has done some survey in your hotel at 11:30 p.m. in the night. Okay, on 15th of August, and your hotel is open between 11 a.m. to 12 a.m. in the night. Okay, 11 a.m. in the morning to 12 a.m. in the night. Further, the AO has also asked for certain information from another hotel. For that purpose, the AO has entered the premise for collecting some information. At 9:15 p.m. the restaurant is kept open from 7 a.m. to 10:30 p.m. in the night. Apart from that, the AO has also impounded certain books of accounts for 18 days exclusive of holidays. and the AO did not take prior permission from commissioner or above for doing so. Okay. Now there are a lot of questions that are asked to us. First, is the action of the AO entering TR and hotels at 11:30 p.m. valid? So he is entering the hotel at 11:30 p.m. Actually, it is valid, but he has done one mistake. What is that mistake? He should have taken an approval from higher authority. Okay. It is not valid since the permission of income tax authority equivalent to chief commissioner is not obtained by the AO, though he entered during the hours at which such place is open for the conduct of business. As I have told you, he has done correct. He has entered at the correct time. Because the law himself says that you can enter during the business hours. For survey, you can enter after sunrise but before sunset. But if the business hours is in night, then you can enter in night also. There is no problem. But the thing is, he has done one mistake, that he has not taken the approval of chief commissioner. He should have taken the approval of chief commissioner. If he would have taken the approval of chief commissioner, he would have been absolutely correct. But in this question, he has not taken the approval. Therefore, he is not correct. Okay. Question number 2. Would your answer to question number 1, it is not 5. Would your answer to question number 1 change if the AO had surveyed TR hotels only for the purpose of verifying tax has been deducted or collected at source in accordance with the provision of the act? Again, the answer is wrong. Why? Because again, the approval has to be taken. Without approval, you cannot do any survey. It is not possible. You cannot do survey without hotel. Even if you want to do survey only for tax, for checking what tax deducted and collected at source. Now, survey can be done for two purposes: to check escaped income also, and also to check the compliance of TDS and TCS. So in this question number 2, you are doing survey for checking the compliance of TDS and TCS. Even in this case, you should have taken the approval of higher authority, chief commissioner. The action is not valid again since he has entered the place after sunset. The permission of the income tax authority equivalent to chief commissioner or above is not obtained. Therefore, he cannot do this survey. It is not a valid survey. Okay. Question number 3. Is the action of the AO entering RR hotel at 9:15 p.m. valid? Okay. Is it valid? So RR hotel, he is entering 9:15 p.m. Check. Is he entering on time? Yes, he is entering on time. Why? Because the business hours are from 7 a.m. to 10:30 p.m. Okay. So is this valid in this case? Yes, it is valid. Since the AO has entered during the hours at which such business is open for the conduct of business and prior permission of higher authority is not required under 133B. See, for survey, it is required to take approval of higher authority. But to enter a premise to collect some information under 133B, see, 133B is for collecting information and 133A is for survey. For survey, the approval of higher authority is required. But for collecting the information, it is not required that you should take an approval from what? Higher authority. Therefore, in this case, the assessing officer is absolutely correct. Okay. Now, is the action of the AO in impounding and retaining in his custody books of accounts and other documents of TR hotels after recording the reason for doing so without taking the permission from income tax authority equivalent to commissioner or above valid? Not valid. Remember, if the AO wants to impound the books of accounts for more than 15 days, then he has to do two things. He has to record the reasons with higher authority, and he also has to take an approval from higher authority. So now in this question, he is impounding the books for how many days? He is impounding the book for 18 days, which is more than 15 days. So he has to take an approval from higher authorities. Therefore, the action of the assessing officer is not valid over here. Okay, it is not valid. And last question, would your answer to MCQ4 change if the AO has surveyed TR hotels only for the purpose of verifying whether the tax has been deducted at source in accordance with the provisions of this act? Again, the answer would have been incorrect, because even if you go to only check the TDS and TCS compliance, and in that process, if you want to collect the books of accounts and take it with you for more than 15 days, you have to take the approval of higher authority. You cannot take the books of accounts and documents and other information for more than 15 days without recording the reasons for the same and without taking the approval from the higher authority. So even in this case, the officer is incorrect. Okay. So this is what this question number 34 is all about. And this is what the 34 MCQ case scenarios is all about. And this is what my commitment towards my full English students is all about. Remember, always, I have made a commitment to you all that I will try my best that whatever I will put for my Hindi students, I will equally put for you all also. Okay. It might be delayed for some days, but I will not ignore you all. Don't worry. Okay. Because for me, if my Hindi students are important, you guys are also equally important, because you are restricted by language barrier and you are not able to understand my Hindi language. And by God forbids, by God's grace, I am able to speak both the language. I don't know how good English I speak. I don't know whether my English is good enough, whether you are able to understand my message properly or not, whether you are able to understand what I'm trying to explain you or not, but I'm trying my best to explain you all in English. My forte is Hindi only. I'm not expert in English, but still I'm trying my best. It takes a lot of effort. If I'm putting 100% for an Hindi video, I have to put 300% for an English video, because it is absolutely difficult for me to think all those things so fast and then repetitively say all those things to you all. So it is my sincere request to all of you that if you have liked the video, it is your duty, it is your obligation, and it is my request that you have to share it with every student who wants to learn direct tax in English. We have put a lot of content in English. I have put revision videos in English, except few topics like TDS, etc. That also I will put, don't worry. I will try my best to put that also. I have put revision videos in English. I have put last attempt MCQ videos in English. I have put last 7 RTPs, MTPs, exam 23 papers in English revision videos. 23 papers. You will not get that revision video for any subject. Forget about direct tax. You will not get the compilation of 23 papers, RTPs, MTPs and exam paper compilation. Forget about direct tax. You will not get for any paper out of 6 papers by any faculty in this country in any language. Forget about English. You will not get it in Hindi also. The compilation which we have done it in English for you all. Okay. So I'm trying my best to give equal importance to you all. Okay. I want encouragement from you all. What kind of encouragement? That you have to share this video with the maximum of your friends. Every student of South India who wants to learn direct tax in English, who wants to learn direct tax in English, who wants to understand each and every concept in detail, who wants to utilize maximum resources of direct tax in English, should be having this particular videos in front of him or her. I request you all to share this with your maximum friends. And I request you all to comment below what was your experience of learning this entire video from me. I am also putting the entire timestamp of all the 34 MCQs, in which there are more than 170, 180 MCQs. I will be putting the timestamp of every MCQ, MCQ number 1.1, 1.2, 1.3, 1.4, 1.5, 2.1, 2.2, 2.3, 2.4, 2.5, like that, so that if you want to search a particular MCQ, if you want to know the explanation of a particular MCQ, you can directly click on that and you can directly watch that. Further, I will also put this link of this file below in the comment box. You can directly download that link. Okay, I will put both the file with explanation and without explanation, with my working and without my working. I will put both the file. Okay, till then, take care all of you. Bye all of you. Take care. I had great time making this video for you all. Take care all of you. I hope you all also had great time listening to this video.